Nagpur, the hometown of Maharashtra's Chief Minister Devendra Fadnavis, and the RSS headquarters witnessed riots on Monday.
Welcome back. So we are prepping for a good start. Let's get the implied open back up on the screen. It's choosing to be on the green side, though Asia is a little mixed, but yeah, there we go. Another 90 points higher. That's what the indication is. So let's see. It's bulls in total control. Our team is standing by with the CNBC-TV18 list of top stocks to watch. So let's get started with IOB. Guys, morning to all of you. Sudarshan, why are you watching out for this one?
Morning, Surbi. So IOB yesterday has disclosed to exchanges that it has launched QIP, and for that floor price that company has fixed, floor price is normally as per the SEBI formula. So it is 42.70 per share, and total size of the QIP is of up to 2,000 crore rupees. And of this, base size is rupees 1,000 crore and upsize option is of rupees 1,000 crore. And deal size is of up to 49.3 crore shares, forming 2.6% equity. Now, the important part is indicative price, which is 40.5 cents per share, more than 7% discount to yesterday's closing price. That's the reason I'm going with red, because discount level is very high for the QIP that IOB has launched.
All right, Masood, thank you very much for that. So, once again, I mean, a QIP secondary market transaction starting to open up as the market is looking a little better. Well, let's talk about Paytm. The stock, of course, has been performing for the last 2 days. Day before was the big move. Yesterday, the stock ended about 3% higher. Vinny is here with more. Vinny, morning.
Hi, morning. So today maybe we could see some bit of a red coming in on the screen. Yesterday the cabinet actually approved some extension of incentives for UPI transactions of up to 2,000 rupees. This is specifically for those small merchants bankers from 1st of April 2025. Now, Jefferies has come out with a note. They've given a hold rating target price of 850 rupees for Paytm. Now, what's the concern is that the incentives are half of the incentives, the value is half of that was of what was given last year. This time it's 1,500 crore rupees. What this means is that incentives now will fall. The benefit that the companies would get would fall from 20 basis point to just 6 basis point. And specifically for Paytm, if this is actually the figure that works out from 20 to 6 basis point as a benefit, then the adjusted EBITDA also could be 50% below estimates in FY25. In FY26 and 27, it would be lower by around 20 to 30%. This is the adjusted EBITDA I'm talking about. And profit before tax for FY25 would be lower and could be lower by 15%. Only one positive sign that we could watch out for, there were news flows coming in around MDR-based charges, that is merchant discount rate charges, which are currently not there for these bankers, Paytm currently. If that starts getting implied, then that could be a silver lining for Paytm. But as of now, red is what we could expect on the screen.
Right, red on Paytm. Let's see what happens on that one, Vinny. But Voltas is a stock that I'm watching out for. Yesterday, we had that conversation with Blue Star and PG Electroplast. Voltas held its analyst meet as well. The stock has been doing well. Over the last 1 month, is up 16% in a wobbly market, increased its gains. The key takeaway from the analyst meet is that the company will focus on profit expansion through value engineering versus a price hike. In fact, over the last 8 to 10 months, the air conditioning market has grown 30%, whereas company has grown upwards of 35%. So they've gained market share and they expect to continue to do that. Yes, production costs have gone up due to INR depreciation and rise in commodity prices. But the company on its part has not taken any meaningful price hikes. In fact, the industry has taken a price hike of 3 to 5%. Voltas hasn't. They've indicated that secondary sales ahead of the peak summer season on a very high base are fairly encouraging as well. And they continue to expect to grow ahead of the industry. Analysts are mixed on this one because Nomura has said they're neutral. We have CLSA, which has said after this outperformance, maybe they have a target price of 1375. Morgan Stanley still maintains its overweight rating. My sense is that because of the fact that the company intends to continue to gain market share and peak summer sales season being more encouraging, the stock, despite the outperformance, may continue to see some green.
Okay, all right. So Voltas is going to be on our radar as well. Let's go back to Sudarshan. Manappuram, today they're looking to raise some money. There's a board meeting today, Sudarshan.
So Manappuram stock has been in focus over the last few sessions. You would have seen that stock has been moving higher despite the stock was in F&O band. It's up 6% this month, up 14% in 2025, and nearly 7% away from the record high. Earlier this week, Manappuram had disclosed to exchanges that board will be meeting to consider fundraising proposals, and that board meeting is going to happen today, and board will be considering raising fund via both equity and debt. So what were the reports? Reports were that Bain Capital is likely going to acquire majority stake in the company, and the deal value was seen around $1 billion. On that report, company had clarified to exchanges on February 24, saying that it continues to evaluate proposals as it comes. So on the back of this and ahead of the board meet, I'm going with green for Manappuram Finance because it's important news, and also the stock has come out of the band today.
All right, that's Manappuram, and expectations that we'll see the price and of course open offer, etc. I think all those things will be in focus. But stock's done well coming into this event over the last couple of weeks now. SBFC Finance is the next one we want to talk about. Vinny is here with details. Vinny.
Hi, morning. So SBFC, we are keeping an eye on this one. Now, the promoters, that is SBFC Holding Pte, has sold some stake in SBFC yesterday. This was through an open market transaction. It came in the bulk deal. 1.3% stake is what they've sold. That is around 1.36 crore shares. Value is around 112 crore rupees. SBFC Holdings, and the promoter company, will be holding around 53.49% stake in the company after the stake sale. But what is interesting is that over the last few quarters also, they promoters have been reducing stake few percentage point, but they have been reducing. In March 2024, it was around 60%. Now, currently, obviously, after the stake sale, it will be at around 53.5%. So, interesting to watch out for SBFC Finance, and we're expecting red on the screen today.
Right, Vinny, thanks a lot for that. I'm looking at International Gemological Institute, IGI. Remember, the stock has been beaten out of shape. It's down 50% from its post-listing high, way below its IPO issue price at 417 as well. And the company's been meeting analysts over the last couple of trading sessions or couple of days itself. What they've said is that the demand for certified diamonds, gemstones and jewelry is expanding beyond traditional market. That was one of the key concerns, whether there is enough demand for, certification itself or not. And on the supply side, the market has a very high entry barrier. Beyond diamonds, they are saying the market is also witnessing a greater interest in colored stones and contemporary jewelry style certification. And the acquisition of Belgium and Netherlands business would give them about 25% additional revenue. They have 65% of the global market share of lab-grown certification as well, which will increase in penetration. So they, on their part, are assuring the street that maybe the demand for certification will continue. The stock has seen a correction, so maybe opens in mild green. Thereafter, what really happens is what the expectations of the investors are on the overall demand itself for certification. So we'll keep an eye out on that one.
Okay, let's see if that commentary can add to confidence in any way after the big fall that the stock has seen. Let's move on. There are a couple of other stocks also in news as well. Vivek is rounding them for us. Vivek, good morning.
Well, good morning. Quite a few stocks in focus. This is on the back of news flow. First on the list is Jyoti Structures. The company has given a year-end order book update. So the company currently sitting at an order book of over 1,800 crores. They say that the majority of the orders will be executed in the next 12 to 18 months. NCC, a good material order coming in for this particular company. The company has received an order from the Andhra Pradesh Capital Region Development Authority. The order size is close to 2,130 crore. And the order is for construction of roads as well as other allied activities. Now, the construction period of this particular order is 3 years. Just to give some perspective, at the end of Q3, remember the company received orders of close to 14,000 crore in YTD FY25, and the company had earlier given an order inflow guidance of close to 20,000 crore. So, company closer to its guided target. Now, the other stock on the radar is Indian Bank. The company today will be meeting. The board meeting is held to consider a proposal regarding fundraising. And lastly, keep an eye out for Antony Waste as well. Some relief coming in. The Bombay High Court has dismissed the Navi Mumbai Municipal Corporation's plea to set aside an arbitral award that was awarded towards or in favor of Antony Waste. Now, NMMC has gone ahead and deposited close to 20 crore rupees. This also includes the interest of the earlier arbitral award. So, some green expected on Antony Waste as well.
Okay, all right, got it. Thanks very much, Vivek, for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are Voltas, Manappuram Finance, Jyoti Structures, NCC, Indian Bank, Antony Waste and IGI. The ones that have negative news around them are Paytm, Indian Overseas Bank and SBFC Finance. Okay, let's move on and talk about Ola as well. Ola Electric has now faced a fresh set of issues with the Ministry of Heavy Industry seeking details on sales data and some inspections as well. We have Parikshit joining in with more details. What's the latest, Parikshit?
Well, Ola seems to be facing questions at multiple levels. One, at the central level, the Ministry of Heavy Industries, which is the nodal body for PLI and also the PM E-Drive incentives, is now looking at the mismatch in data. That is what Ola Electric is claiming as 25,000 vehicles sold in the month of February versus 8,600 odd vehicles which are registered in the Vahan or the Ministry of Road Transport Highways registration portal. So they're seeking details from the company as to why there is a mismatch. Secondly, we have seen an order of the Maharashtra government and also by other RTOs in the country. There are inspections happening against Ola Electric at their stores across the country. In fact, in Maharashtra, over the last 2 days, there have been 36 locations where there have been inspections. And this has happened in Pune, this has happened in Mumbai, and close to 34 to 36 scooters have been seized also by the RTO. This is because the scooters are found without valid registration documents and these stores do not have valid trade certificates. A similar a probe inspection has happened in Jabalpur, where 6 or 7 scooters were inspected and a reply from Ola has been sought. We've also got to know that Ola Electric stores in Punjab were also shut down for not having valid fire certificates and trade certificates. We have sent detailed queries to Ola Electric on all of these issues. We are yet to get a formal reply from them.
All right, Parikshit, thanks a lot for that. Ola, the news flow continues on a regular basis on that one. We'll keep an eye out on how that performs in trade today. But for all the roundup of the commodity market action overnight, Manisha joins in. Manisha, let me hazard a guess. Gold continues to glitter and yet another record high is what we saw there.
Oh, well, absolutely. And it's not even tiring at these levels. You know, the gold is trading at above $3,050 an ounce right now. This is after the U.S. Fed stayed put on rates as widely expected and indicating reducing borrowing costs by 0.5 percentage point by the end of this year. So the bull market is surging strongly, holding above 3,000, holding 3,050 as well. The geopolitical tension seems to be coming back and the fears of recession also are on the higher side. So there is one safe haven and you have to be invested, whatever size of your portfolio, within gold. But let me remind you, it's not just gold. Take a look at copper prices. 10-month highs onto this one. Inventories have continued to decline. Potential tariff concerns keeping this commodity also on the higher side. And very strong gains is what we are also working with in sense of aluminum and zinc because of supply disruptions. And again, as markets weave in the tariff percentages into this as well, all of these commodities in Asia are trading very, very strong right now.
Manisha, thank you very much for that. Thank you very much for taking us through all of that. We'll take a quick commercial break. Deepan Mehta of Elixir Equities is going to be with us in just a bit from now. We'll talk about individual names that Deepan is watching. We've had a nice rebound. Deepan, of course, has also been turning constructive for the last couple of occasions that we've had him. So that's coming up.
Had been simmering since the release of the Hindi movie Chhawa based on Chhatrapati Sambhaji Maharaj's life. The film brought Mughal Emperor Aurangzeb to the forefront, polarizing opinions. On Monday, VHP members held a procession in Nagpur to mark Shiv Jayanti, passing near a mosque. According to police, VHP members burned an effigy of Aurangzeb during the procession. They also burned a chadar bearing holy inscriptions. Sources told CNBC-TV18 that while police were deployed at the time, no violence broke out immediately. However, later in the evening, members of the minority community reportedly pelted stones and set vehicles ablaze, triggering clashes that left around 40 people injured. Among them were 33 police personnel, including 3 DCPs. Over 40 vehicles were torched. Nagpur Police Commissioner Ravindra Singhal told CNBC-TV18 that the situation is now under control with Section 144 imposed. He confirmed that 47 people, including members of the majority community, have been detained so far. Regarding the burning of the effigy and the chadar, Singhal claimed police had no prior knowledge of the VHP's plans. He added that officers tried to intervene and prevent the burning of the chadar, asserting that police have video evidence to support this. As for reports suggesting rioters were armed, Singhal refuted claims of swords and knives, stating that the rioters used bricks and stones gathered from a nearby construction site, making it harder for police to detect any build-up. But later, Chief Minister Devendra Fadnavis said that one of the cops was attacked with an axe. On the question of action against VHP members for inciting violence, Singhal assured that appropriate measures were being taken. Meanwhile, the opposition has slammed the state government, calling the Nagpur violence a disaster waiting to happen. Over the past few days, extreme right-wing groups have threatened to raise Aurangzeb's tomb with multiple rallies across Maharashtra's Marathwada region, advocating its demolition. Leaders like Nitesh Rane have also invoked the Babri Masjid demolition in their speeches. The opposition alleges that despite these warnings, the state government failed to act. The violence erupted as the Maharashtra Assembly's budget session unfolded. The Chhawa and Aurangzeb controversies dominated the session's first half, and now the Nagpur riots have reignited the debate.
Regulator has been engaging, especially with the larger, older insurance companies.
Welcome back. Let's welcome Deepan Mehta of Elixir Equities on the show right now. 102 points is what the GIFT Nifty is indicating as an implied move. Deepan, yesterday we got the news from the DGTR where there are some safeguard duties coming in on flat steel products. Now, whether that does a lot or not is still, out in the open. Analysts expect about 10% increase in EBITDA, etc. But from the decline that we've seen from the highs in the metal prices and the anticipated up move ahead of this news, do you think, the worst is behind for metals and we start looking at this sector?
Yeah, good morning, Mangala man. Thank you for having me on your show. I'm sure it'll give a nice bounce to steel stocks. But end of the day, I think, do you want to invest in an industry which requires government help for protection? So that's the question which I'm not able to answer correctly. And, it's a very cyclical industry, a lot of volatility in earnings as well. And when markets are recovering the way they are, and with so many new choices coming up, I think it's better to go for other sectors, maybe other investment themes, rather than steel stocks. But there's no denying that they could be in for a nice trading bounce. Valuations are attractive and improved capacity utilization and volumes also could drive earnings. And then the base effect benefit also may come into play. So you could have a good run for steel stocks. But as a new investor in this sector, I'm not sure it's a good idea.
As a new investor, not a great idea. We're not sure whether it's a great idea. Deepan, stocks are seeing some repair and recovery. And that's good to see, right? You've been gasping for breath and suddenly there's some air in the room. We all are. What's your sense, Deepan? I've been saying for at least a week, price-wise, bottom seems to be in. And momentum, how long it'll last, whether it's fleeting, etc., we'll see. But what is your own perspective and where is interest activity likely to be if we've seen the lows already from here?
Yeah, Prashant, good morning. First of all, for us to completely conclude and have the comfort that we have a strong bottom in place, you need to see a trend reversal. We are seeing lower lows and lower highs. We need to see higher highs and higher lows. So once that pattern gets established, then you can be sure that, okay, now the worst is over and gradually the markets will build on the gains and we have a foundation in place. So that's one important pattern that you need to look out for. Secondly, I think that it has to be India growth stocks. And it could be the same stocks which did well in the last phase of the bull market, which started from October 23 to September 24. But broadly, it has to be India-focused companies and maybe beaten down sectors, which is why I came to cement, to an extent retail and banks, NBFCs, because I feel that there's some value over there and growth rates will pick up, base effect will benefit them, and RBI cutting interest rates, government budget benefits of a rebate, all of these will definitely improve consumption. So the investment themes will be again India-focused companies. But as I said, I think for us to be completely sure, we need to have a reversal of the pattern which we saw in this last 5-6 months or so.
Okay. Dipan, in terms of stock action, yesterday the momentum was back in such a big way. Everybody's lapping up PSU stocks again, defense stocks again. Even the railway names were tracking big gains yesterday. Now, that could just be because they've been beaten down, right? I mean, 3-4 months of absolute thrashing. But what would your advice be? Should one be looking at areas like railway or defense at all?
Good morning, Surabhi. I think this is the effect of a risk-on trade from domestic investors. And these companies have created huge wealth. They've been multi-baggers past 4 or 5 years until about 6-7 months ago or so. There's been a steep correction. But if you notice over the last 2-3 years also, fundamentals have only improved. And they're sitting on decent order book position. There's good order visibility. And whatever government policies, encouragement is there, that continues. So I think that investors want stability in earnings and they're buying these companies. And I completely agree with that strategy. Quite positive on defense companies, on PSU, capital goods companies, on railway companies as well. You can pick and choose, but I think companies like HAL, Bharat Electronics, Bharat Dynamics, I think they are the best placed in terms of size, in terms of business model, and in terms of the kind of potential which they have in the domestic and the export market.
I take your point entirely. You know, partly it could be risk on, partly it could be NAV propping because these stocks have seen a big decline from the highs. Partly could be the effect of the last 15 days of the financial year as well, where companies try and close their order books. So a bunch happening out there. We'll keep an eye out on this. But we started our conversation with the metal space, right? So let's get an important voice coming in from there itself. Vedanta's Anil Agarwal promises to reduce debt by about $3.5 billion by 2027. In an exclusive conversation with CNBC-TV18 Shireen Ban, he says that prices of aluminum and zinc are seeing premiums like never before. Let's hear out the excerpts of that conversation.
What about the global environment today, Mr. Agarwal, and how that's likely to impact commodity markets, specifically things like aluminum and steel? We have, of course, seen an escalation as far as the tariff war is concerned. President Trump imposing tariffs, other countries retaliating with reciprocal tariffs. What does all of this mean now for commodity markets? How are you reading the developments?
We are watching, but we have a less impact because we are domestic player. Our Indian consumption is so high. In any case, aluminum, US need. Aluminum does not produce basic aluminum. So they purchase a lot of aluminum alloy. And we are developing those alloys, and those alloys will be very important for them. So we are definitely watching. It is impacting to everybody. But as far as Vedanta is concerned, whether it's oil and gas, whether it's a zinc, whether it's a copper, whether it's a aluminum, we are worried about as an overall what will happen, but Vedanta will be less impacted.
Less impacted, you believe. We've also seen the DGTR, sir, recommend the imposition of a safeguard duty to the tune of 12.5%. That, of course, has to be ratified by the Finance Ministry. So there is still a wait and watch there. But what do you make of that? And do you believe that this is warranted at this point in time? And is this enough?
I think this is enough. Government is working very, very hard to make sure industry run well, and those days has gone where government used to take long time to take decision. Now government is absolutely there, and to make sure the government, the business, because we are heading towards $5 trillion economy, and we cannot take any chance to reduce the production, slow down the production. It is very, very important for us.
Yes, that certainly is the case. I also want to understand from you, as far as prices are concerned, if you can give us a forecast or an assessment or an estimate of where you believe prices are going to be across the board for each of these commodities that we just spoke of, whether it's aluminum, copper or zinc.
I mean, there is a short supply, huge demand. The warehouses are empty, and everybody is looking at. We have never seen premium on the aluminum what we see today. Highest premium in the zinc is the highest premium. Or gas. Can you believe that gas in India you can sell at $10? And same thing on the oil. So it is a time. It shows that how much is the consumption is increasing in India of this metal. So prices.
That's a big.
Yeah, go ahead.
That's a big statement, Mr. Agarwal. You're saying you've never seen the kind of premiums that you're seeing, whether it's aluminum, zinc, or gas.
Absolutely. And this shows the growth in India, the consumption pattern in India. Of course, it has American, what they are doing on the duty, it also has impact. But the consumption in India of this metal are growing like anything, 10, all double digit.
All double-digit growth is what you anticipate. Let's talk about debt as well, Mr. Agarwal, and your plans as far as deleveraging at the parent level was concerned. You've been able to deleverage to the tune of about $1 billion. The average cost of debt is about 11% versus over 13% at the start of the year. If you can lay out for us what the debt reduction plan is from here on.
I think we are the lowest debt in terms of our peer group is concerned. You know, that total debt, if you look at, we are the parents about $4.5 billion, down the line about another $4 billion. So about $8 billion. Against this year, we are going to have close to $6 billion EBITDA. And in another 15 days, we'll be declaring that it's hardly any debt if you compare anything. But we have a full plan that we will be completely reducing our debt on the parent company in 3 to 4 years' time.
If you can add a little bit more clarity on that debt reduction plan at the parent level over the next 2 to 3 years, you believe that you're very comfortably placed today, but if you can draw out the roadmap for us with a little bit more detail.
So in this year, 25, we are going to reduce $1 billion debt. 26, we are going to reduce another $1 billion debt. And 27, we are going to reduce $1.5 billion debt.
All right, so $3.5 billion over the next 3 years, as clearly pointed out by Anil Agarwal, also saying that demand for metals is extremely high, including that for gas, etc. as well. Last 1 month, the stock has done well. The next trigger, obviously, is the demerger, and the kind of value that it creates for shareholders is something that we'll most definitely keep an eye out on. But we're still with Dipan. Dipan, you started on by saying that, steel offers an attractive trading opportunity. But from a Vedanta standpoint, where do you see, value being generated? The management has been speaking about debt reduction. There is that demerger that will take place as well, which they've been speaking about as a big value accretive measure. Would you buy into that?
Yeah, Mangam, I think so. And there's a good, value unlocking opportunity, or call it an arbitrage opportunity. So if Vedanta's current market capitalization is 1,80,000 crores or thereabout, when they split the company and all the companies have identical shareholding pattern, that could be a value unlocking scheme. And you could easily have a 10-15% type of appreciation of the combined entities when they get listed separately, as compared to the consolidated entity which is listed just now. So yes, I think there is a good trading opportunity. There's a good arbitrage opportunity in Vedanta also. And by the way, it was an excellent interview. And I think a lot of facts came out very clearly. So with the management sounding so positive, you could certainly consider this stock.
All right, 460 as far as the price is concerned. And yes, I mean, especially on aluminum, which is the prime driver for Vedanta. Mr. Agarwal actually sounding very, very confident. Let's take a quick commercial break here. We're going to be joined by Sudarshan Sukhani, Mitesh Thakkar, so some technical trading ideas coming up in just a bit.
To them about the possibility of listing, to put a glide path and timelines towards that. This is something that has been taken up by both our boards as well. And as a result of that, the board at a suitable time will consider the nudge, as you said, from the regulator. I think FY27 is early. The board and the management has been fully involved. Well, the board and Allianz as FinServ as a shareholder has been fully involved in the current transaction, and the management will now roll out the necessary changes. So for us, the next year or two is going to be busy with this. I believe at a suitable time, the board will seriously evaluate IPO as a possible option for both the companies.
Welcome back. We've got the pre-open, which is going to come up soon at about 9 minutes or so, and 116 points higher on the GIFT Nifty. So the gains continue, and we're building on nicely, and the market gains are broadening out as well, which is, I think, also an important thing. Mitesh is with us with his trades and what he'd like you to do. Mitesh, good morning. Welcome to the program. What's the sense, Mitesh? 22,900 or so is where we left off. What's the next stop, and where are supports, etc., going to be?
Morning, Prashant. So, last few days, once we started getting past 22,600, 650 zones, we have talked about targets of 22,800, which was met very easily. Then 23,150, I think we are heading towards that. And logically, I think the way this reversal is shaping out, I think good chance that we'll even make an attempt towards 23,500, 600 zones. So my eventual target is that. But in between, there's a pivot at 23,150, 160, 170 zones. So I think around those levels, tactically, you might want to take some profits once we reach over there. But till then, I think stay long. Use any declines in the last 3 days have been very good for the markets. But in case you get an intraday decline, I think buy into it. For the Nifty, the preferred buying zone is around 22,750, 700 levels. For the Bank Nifty, the corresponding zone is around 49,200 to about 300 to about 200 zones. And for the Bank Nifty also, I'm looking at 50,400, 500 as the target area. So both the indices are suggesting that there should be more upsides in coming days, even if you get an intraday decline. So therefore, I think I would maintain clearly a long bias.
All right, a long bias. What individual stocks would you be backing if the bias continues to remain long?
Good morning. I have all buy calls. Yesterday, I think there was some breakout in the Nifty reality chart, so I've got two of them. In fact, Godrej Properties was a buy yesterday as well as a BTST call, but now can be bought as a trading position. Keep a stop at 2074 for targets of 2185. And DLF also had a good short-term reversal kind of a pattern on the chart. So buy here with a stop at 688 for targets in the range of 720 to about 725. That apart, a buy on Bank of India with a stop at 100 for a target of 109.5, which is close to its 200 average. And Apollo Hospitals is a conditional buy. It's close around 64.20 mark. I would want to see the stock take a minor pivot, which is around 64.45. So buy above that. Keep a stop at 63.90 and 65.80, 6600 should be your target.
Okay, all right, got it. Mitesh, thanks very much for those trading ideas. Let's welcome in Sudarshan as well and get his sense on today's market action. Sudarshan, morning. It's been a big, sort of green up move. What about the indices? What's the trade you're taking, Nifty or Bank Nifty?
Yeah, good morning. In fact, I was away for 3 days taking my 7-year-old grandson to Dubai, and that was a very wise idea. The markets behaved very well in the meantime. That's going to continue. See, what happened is this. We went into a deep correction. After that correction, for almost a month, the market went sideways. That's exactly how a base is built. From that sideways move, the market has broken out on the upside. We are seeing probably the first leg of this up move. At some point, we will pause. At some point, we will see another sideways move or a minor correction. But the intermediate trend has also turned up. So what will happen in the future is a different matter. But currently, there is only one trade. Every dip is a buying opportunity. And not only that, when the market goes sideways, we will see stocks doing rotation. So on the stock side also, focus on the buys. But for the Nifty, clearly, if you get a...
Oh, I think...
Right.
Oh, sorry. Sudarshan, we just lost your feed, but I think we have you back. Also, tell us about the individual stock trades then that you'll recommend today.
All right. Zolto is a buy with a stop under 219. Zolto is coming after a long time in my list. Syngene is a buy, although IT stocks have not done well. Perhaps the time is changing. Consider buying with a stop under 691. SBI Life is a buying opportunity with a stop under 1450. And finally, Concor is a buy with a stop under 670. I'm repeating again, focus on the buys. Don't go for anything short.
Okay, all right. We'll take a quick commercial break here. We'll come back. Sudarshan, thank you very much, and I hope you had a good trip. Looks like you did. Dubai it was, right? You said. Thank you. And of course, Mitesh, appreciate you joining us as well. We'll speak with both of you in about 10 minutes time and take stock once again. The pre-open session is going to be starting in about 4 minutes or so. We're going to come back with Kumar Rakesh of BNP Paribas to discuss key trends in the IT space. I mean, the sector was, a meaningful loser. It was down 2% at one point, ended about 1% lower. The index itself and most names under pressure. What's the road ahead? Kumar Rakesh tells us.
Welcome back. 15 minutes to go before we start getting our rates. Let's get back to Deepan with a couple of thoughts and ideas. Deepan, I want to talk to you about the best performing stocks on the Nifty so far this year, 2025. And it's the Bajaj twins, both finance and FinServ, right? There's so much of news flow happening, plus there's overall interest, and the consensus buy call in the market right now seems to be blue chip financials. What is your take on both the group companies and, of course, this latest buyout of Allianz?
So we first a disclosure that Bajaj Finance is our core holding, top holding, in fact. And for 5 years, patiently, we have been waiting and the stock has really gone nowhere. The Nifty and all the other small mid-cap stocks have been multi-baggers, but Bajaj Finance has been flat, almost flat. And now it has shown amazing strength. I think when the Nifty was down 13-14%, Bajaj Finance was up 15% or so. And I think that in the next leg of the bull market, Bajaj Finance could clearly be the absolute sector leader, and even amongst the Nifty stocks, the Nifty leader. So very positive on Bajaj Finance. I think a lot of concerns are getting gradually addressed. There was this threat from Jio, but that is no longer as severe as we thought earlier. And the NPAs and the collection efficiencies have all gone up. And the advantage of being multi-product certainly benefits Bajaj Finance, and its size is also quite important. So very, very, very positive on Bajaj Finance, and may not be a multi-bagger from these levels, but certainly could outperform the benchmark indices.
Deepan, another pack which did very well. I'm not sure if there was no news flow per se. Mazga, the shipbuilders, Mazga was up 10, Garden Reach, Cochin, all double-digit gains yesterday. Always moves like a pack. And of course, the other defense, the HAL, the world, did not really move. Any interest here and any picks?
Yeah, I think these are also all great companies, and all these shipbuilders have many, many years of earning visibility because of the kind of order book position they are sitting on, anywhere from 5 years to 10, 12 years or so. So very positive on the sector as a whole. And I think there is some incentive given for shipbuilding in some of the tweaks they have done to the Bharat Mala policy by the government. So there is some positive news flow. Just need to analyze it a little better and see the impact. But nonetheless, I think there's a huge export market for these shipbuilders. There's also the repairs and maintenance component or the division that has also got good potential for growth. And all the valuations are on the fair side. I would still see that these stocks can at least perform in line with the Sensex Nifty. And as a shareholder, I would like to remain invested.
Okay, now this is a slightly off-tangent question, Deepan. Out of the completely bombed out names, anything just because of price damage, sheer price damage, do you feel chance le lete hain? Any names there in that chance le lete list? Yesterday, for example, you had Idea Forge, Fusion Microfinance.
The one stock, Prashant, which I'm thinking of day in and day out, and I'm resisting from buying as a matter of disclosure, is IndusInd Bank. And I rarely average, but I'm really considering over here. I'm very tempted. But then when I look what happened to RBL and Yes Bank, I'm just like holding myself back. But I don't think IndusInd Bank is in that category at all. But it's completely bombed out. It's extremely attractive. It's a great bank. And now entire banking sector also is looking up per se. And I think that this stock has been a bit too much beaten down. Whatever the damage was, it's a one-quarter phenomenon. I mean, they'll write it off in 1 quarter itself. But beyond that, I think, you could see improvements in earnings. The only thing which bothers me is the confidence of the management to, again, grow the loan book. Because what I have seen is that after you have so much of stress and so much of negative surprises, the management becomes very conservative and they don't go ahead and lend, and suddenly the market shares start to come down when it comes on the lending side. So that's one concern. But it's one bombed out stock that investors can consider. And if you have a kind of a strategy to go for such stocks, then why not have a look at it?
That's an interesting one that's coming.
Deepan reminds me of that line from the very famous OTT series, risk hai to isk hai. But he's still thinking about it, and that's a caveat that he's put out
The
there.
caveat is that risk hai. So we'll just keep an eye out on that one. From one beaten down sector to another beaten down sector. Let's speak about the IT pack. Is there an exciting entry point here, or is there not? Is it still uncertain out here? Let's get in Kumar Rakesh, who's the India analyst, auto and IT at BNP Paribas. After a big decline that we've seen in the IT pack, there were brokerages which still believe that, the decline is largely earnings-led and it is not multiple-led. And at times where it is multiple-led, it is justified as well. Where do you stand on that? And do you think after this crack that we've seen in the IT stocks, there is an attractive entry opportunity? If yes, then where?
Hi, good morning, and thank you for having me on the show again. So last week we were in Hong Kong, Singapore meeting investors, and we could see this very high level of bearishness that has gone into investors' expectation for the sector. Till last year, when we were meeting investors, till late last year, early this year as well, the only pushback that we used to get on our positive stance on IT was around valuation, although almost generally everybody had started accepting that the recovery is underway and we should start seeing better growth in the next financial year. And valuation was the only holding point. Now, while the valuation has sharply corrected, we noticed that investors now have started expecting next year growth to be similar or possibly much weaker than what the companies would report in FY25. Now, where to look from the entry point to your question, we think between now and April, we'll see more of consensus earnings cut, a little bit of more moderation in terms of what the next year growth will likely look. Companies will come out with their guidance in April month, and we think that they will set expectations also quite modestly and give guidance which could be conservative. And that we think should set the bottom in terms of expectation from the sector going into next financial year. And having already seen the valuation correction, we think by April, we will start seeing some attractive entry point to start looking at the sector favorably.
Okay, that's interesting, Kumar. Hi, morning. You're saying that maybe April onwards, there could be entry opportunities. I mean, I'm just throwing Citi's argument at you because yesterday that report was doing the rounds and they are of the opinion that at least for the large cap, let's talk large cap, let's leave out mid cap for the time being. Large cap IT growth rates now with the new reality in the US may still be about 4-5%, nothing more than that in the new fiscal. And then their argument was that valuations are perhaps therefore still expensive and still above long-term averages. Your thoughts on large cap IT?
Hi, Survey. So I think that is a very fair question if you look at from pre-COVID period when the growth used to be mid-single digit, about 5 to 7% for the sector. And the sector used to trade at multiples below 20 times. And hence, if that is the new reality that we are thinking that the sector is likely to continue to see these tepid growth levels, these valuations may start looking expensive. But our view is that demand outlook has dramatically changed post-COVID. Of course, there are macroeconomic headwinds, and that is what we are dealing with right now. But as we start coming out of this, we should start seeing growth, which is much better than what the numbers which we are talking about here. You just look at the YOY growth on a quarterly basis, not on the full year basis. Many of the companies in the Indian ITs, among the large caps as well, start moving towards the high single digit by third quarter or by fourth quarter of financial year. So if this incremental slowdown in the macroeconomy, which we are talking about, wouldn't have happened, we were already on the trajectory towards a high single-digit sort of a revenue growth. And the demand tailwind from GenAI and the broader economic recovery in terms of multiple verticals starting to push growth hadn't already started playing out. So we still see that there is a path for a high single-digit, close to double-digit revenue growth for the sector. And if that is the case, we think looking beyond FY26, these valuations may still be justified.
This high single-digit, almost touching double-digit full-year growth. By which year do you see this happening?
From FY27 onwards. So if you look at last couple of quarters, most of the growth was driven by BFSI vertical, where we had seen a broad-based recovery to start playing out. In December quarter, we started finally seeing recovery to start coming into CPG retail and energy and utility vertical. But there's long tail of other verticals which were yet to start pushing growth for the sector. And that happens when the entire economy fully recovers. The signs of that we started seeing in the month of January. US manufacturing PMI, which was below 50 levels for the last 2 years, had started reporting numbers above 50, getting into expansionary phase. Manufacturing is one of the vertical which was still declining for the sector. And hence, from the broader recovery perspective, we had started seeing signs to come through by January. Of course, since then, things have moderated, and we'll have to moderate our expectation in the near term. But we shouldn't dramatically change the view from a long-term perspective.
What are the risks to your call here? Because, you know, the macro data emanating from the US does point towards growth slowdown out there. So does the commentary coming in from a lot of the verticals out there which, are big clients of the Indian IT services companies itself. You say that there are concerns of a demand slowdown, but it's not a sign of weakness, it's a sign of caution. When does that caution turn into weakness? What are the risks here?
Right. So the base case with which we are working with is the impact on the macroeconomy related to tariff and counter tariffs and related uncertainties is a transitory effect, possibly lasting a couple of quarters. And if that base case changes and we start seeing the impact of that to be more long lasting, that is the main major risk that we are working with. Last night, commentary from Fed was reassuring in that way. Even they see the impact of tariff to be transitory. While they are raising their expectation on inflation, they are not taking steps to act on it as yet because they think these impacts are more transitory and should stabilize from as we move a few quarters from here. And that is the base case with which we are also working with in our estimates. But yeah, that is something we definitely need to keep watching out. If these things do not start settling down in a quarter or two, then possibly we'll have to take a longer look as well. How is this a new normal?
Finally, Kumar, on mid-cap IT, what are you liking? There are companies like Coforge that have just defied gravity, defied all odds, and they've just been, blazing ahead. There is the automotive space, names like KPIT, etc., which have been struggling last couple of quarters. Where do you see maximum growth in mid-cap IT?
So speaking with investors, at least the foreign institutional investors, they're not too keen to get back to mid-cap IT. I think they have to need the broader market momentum to start picking up. And that's when the attractiveness of the mid-cap IT starts coming back in. But if that happens, our top pick in that space is Persistent Systems, which has been delivering pretty solid growth despite the macroeconomic concerns. And as the demand recovers, and the GenAI demand starts picking up for them, we would expect that growth to start picking up. Looking at PEG ratio, it still looks quite attractive. From a long-term perspective, we think that is one of the stocks should be part of the portfolio. I happen to cover automotive as well, as you know, and in that space, we'll have to watch out how much of electrification acceleration is still needed from global automotive companies. Some of the European Commission and governments are looking at slowing down the electrification journey, and if that happens, that creates a headwind in terms of the demand for some of the automotive ER&D companies.
Absolutely. So we'll have to keep an eye, but and of course, lots of news flow. US, of course, still the prime driver as far as Indian IT is concerned. So remains on tender hooks for now, news related. But thank you very much, Kumar, for joining us this morning with that perspective. Appreciate it. Well, let's bring in Sudarshan and Mitesh with their 9-10 call. Sudarshan, what do you have?
Well, SBI Life. Consider buying SBI Life with a stop under 1450.
Okay. Stop under 1450. The stock's about 1490 right now. Mitesh, what about you?
Bank of India for targets of 109.
Okay, Bank of India on the long side, both longs, and that's the texture of the market as well. Gentlemen, thanks very much once again. Let's talk about city gas distribution companies, and Axis Capital has got a note out. Sudarshan is here with details on this one. So over to you.
So Axis Cap has come out with a note on city gas company. It's positive on IGL and MGL while it remains negative on Gujarat Gas. It has mentioned few catalysts. First one is aggressive expansion in network infrastructure, favorable CNG economies versus petrol and diesel, and addressable market has increased to total PV volume of the industry and supportive government policies. Amongst all the three companies, it prefers basically companies having the highest CNG exposure. So it has initiated coverage on MGL with a buy call and target is 1580. It has upgraded IGL to buy and target is 224, and it initiates coverage with a reduced call on Gujarat Gas and target is 390.
All right, take that point, Sudarshan. Thanks a lot for that. Meanwhile, we'll keep an eye out on market opening itself. Meanwhile, just watch out for Z. I'm looking at that one. We have, a CLSA note that has come by, which is suggesting that the stock could double from current levels, largely because of the big decline that it's seen, almost 55-56% decline ever since the fallout of the merger with Sony. Valuation's attractive. We've seen the promoters buy some stake in the company as well. Can things turn around for Z is something that, brokerages are betting on from lows.
Yeah. Do you know who's written it? Is it still Who's the analyst?
I don't think it is the same analyst as it was
I think
earlier,
Dipali
one of them. We'll just try and get some details on
we'll
that.
try and have the analyst on as well. And but that's an interesting one. We were talking about bombed out names, right, with Deepan earlier. Well, this is certainly a completely bombed out name as well. So more details on the note as well in terms of exactly what they're saying with Mangalam in just a bit from now. We've got market open a few seconds from now. So 130 points on the Nifty. You've got decent gains on the Sensex. And there's a 0.5% higher open once again. 23,000 plus on the Nifty and 49,700 on the Nifty Bank. The small cap index is up about 0.8%. And 10:1, not 10:1, beg your pardon. It's 6:1 advances to decline, at least right out of the gates in terms of the market open. We'll have to give it some more time for things to settle. But this is a good-looking screen, good open in that sense. Absolutely. 100 on the Nifty and about 300, about almost 400 points on the Sensex is what we have. And I think the broader markets are doing just fine once again. Nifty heat map, if we have it, maybe just gives you a quick sense. I think it'll be all green, mostly all green. Maybe 10, 11 names in the red. Everything else is starting strong. Rupee.
Absolutely. This is a good opening. And off late, the implied open has been spot on in terms of predicting the actual opening as well. Indeed, it's 100 points up and 23,000 is on the screens for the Nifty. IT stocks finally are managing to recover after the drubbing they've received earlier this week. Wipro, Infosys, we were just discussing these names with the analyst at BNP. So there's some buying that's coming back. TCS is also about 0.7% higher. So that's a solid move for the market. And you have banks and financials. So both the twin turbo engines are charging ahead for the bulls. Banks and IT. IT I've mentioned. Let's look at banks. Indices is seeing some takers, 1% up this morning. There's ICICI Bank, there's State Bank of India. These are stocks on the higher side. SBI Life from the broader financial universe looking good. HDFC Bank itself is up about 0.5%. Kotak is higher. Axis is also higher. So banks looking quite good. Reliance is contributing, not too much, just about 4 rupees, thereabouts, 4-5 rupees on Reliance. But for what it's worth, it's in positive territory for the time being. Aside of IT, banks and Reliance, M&M, BEL, these are the other gainers. Adani Enterprises seeing some early gains as well. The only part of the market that's a little soft, JSW Steel, some of the metal counters are losing their sheen after yesterday's big moves. L&T is quiet, 0.5% lower. And there's a little bit of red on some of the pharma names like Sun Pharma, Reddy's and Pharma close to the flat line. But otherwise, it's a solid start, 100 points higher.
100 points higher on the Nifty, and it's the IT pack which is leading it. The broader markets have been interesting moves, big moves as well. Z, for instance, we just discussed that pre-open, about 30-40 seconds ago. CLSA is bullish on the stock. It's opened about 4% higher. We've seen some traction in mid-cap IT as well. Emphasis, Birlasoft, Intellect, Design Arena, all of them up anywhere between 2 to 3%. But on the way down, I'm looking at all these cables and wires stocks. Yesterday we got an exchange notification from the Adanis that they've incorporated a joint venture for their cables and wire foray. The foray itself was known already, but the action that, they've gone ahead and incorporated a joint venture has the street worried because, again, this is, coming after Ultratech has made their announcement in this space as well. So we have KEI Industries down about 7%, Polycab down about 6%, Havells down about 5%, RR Kabel down about 2%. All these companies have said that for any conglomerate to come in and establish some certain market share out there which could impact the industry is still about 2 to 3 years away, but we are seeing some decline out there. Voltas, healthy analysts meet. Maybe the street does not like the fact that the company is preferring growth and market share over margins, or perhaps it could just be routine profit taking after a 16% up move that we've seen on the stock itself. Jubilant Foodworks down about 2%. Remember, the Turkish lira has depreciated a fair bit, and they had, some exposure to that via their DP Eurasia JV. So maybe a bit of concern out there after the recent outperformance that we've seen. But no such problems for the stocks that have been doing well. Garden Reach Shipbuilders, another day, another big up move, and they've gotten a memorandum of understanding with the Nagaland PWD for a supply of 8 sets of double-lane modular steel bridges. So orders coming in thick and fast. Also orders coming in for Paras Defense. That stock's opened about 8% higher at the open itself. 140 crore order, if I remember correctly, announced just before market open today. That stock up 8%. So big moves on both sides. Mid-caps outperforming And as things have settled 4 minutes, 5 minutes into trade, we have 2,000 stocks which are advancing for about 200 which are declining. But the ones which are declining are seeing massive cuts.
Absolutely. And, it's a good looking screen, 120 points. So despite that, the pressure from, remember earlier it was the Aditya Birla Group with their planned foray into this segment, the wires and cable segment. And that day, of course, stocks fell 8, 9, 10, 12%. And now it's another one. All the biggest volume-led gainers are all these wires and cable companies, as Mangalam pointed out. Mangalam was pointing out right before open, Z started 5% higher and it's got the second highest volumes on the NSE. So about 105 rupees. And we'll have details of what CLSA is saying on Z in just a bit from now as well. That's it. Otherwise, on the upside as well, volume-wise, it's a kind of slow start. But like yesterday, hopefully it broadens out. Eris is up. Eris Life Science is up 11%. And it's got some volumes as well. So that's why I'm making a quick mention of it. That's it. Otherwise, it's a decent kind of start. The number one volume-led gainer is Garden Reach with a 3% gain at this stage.
Actually, that yesterday, PSU move from yesterday, that's kind of continuing this morning as well. So you have some of the shipbuilders, have some of the railway stocks, some of the financial names, so Ircon, etc., IRFC. These stocks are still up and about. So the PSU move is also on. But I think Mangalam spotted the most interesting trend of the morning, which is wires and cables. And I remember what these companies said even after the Ultratech entry. They maintained a very brave face, saying that this will take some time, it won't be disruptive, etc. There was some recovery in the stocks. But the fact is, there have been two huge, big, deep-pocketed players coming in. Perhaps you can't entirely write off the competitive intensity that could maybe unleash ahead. So, yeah, all of them down 4-5%.
We'll keep a track of them. Vineet Sambre is with us, Head of Equities at DSP Mutual Fund. Vineet, good morning. Great to have you with us here. Prashant, this side. Now, let's just actually, why don't we, we'll get to the markets in just a bit, but there's, once again, effective competition. Actually, more sectors, right? Competitive intensity is super high, actually increasing. Wherever there are lucrative margins, decent profit pools, there are entries, newer players coming in. We were talking to in the AC space, we had Blue Star yesterday, and we were asking them 65 companies in that space. But just your thoughts on this wires and cable segment, and I'm sure you have exposure. Yeah. Broadly, what do you make of it as an investor?
So, Prashant, first of all, let me agree that incrementally, most sectors, we are seeing a lot of disruptions, just not the competition, but also technology disruption, which is taking place. And, a lot of it is actually leading us to sort of go back to, our financial modeling and just see whether, some of this is still making a case. Are the companies losing their core moats? So I think the investment climate overall is becoming very, very challenging, and we have to be sort of very alert in terms of how the companies are keeping up with their competitive moats actually. So that is one very important aspect. Especially on the wires and cables, let me say that I was trying to look for the history when a similar thing happened in case of paints business as such. And when we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment. And only after 1 or 2 years, it really struck that, it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks, I think, corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large. Today also, when we think about the power sector investment requirement, not only in India, but globally, I think it's going to be huge. And from that perspective, some of these companies would still continue to see maybe decent growth. And the new entrants will also have maybe 4-5-7% of the overall market by FY30. But important point is that the stock reaction has already happened this time because the playbook was available. Investors got worried very soon, and 20-25-30% reaction has happened. Maybe some more reaction and the stock starts looking attractive from valuation perspective. I would believe that the growth challenge is not going to be there for these companies, and hence at some valuation, it would make sense to sort of look at some of these companies as such.
That's an interesting one. Some correction has already happened, a little more, and then it becomes attractive. Vineet, always good to speak to you. You know, there was an interesting analysis that came from your house, which was when the mid-cap index was down almost 23-24% from the highs. The analysis was that about 8% decline was due to earnings degrowth and 15 to 17% was due to derating. Now that we've seen a recovery from the lows of almost 5 to 6%, how much do you attribute to improving earnings prospects and how much do you attribute to, valuations resetting?
So, Mangalam, this is all very short term and driven by sentiments rather than any big earning change. I think for me, if you ask me, I still consider that March quarter will be, again, looking like downgrades of earnings from where we were. And this is coming from, the commentaries we are listening from the management. It's bit cautious, and I think you guys are also talking to the management. There's no real recovery which is broadly seen across different segments, and hence I would imagine that we are still under some risk of earnings downgrades, maybe 1 or 2 quarters more. But good part here, Mangalam, is that we have seen 4 or 5 quarters of sequential earnings decline. We already have seen a low base creation, and in some form or fashion, the macros eventually should sort of turn as we see that monetary fiscal, some bit of that space is easing out with the stance taken by RBI. So and the hope is that consumption should start seeing revival maybe towards the end of this year. So I would say that things can turn around from here. Maybe 1 or 2 quarters of pain. Markets will slightly be ahead of that, and hence today we are seeing these corrections and then bounce backs. But I think there are from the corporate side, some more pressure points still may be there in the quarters to come, 1 or 2 quarters.
Vineet, hi. Good morning. Good to be speaking with you on the show today. So since you're saying that consumption is likely to bounce back, let's talk about how you'd play it. And there's been enough debate around it, right? The top-end premium level consumption, but then we got into the narrative of the urban consumption slowdown. After the budget, the narrative changed to that now that there is, people have 1 lakh rupees extra to spend, they'll go to QSRs, etc. So you tell us, what are you convinced about in consumption?
So I think, Surbhi, you're right. It is very unclear and the wallet shares are changing. People are also now traveling a lot. They're spending a lot on hotels. We don't know where exactly the spends are going to take place. But the way to think is that we go back in history and see that. So first of all, we have benefits of taxation. The welfare schemes are maybe giving some more benefits to the people. Inflation coming down is good for the rural folks because they were affected post-COVID. And I think towards the end of this year, we'll start talking of the 8th pay commission benefit, which last time around, it did help auto sector in a big way. So, instead of really focusing on where exactly we'll see the benefits, I would say that we'll have to create basket of consumer discretionary stocks as such, because we believe that these are durable. The tax benefit is a durable benefit, and people may want to build these kind of assets where on the discretionary side it can be auto. People may like to spend on hotels, QSRs, and all of those. So we have exposures out there, and we are actually incrementally looking at this space. Maybe retail at certain valuations could become attractive. Right now they are all going through a bit of a slowdown. And what Prashant mentioned, I think one thing which we'll have to keep worrying about is the competitive dynamics across the space, which has become a very important factor to think before we buy with a long-term view.
Sure. So you mentioned that in this basket of discretionary consumption, you'll probably put autos, maybe hotels, maybe retail at some point. Where does that leave quick commerce and the platform companies? Because the problem is their sales numbers were fine, even the profitability looked okay, but now they're reinvesting in the business, they're opening all these new dark stores, and the market got a little worried. Where are you on that space?
So there, actually, we are still seeing the competition is heating up, and that may not still mean that these companies will see light at the end of tunnel soon in terms of the profitability, and which is where we have taken a sort of a pause out there in terms of going aggressively on those names. But we are watching that space. We know that, as I spoke about the wallet share, I think they are catering to a big need which is there. Just that needs to get converted into pricing power, and that should eventually deliver profitability. If that path becomes clearer, I think it would make a good case for investment.
It's interesting, some of the names that you hold in some of your funds, you do have small ticket discretionary items from the consumption space like Safari, you have Thangamile, LT Foods. Interesting, updates coming in from the retail and textile world as well. Vineet, the question I'm curious to know the answer for is, in this decline that happened, did you top up on already existing names, or did you buy something else as well, which was always on your wish list, but because it had run ahead, you couldn't buy it, and now the valuations seemed attractive? If you could give us a sense of what you did.
So a large part actually went into our own existing stocks, because there we already have our own understanding of businesses, and we slightly increased the exposure. And we also took this opportunity to maybe cut exposures in names where we felt that the overall outlook for them would be slightly more elongated in terms of recovery. And new names we keep watching. So as a proportion, I can say that maybe higher allocation to the existing names versus the new names. And new names also are finding their way into the portfolios as well.
What would the nature of those companies look like, the new names?
Yeah, so I think it is to do with where the businesses have seen low cycles. So specialty chemical as a pack is one area. Auto ancillary, I spoke about the auto, but auto ancillary seems to be a better way to play all of these. Some consumer names we are watching. So I think in and around these segments, the names would sort of lie.
All right, Vineet, thank you so much for joining in and giving us your views on the market and talking us through the sectors and stocks that are not specifically stocks, but ideas that you like after this correction itself. But one of the sectors on our radar is the capital markets theme itself. CAMS as a company is on our radar. It signed an agreement with LIC to provide insurance repository services. To discuss this and more, we do have Anuj Kumar, who's the managing director at the company, who joins us now. Basics first, Anuj, thank you so much for joining in. What does this do to your incremental revenue, additional users, market share that comes in, this tie-up that you've done with LIC?
Hey, good morning. Hi, and thanks for having me on the show. So broadly, you will know that the insurance repository has been in existence for over a decade, but hasn't got the impetus and the push that you would expect. So therefore, LIC joining up, I think, is directionally a great thing for the industry, because a large market leader with that kind of market share had stayed away from this architecture. What this does is that we have now close to 80 lakh plus EIA accounts. All those account holders, practically everyone will have an LIC policy. They will be able to bring this into the realm of servicing through that. LIC over a period of time within 2025 will move some of their new issuance. They may not get the legacy policies yet, but the new issuance will start moving into this architecture. So you can have your LIC policies, both new and old ones, as you like, in the insurance account. On top of this, you would be aware that we have Bima Central, which is the unique unified servicing platform, where you can manage your entire portfolio at one go, including transactions over a period of time, lien marking, borrowings, all of those things. All of that will get enabled. So I think it is structurally the right thing to happen for this segment of the industry.
For you, sir, Prashant here, good morning. This is about, the repository is about what, less than 2% of your revenues so far?
That's correct. It's less than just about 2% of our revenues. So okay. I think we are not expecting a large kick-up in revenue because of this.
Yeah. No, LIC, if you just count the number of policies out there, LIC is about an 80% share of all policies. Now, with LIC coming on, as you said, this does shake up things a bit. Would you expect 20, 30, 35% kind of growth in this business? I mean, from a low base, obviously, that is one. And second is, could you tell us what is the cost of doing? What do you charge as margin on these policies?
So it's a very simple charging mechanism. Every time an insurer brings in a policy, he pays a charge of conversion or dematting, which is between 5 to 10 rupees. And then they charge an annual maintenance, which is also in a similar range. So that is what they end up paying. So the rules of large numbers apply. I would think certainly this business is poised for growth. I can see that number to be in the range of, let's say, 25-30% for the coming year for FY26. It's also great signaling to the rest of the market, which hasn't yet aligned to this architecture. So you can find that a lot of the others will also start lining up. Just to share, someone like Star Union, Daiichi brought in their entire policy base to us last year, which means those are insurers which are complete believers, and they want to get into this 100%. I think that momentum will increase now.
You know, NSDL, CDSL, etc. also will start doing this. You've kind of beat them to it in terms of. But do you think it gives you a kind of first mover kind of advantage here?
It gives us the first mover advantage in two ways. By the way, LIC will sign up with all the IRs. It is not that they're just signing up with us. We are the first to sign, but you will see that happen in the next month or two. They will tie up with everyone and give consumers a choice. I think the way this game is played is that the larger number of e-insurance accounts you have, because each citizen is allowed to have one, you can get as much market share as you drive the EIA count, because then whether the person has an LIC policy or healthcare, everything gets into that account. So that's the direction for us to take, to focus on maximizing coverage of EIA and then signing up with as many insurers as possible progressively, so that those policies then get inside the EIA accounts.
So just to completely understand the full picture on this, you're saying that this business should grow at 25-30% over the next couple of years. Tell us two things. One, the margin profile of this business and how it compares with, say, the mutual fund business that you run. And if it grows at 25-30%, that let's say by FY27 or so, how much of your total revenue will start coming from this business, and what does that mean for overall profitability and margins?
So this business is a small business right now, like you said, 2% of overall revenue. So think of it as a break-even business. It is not a margin accretive business right now. As we kind of drive the momentum and help this grow by, let's say, 30%, this will get into double-digit EBITDA in the next 2 years. That's our aspiration. It will still not be materially contributing to the overall book. The overall book is very large. You know that we are a company with about 500 crores of PAT. So when it will start influencing, that may take another 3 or 4 years. But from a size and growth perspective, things look pretty strong.
5 to 10 rupees is what you said, sir. Is it 5 or 10? Or is it somewhere in between? What? In terms of what you charge, one time and then annual maintenance?
Yeah, it's not a flat rate. It depends upon what deal you get with individual insurers. It is in that range.
Okay. Also, I mean, you said that it should get to double-digit EBITDA, say maybe by FY27, 28. Overall, you're operating at 40% plus margins. So in that sense, for the next couple of years, this is not really like you're saying, it's not really about margin creative growth.
No, think of this as a platform business. We've laid the rails, we've done the plumbing, we've acquired the customers, and we have the accounts for them to place their policies. Momentum builds over a period of time. That's exactly the momentum we've seen in other platform businesses. So what I'm very positive about is that foundationally, as we grow from, let's say, 80 lakh to 2 to 3 crore e-insurance accounts, the number of policies will multiply. I'll give you one simple metric. Every quarter, we used to get about 500,000 in DMAT till about a year back. This quarter, that number is 1.5 million. Our objective is that 1.5 million doubles from here in the next 2 years and becomes about 3 million. At that size, this is, it has every indication to become a large material business for us.
Let's talk about your core business here. The mutual fund AUM actually declined by 1% month on month. The inflows have been lower. It's a function of the markets itself. And then the most important part, SIP stoppage as well, increased by about 123%. So does that have an impact on your MF business? Are there any concerns on growth out here? And you were also renegotiating a couple of contracts with 1-2 players. Has that happened? At what levels?
So I think the primary metric, which is MF AUMs, have held very well. If you see whatever has gone off 4Q over 3Q, overall AUMs have not declined by more than 3%. Equity has not declined by more than 4%. This is despite that mark-to-market losses have happened over a period of time. One of the biggest contributors is that net sales, which were over 1 lakh crore a quarter, let's say 1.5 lakh crore, held at 1.5 lakh in 2Q, held at the same number in 3Q. I think in 4Q there'll be a fall, it'll still be over 1 lakh. So a lot of makeup has happened because investors continue to bring their monies into the industry. It is very similar for our assets also. Our equity assets are down about 3% quarter on quarter. Overall assets are down about 2%. So there's nothing alarming there. The real metric you should see is new SIPs, because what's happening on net is that there is some one-time closure of accounts. The industry has been very disciplined in shutting down SIP accounts. If an investor has 3 successive bounces or 3 instances of non-payment, I think in the momentum, some of those closures got delayed. So you're seeing some, over par closures in Jan and Feb. You may see that in March. If you continue focusing on new SIPs, which is a great metric to see, the industry was getting about 2 crore a quarter in 2Q. That number is down to about 1.5 crore. So it's not a bad number at all. From those numbers, we do not see any panic at all. And from a 2 to 3% AUM erosion, I think that's a very good number, which is going on in fourth quarter.
Got it. All right, sir. Had more questions, especially on MF Central. Maybe we should get you on Let's Talk Money for that, because for consumers, for users like us, that's the next big thing that we all are watching out for. But thank you very much for the business update, and look forward to the next conversation as well. Well, let's move on now and put the spotlight on CEAT. That's the next company on our radar. It has launched a new range of tires under the Sport Drive range that includes ZR-rated 21-inch tires, run-flat tires, and low-noise calm tires as well, targeting specifically the luxury and the premium end SUV segment. Our colleague Sudarshan caught up with Arnab Banerjee, MD and CEO of the company, and began by asking him about the launch.
We have launched 3 tires with new technology. One is the run-flat tire, which will keep you safe even if the tire is damaged. You can drive up to 80 kilometers and get it fixed. Second is the calm tire, which is a low noise tire, which is becoming very relevant in terms of long road travel over highways, electric vehicles. And the third is a high speed rating tire, Z-rated tire in 21-inch. So all these tires are targeted towards customers who are evolving from just commuting to exploring on the highways, driving electric vehicles, and also off-roading and going long distances. In terms of strategy, we are targeting the premium end of the market, which is about 8 to 10% of saliency in the overall car tire aftermarket. This is going to grow much faster than the rest of the market, and this is going to grow to 25 to 30% saliency. So if we have ambition, and we have ambition to improve our competitive position in the market, then this is a segment where we have to fortify our position. So these 3 launches are going to do precisely that, and there will be many more coming in the near future.
So what will be the price range and any market share that you would be targeting?
See, our market share is about 16% plus overall. So we would definitely like to be over-indexed in this segment. So we would like to have at least 16% or closer to 20% share in this premium segment, which is the 17-inch plus segment, which is what we defined as premium segment is. So these 3 launches are going to aid that process.
So now shifting to operational metrics. So I'll start with the demand issue. And especially on the domestic front, we have seen that over the last at least 2 to 3 months. Now, apart from 4-wheelers, demand has been sluggish even for 2-wheelers. So how is your ground check? How exactly your customers are saying?
So I think you are referring to the OEM demand. So yeah, OEM, I think 4-wheeler has been slow in terms of its flattish, low positive. 2-wheeler has been growing well actually. They've just touched the FY 19-20 levels.
Retail sales, if you see over the last 2 months, it has come down. And in the last conference, these companies, even for FY 26, they are not so bullish.
Yeah. Right. So how we are looking at, first I'll address the OEM segment tire sales. So we had mentioned about exiting some vehicles in the last 2 years, which we did because of reasons that these are not going to grow these sizes of tires. So we are coming back into the OEMs basis the approvals that they've got and the visibility of that. So our growth rate in OEM is pretty okay. Even though overall OEM sales is in some segments is slowing down or flattish. That's one. Replacement market size, see the commercial market, commercial tire market, truck bus radial market is going to grow by mid-single digit because that kind of mirrors the GDP growth. The passenger growth has been slow in aftermarket, so we expect that to at least improve to low single digit to mid single digit. Two-wheeler aftermarket growth has been steady, especially led by the scooter tire segment, to about high single digit to almost double digit. Rural market is shaping up well in two-wheeler. So that's the outlook in terms of demand in aftermarket.
So you are confident of double-digit growth that you have been targeting? And
we would definitely like to target double-digit growth because that's been the momentum for the first 3 quarters.
And what would be the range that you will be looking for FY26?
At this moment, I would like to say we are definitely targeting double-digit growth. So let's make it happen. Yeah.
No, from sales, if I can talk about the margin, because in the last conversation that we had with you, you had told that this year margin can be slightly below the last year that you had done.
FY25.
Correct. So if you can talk about the range that you might be seeing looking at for FY25, and also if you can say for FY26, what would be the range that you would be targeting?
Yeah, we normally don't give a guidance on margin. So you have seen the last 3 quarters, it's been around 12 to progressively down to 10.4. I can share with you that the raw material situation looks flattish. So it has stopped escalating or increasing further. That's a good news. But it has not yet slackened or dropped off. So quarter 4, quarter 1, quarter 3, all will be similar in terms of raw material prices. What that means is that there will be perhaps no erosion of margins. And if we are able to take some price increases, they might accrue to the bottom line. Having said that, this is the busy season for tire trade, so competitive pressures will also be high. How much of that margin we can retain in our quest for market share, we'll have to see. But we are inclined to take some more price hikes in small doses much more frequently over the next 3-4 months.
I was coming to raw material prices. So natural rubber, and both if you can talk about natural and synthetic. So what is the range of rubber prices that normally you are comfortable with? And any price, obviously you are saying that you will be taking price hike, obviously it might be some small, but in the last 1 or 2 months, have you taken any price hike? So first, range of that you would be comfortable with, and price hike that if you have taken.
I would share the range of gross margin that we are comfortable with, because we really don't control the natural rubber prices, right? So we are, the least that we are comfortable with is about 40-41% gross margin. We are now about 5% behind that. So to that extent, we need to correct the gross margin. Of course, we are also looking at a zero-based approach to the cost structure. So there will be some impact on the cost side as well. But gross margin, there is a clear scope of improvement by about 5%, which will be done through progressive price hikes of small amounts. We have taken some price hikes by the end of quarter 3, by January end. And we expect to take some more price hikes by end of March, and this approach will continue over quarter 1.
So do you mean to say that like rubber price, whatever is the current rubber price, still it's not at the comfortable range that you would say?
It has settled down at a much higher level than last year, is the reality, right? And there's a supply-demand gap in natural rubber. So it also depends on how the demand situation evolves. Sorry. So demand situation globally, not only India, but US, Europe, and the Chinese market.
So now coming to export front, because that segment also forms around 20% to your revenue. Now considering all these ongoing geopolitical issues and tariff tantrums, how is the order book looking at on the global front?
See, international business is something which is strategic for us, and we have invested in product development and nurturing Europe, Latin America, and US. We've just launched in US. So it's important, however, it's also most uncertain. But the good thing is that our bets are placed over 3 geographies. Also, Middle East is pretty strong for us. So not everything goes down or goes up together. So we are able to hedge our bets a little bit. Freight rates are coming down. Currency depreciation is good news for international business. So these are the silver linings, I would say. We are getting good market access in Europe. We are looking at growing on a small base in US. So optically, the growth will be good. There are some headwinds in Latin America because of protectionist measures. So it's really a mixed bag. And if you're referring to US tariff situation, Well, any increase in tariff has a negative impact on the prospect, but since our base is very small, the material impact, at least in FY26, will not be much.
So in Europe, you're saying that things have improved in the last few months?
For us.
For you? Yeah.
Yes.
Okay.
Yes.
All right, so that's SIAT talking about their strategy ahead as they roll out that new range of tyres. We'll take a break on that note, come back on the other side, and we'll connect with Ravi Kapoor of PwC India, as well as Sachin Dikshit of JM Financial Institutional Securities. PwC has come out with a new report on what the rise of quick commerce means on traditional retail. And of course, we'll ask Sachin for some stock ideas as well.
Welcome back. You're watching us here on Corporate Radar, and what a move we've seen on the markets itself. 115 points on the Nifty, though the mid-cap index has given up some of the gains. And the reason why we've seen that is because, we've seen some sell-off take place in the wires space, which is accelerating. KEI Industries down 10% right now. Polycab down about 7% as well. Havells continues to see cuts of almost, 4 to 5%. CAMS, we just spoke with the management, that stock too is lower by about 2.5%. So maybe some bit of profit taking, maybe some bit of caution. And we are also seeing the Nifty Bank face some resistance at that 50,000 mark. The Nifty is holding up because the IT pack continues to do well in today's trading session from its opening levels as well. But let's talk retail. A recent PwC report says quick commerce in India expanded at a growth rate of 73% in FY24. But was that on account of taking share away from traditional retailers, or was that organic growth from all the consumption spaces itself, is the big question. We have Ravi Kapoor, who joins in from PwC, and we also have Sachin Dikshit, who's the lead internet research analyst at JM Financial. Thanks a lot, gentlemen, for joining in. Ravi, three things that really stood out for me from the report that you said. 60% of the traditional retailers perceive online shopping as a significant threat. The second part is that while e-commerce is likely to grow 22.5% over the next 5 years, traditional retail is likely to grow sub 8%. So, what are we looking at in terms of the overall pie expanding, or is it just channel shifting which is taking place? And in light of that, how do you view company strategies?
Well, thanks, Mangalam, for this opportunity. I think the prognosis is very clear. If you really look at the overall personal consumption expenditure in the country, it is growing at roughly around 7 to 8%. So clearly, there is a shift which is happening from our traditional channel mixes going into the organized channels in general, if I call them that, which is a combination of organized brick and mortar as well as the quick commerce and the overall digital commerce players. So clearly there is a move which is playing out in this shift. And what we are seeing here is that, like everything else, it's not evenly spread out. You cannot average out, or you cannot create a macro picture out of this trend. What we are trying to say here is that the way it is playing out for smaller traditional retailers in tier 1 markets, sitting in high SEC localities, the play out is going to be very, very different from when you look at retailers which are operating in tier 2, 3 markets, or bigger retailers where they are much more secure in the way they are able to manage this trend of e-commerce becoming bigger for them. So the hand is not evenly played out. There are pockets where we see this to be much more severe. And what it essentially means for brands is that you need to now take care of more dynamism, more complexity in the way you're looking at your channels. Clearly, we see as the overall growth story of India plays out, we see the organized channels becoming bigger. In fact, our sense is that in the next 5 to 6 years, organized channels should become 30% of the roughly 1.8 trillion retail market that we believe India will become. So clearly, something has to give. And clearly, what we see is that the bottom of the pyramid is where the maximum amount of challenge is going to be for Kiranas. And there are ways in which Kiranas will have to really reinvent their business model. And that is what we have tried to cover as to what one can do to really play this out.
Sure, but Ravi, got your point. And I guess that challenge is far more pronounced in urban centers, right? Which is where we're seeing a greater adoption of e-commerce and quick commerce. But back to that central point. So does the report, finally come to the conclusion that right now e-commerce, let's talk urban centers only, that right now e-commerce is not really growing the market. It's only distribution shifting from one channel to the other. Is that what your report is finally indicating?
So it is not exactly that as well, right? Because overall retail is growing in India. Overall retail consumption is growing. Our sense is growing anywhere between 9 to 10% year-on-year CAGR. So overall pie is expanding, but there's a disproportionate shift in certain sections of the consuming economy, which is being taken over by the e-commerce channels. That's the way to interpret it.
I think in that, gentlemen, morning, Prashant here. Ravi, in that report, you talk about the Jevons paradox, right? I think the last we heard that was from, I think, Satya Nadella two weeks back, and that paradox shot into fame. But interesting highlights, an interesting report, really. Let's bring in Sachin into the conversation as well. Sachin, good morning. So you heard Ravi, and what does this mean for from an investor point of view? I mean, names like Zomato and Swiggy have corrected quite a bit. Do these trends make these stocks interesting and compelling investment opportunities?
Yeah, sure. What is happening is that most of these stocks, right, Zomato, Swiggy being in the public markets, and then also some unlisted companies that are there, everyone is growing very, very well. And something that's corroborated by Ravi's report as well, in the sense like a lot of growth is coming from e-commerce, where quick commerce is rising in overall mix. So a lot of that channel shift is happening. What we are also seeing is that it's not just channel shift that's happening here. There is also a factor of accessibility that comes into play, right? It came into play in e-commerce earlier. Now through quick commerce, you are seeing that when some of these quick commerce players are expanding into tier 2, tier 3 cities, a lot of the brands that were not present there, a lot of the brands that could not afford to build distribution in these areas are now able to access this customer base, and the customer is able to access those products. So that is also playing out, yeah.
Yeah, Sachin, exactly on that point, Ravi's report, actually, I was going through some of the details, and the report also mentions exactly this, that the quick commerce players, they're finding the difficulty a little more challenging in tier 2, tier 3 as compared to urban centers. That's where they have to figure out inventory management, logistics costs. The market is a little more fragmented. It's not as easy or as homogeneous as, let's say, Mumbai or Delhi. And this is exactly where the store rollouts are happening, right? We remember what Blinkit said and what happened to Zomato at the end of the last quarter. I think it was last, when they said that they will be investing a lot more in the store rollout plan. So given that reality and the whole profitability metrics, do you think that it's good to invest in the companies even as they themselves are still very much in an investing phase, specifically on quick commerce? Sachin?
So what is happening in quick commerce is that you are seeing that a lot of store rollouts are happening. Companies have given guidance in terms of where they want to reach in terms of their store presence. But what is also interesting is that the store rollouts in tier 2, tier 3 cities are very minimal, in the sense like if you look at number of stores per tier 2 or tier 3 cities, that number is probably 10-20% the number of stores that you have in tier 1 cities. So what these
Right.
companies are doing is that they are looking for basically micro markets in these smaller tier cities, opening stores there. And because quick commerce anyways is a densification play. So that's why that's the approach that they are going to take. And which is why when you look from Ravi's reports perspective, where he might be looking at a broader offline retailer perspective in these smaller tier cities, most of the retailers will not get impacted. It will
You know
be
what
just that smaller, yeah.
Right, Sachin, you know what we understand so far from the way any market develops. First is curiosity, then there is denial, then there is overwhelm, and then there is overestimation. In the Q-commerce opportunity, where are we? Because earlier there was curiosity whether people want stuff in 10 minutes or not. Then there was denial that, oh, maybe they don't want so many things. Then there was overwhelming stuff that people are ordering fridges and air conditioners as well. At what point do we lead to overestimation of the market opportunity here?
So some of the overestimation, I'll say, has already corrected, right? If you look at how some of the reports came out in the past 1 year, there were a lot of ambition that was built into quick commerce, thanks to the fact that a lot of players have entered, a lot of profitability guidances have been toned down. So I think we are now after overestimation. I think that overestimation did happen at some point. We are now reverting back to the norm where the valuations look saner, the estimations look more in line, but still even today I think a lot of uncertainty still prevails in this sector because there are still players who are trying to enter and try to make a dent to the quick commerce landscape. At one point of time there was only Swiggy, Zomato and Zepto who were trying to do anything here. Now we are talking about 3-4 players who are trying to make a proper dedicated quick commerce play. Secondly, we are also seeing a lot of the marketplaces in terms of the e-commerce side who are now moving to a 2-hour, 3-hour delivery, right? Which again tries to play into that quick commerce arena. So I think in that sense, a lot of turbulence is still there, and which is why you have seen the corrections that have happened. Now the bet is like whether you want to play this sector in the sense like look for who is going to be the winner and try to back them up, or you want to stay away from it. So I think we are still seeing some divergence there. Obviously, people are putting their chips on some of the players, which you can see how the stocks have been moving around. But I think the uncertainty level is certainly higher than what we have seen in the
Uncertainty level is certainly high. That is why we got you, Sachin. So from a viewer's standpoint, those who are looking at Zomato and Swiggy, what should they do?
So obviously, in terms of where the valuations are, we have very strong ratings on both the stocks. We have buy ratings on both the names. Right, Swiggy's quick commerce play is slightly behind what is there for Zomato, which is why you are seeing that Zomato has picked up in the last few days, and we are seeing Swiggy also remaining. I mean, at least the bottom seems to be capped as of now. But we do have buy rating on both the names, and we believe that quick commerce in this format is going to sustain. There is certainly an market adoption, a customer love that we have seen for the model. So in that sense, I think the story is long enough to be played for some more time.
All right, we'll leave it there, gentlemen. Thank you very much for joining us and speaking to us about what you see as trends here in the space. And we continue this conversation because, of course, I mean, there's a lot happening, newer entrants as well in quick commerce, which we've not touched upon. So people want a piece of the pie, which is expanding. Sachin and Ravi, thank you again. Well, while we've been on that discussion, markets have seen a fair bit of move. So not so much on the Nifty, but the mid-cap index, look at the intraday mid-cap index, the intraday small-cap index. We've completely given up gains. From yesterday's close to the day's high, the gain was about 1%. We've given back about 1%. From the day's high. I mean, basically the high in the last 45 minutes that we've been trading or so. So it's a pretty steep come down. On the Nifty, you still have 23,000, about 100 odd points higher. And I have to say, even as that's happened for mid and small cap indices, market breadth is still very strong. I mean, I think it's almost close to 3:1. It was 10:1. It's about 3:1. So we'll see and track how this progresses from here. That's a Nifty heat map as well. Mitesh is back with us. Mitesh, morning again. Just a quick view on indices and, of course, what's happening in broader space.
So, morning, Prashant. I think the view remains positive. And as I said, after 2-3 days of nearly 2.5 days of good rally, you might get an intraday dip, but I think for me that would be a buying opportunity. So stay long. The Nifty has hardly declined from the highs, only about 30-40 points. The Bank Nifty has tapered off a bit by about 200-250 odd points, but I think the chart structure remains positive. So I'll maintain 50,500 as the near-term target for Bank Nifty, and once we clear 23,150, then 23,500 as the target for the Nifty. Very, very clearly a long bias, and in case we get another 80 to 100 point dip on Bank Nifty, I would even want to add on to long positions.
Couple of heavyweights doing well right now. That should aid your call as well, Mitesh. We have Reliance, which has moved to the high point of trade swiftly. And we have HDFC Bank, which saw a dip, and from the lows, that stock has moved higher as well. So just look at Reliance. That may support the cause of the index a little more. And HDFC Bank, which saw a bit of a dip, and that dip too has been bought into. So with that, what we'll do is take a short break. Actually, Mitesh, you have stock picks as well at 10?
Reliance is in fact one of the picks,
Okay.
Very good structure coming out of a good correction. There's a fresh buy with a stop at about 1245 for targets of 1290 to about 1300. And the other one which I like is a tech stock. In fact, technology is trying to show signs of recovery. So Tata Elxsi is something which has come on the radar. Slowly buy here with a stop below 53.85 and look for a target of around 55.52 billion.
All right, Mitesh, thank you so much for joining in and giving us your calls. With that, we'll simply do a short break, come back on the commodity space. Manisha Gupta gives us a wrap on all things that are moving.
Make informed.
Welcome back. Well, the equity market got a little wobbly on the mid-cap index. Let's actually see the Nifty as well. A quick, taking stocks. Nifty is fine. It's the mid-caps where we got a bit of a sell-off. Let's take a look at now what's happening in commodities. We have Manisha joining in. Manisha, what are you tracking this morning?
Well, I'm looking at overall metal as a sector. I mean, we've all been talking about on how gold is trading at an all-time highs, but within the metal space as well, what is really giving tough competition to gold has been the copper prices. Very strong gains onto that one. Let's talk about the macro first, and the US Fed projected slow growth and higher inflation, and we've seen some bit of a buying come into tangible commodities because of that. And then apart from that, there there also have been statements from Powell saying that they're not in a hurry to adjust borrowing cost yet, but also said that they're waiting for greater clarity here, but also said that the US Fed could be looking at 0.5% of an increase in interest rates by the end of this year. But let's take a look at copper right now. And even as these statements were coming in, you saw the copper prices gain up by more than a percentage point. So when you look at week-on-week basis, we've seen copper prices gain up by 4%. It's up 13% in last 1 month. And in this year until now, we have gained by 28% for the copper prices. So very strong gains. This is more than what gold has done, more than what silver has done, and more than what various other commodities also have performed in this year until now. So when you look at the spot markets, we have seen that reflect supply tightness. That is because there's a lot of buying happening on LME in Europe and especially in the US markets there. Inventories on LME and Shanghai have continued to see a decline. And the only one place that you have seen inventories actually gain up has been the US markets there. China's special action boost that we saw come in on Sunday also has led to a lot of sentiment buying. The consumer spending in China is expected to gain up with the kind of stimulus measures China is putting out, and that in turn also has been supportive. But you really need to see on what US is doing when it comes to copper. So we are hearing this for last month now that US could potentially impose tariffs on imports when it comes to copper. Now US imports nearly 45% of its copper demand, and US copper at this point in time is trading with $1,200 a ton of a premium to anywhere in the world. So US copper is expensive at this point in time. Also, when you look at the US copper imports, they are near all-time highs. So the all-time high that we've seen in sense of imports in any month in US has been 132,000 tons. But there are reports that Trafigura, Glencore, Gunvor Group are redirecting a lot of copper to US from Asian and UK markets there. So that clearly has been supportive. Also, there are expectations that in this month, 100,000 to 150,000 tons of refined copper is being shipped to US. And that is what is commanding premium. That is what is taking the prices on the higher side as well. The markets do believe that we are trading very close to all-time highs when it comes to copper. And if these numbers continue in sense of copper being shipped into US, you could be looking at all-time highs not too far away in sense of copper.
All right. Thank you very much, Manisha, for that. So that's metals and copper in focus. Well, copper essentially is what we are talking about next, but in the form of cables and wires. Stocks are taking it on the chin. One more entrant, large conglomerate making an entry. Vinny's here with a focus on that. Vinny, morning.
Morning. So absolutely, we're seeing a bit of a pressure coming in on all these cable and wire stocks, KEI cables or even Polycab, Phenolics cables, RR Kabel, all of them under pressure today. Now, increasing competition is the key factor for this. Adani Enterprises has formed the JV for its cables and wires segment, where we're seeing that the 100% subsidiary of Adani Enterprises, that is Kutch Copper, has formed this 50-50 JV with Pranita Ventures, and this is going to be called Pranita Eco Cables. Now, what is this business that is going to be from this JV? It is going to engage in the business of manufacturing, marketing, distribution, buying and selling of metal products, cables and wires as well. So this is very interesting. Now, as of now, what we know, we don't have the details of the exact investment that is happening, but Kutch Copper Limited last year had spoken about, in 2024 sometime they'd spoken about investing $1.2 billion to set up a 1 million ton per annum copper plant in Mundra. So this is still underway. This is still under development and construction, and that would be making products like copper rods, gold, silver and other copper products. So this is going to be interesting of how Adani Enterprises is going to play out with this and Kutch Copper Limited in terms of what is the exact business that they'll be doing, since it's a 50-50 JV. Nonetheless, just in the month of Feb, we had Ultratech Cement also, who had announced that foray into cables and wires, making that capex plan announcement of around 1,800 crores over the next 2 years. And since then, we've seen all these stocks be under pressure. In the last 1 month, we've seen the stocks fall almost in the range of 10 to 19% for all these stocks. So keep an eye out on that. Pressure surely is increasing. And analysts are saying that this could maybe hurt the industry better, and some bit of the return ratios for these incumbents may get impacted as well.
Sharp fall. Look at that, 12 to 13% down on some of these names like KEI now. Vinny, thank you very much for that perspective. We do have to take a break on that note. Come back on the other side and it'll be time for our special segment. It's the economy. Lata, today we'll discuss Asia macros and markets post the Fed decision with Louis Kugis of S&P Global Ratings and Neeraj Seth of BlackRock.
comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access.
Well, the global economic kaleidoscope has moved. The US Federal Reserve has upped its inflation forecast, lowered its growth forecast for the US economy, giving a whiff of stagflation worries. But it has retained its forecast of 2 cuts in 2025. More important, I think, is Treasury Secretary Scott Bessent telling Fox News that his government will, on April 2nd, give a number to each country that represents their total tariff wall against the US. But it wasn't clear from that interview if the higher tariffs will be applicable given that number from April 2nd or whether that number will form the starting point of negotiations. So what does all this mean for Asian economies, Indian economy, currencies, markets? I have an economist, Louis Squeeze from S&P. He heads Asia economics and a market veteran, Neeraj Seth, former CIO and head of APAC Fixed Income at BlackRock. Neeraj and Louis, thank you very much indeed for joining me today. Louis, first to you. I'll come to the Fed in a bit, but what have you made of Scott Bessent's statement? Do you think reciprocal tariffs don't actually apply on April 2nd itself?
It's a good question. I'm not sure anybody of us knows exactly what they're planning in terms of timing and not even exactly what they're doing, right? So the White House published a piece a few months ago saying that they consider there to be 7 or 8 criteria that they'll look at when they make up their minds about these reciprocal tariffs. They include tariffs, but also, bilateral trade surpluses and even things they don't like about your tax regime or things like when they feel your wages are too low. So we will have to look what they are coming up with and then make a decision. As you said, also, the timing is also not exactly clear.
But Louis, neither S&P for that matter, yesterday Fitch even published its India growth number. They've retained it at 6.5, and I think your number is also 6.5. The tariffs are not making you revise India's growth numbers?
We actually looked very carefully at which Asian economies we think are most at risk of tariffs, and also where we think if tariffs are imposed, the impact will be the biggest. And, India still has sizable tariffs from a US perspective. So India may well face some tariffs, but exports to the US are not a huge size compared to India's economy, right? So the impact on growth is likely, to not be overwhelming. And that's why we think, yes, India may well see tariffs, but they don't necessarily completely run, of course, that trajectory for India that we're looking at.
Yeah, somebody, I think Citibank calculated that it is only 2% of India's GDP, the exports to the US. Neeraj, the bigger point is, first of all, of course, thank you as well for joining us. What is your sense about US exceptionalism? If the Fed itself is lowering growth rate and upping inflation forecast, and we have seen the stock markets react, is US exceptionalism over?
I don't think it's over, but there's certainly a pause. And I do think markets were stretching the concept of US exceptionalism, which led to a lot of capital flowing to the US from a financial markets perspective at the expense of rest of the world. I do think you're seeing a pause now from a tech, from a future growth perspective. I still think US actually is very well placed, but the market stretched the valuations on the concept. And I do think we are just seeing a recalibration based on the shift in geopolitics, the shift in the US politics and the policy predictability. Because the one thing, I would say the only thing predictable today is the unpredictability of the US policy. And I don't think that's going away. So that pause is very well warranted.
Okay. So it's a pause. Maybe exceptionalism is tarnished a bit, but not over. But Neeraj, the bigger question really, which any Indian will ask you, when does the FII selling stop? I mean, I'm asking you also because India's inflation has come in much lower. So the need for the rupee to depreciate any further seems to have gone away. Given that side of the story, do you think we are at least at the end of this outflow from FPIs?
I think we've seen a decent chunk of what I would say what one would have expected. But if you step back and think of the three broad reasons, the valuation is a starting point. When you started to see the outflows last September, the Nifty was about 26,000, and we're seeing close to 28 billion of outflows from the FIIs. The second is the unpredictability post the US election and driven by tariffs and obviously the lack of direction at this point from an investor perspective. And the third factor is the rise of Chinese markets. And we've seen the push from the authorities to revive growth, and the run-up in the Chinese stocks have obviously taken some part of that allocation back. So I think we've seen majority of it, but are we done? I'm not sure, because the predictability as well as the potential for Chinese stocks to do well, at least in the near term, still very much is on the table.
Okay, I'm going to come back to you for a dollar rupee view as well, because the rupee has appreciated 1.7% from the February 10th lows of 87.97. Today it stands at 86.22. But I'll come back to that. Before that, I think another factor that we have to bring in is Europe. The deficit increase and the German Bundestag allowing for the debt break. The German executive is going to spend 1% more on defense. Lewis, what does that mean for global growth? There is a huge fiscal stimulus from a large economy.
Yeah, Germany is still a pretty large economy. So our European economists, they're looking at this. We expect to have to raise our forecast for next year's growth and for 27. Not a lot for this year, because it takes a while before this starts to really, affect the economy. But definitely, we're looking at an impact on growth next year and the years thereafter. And it's about time, right? Because so far we've been looking at a really weak picture coming from Europe. So, there are probably, from a business, from an economist perspective, there are probably more productive ways to grow than via defense spending, but at least, we have spending now at higher levels than we were looking at before. So yes, we are going to raise growth forecasts.
Okay. In terms of deltas, would you say that you would push the Chinese growth higher? I'm not at the moment looking at levels. I mean, it's not 4.5 or 4.75, but is it that India is seeing an outflow because the delta here is not moving to higher? But for China and for Europe, the delta is higher. Would that be a fair observation, Lewis?
You know, I think it's really interesting. There are a lot of things going on at the moment, right? One side is the economics, and then you have financial markets. And I think financial markets have rightly, you know, looked back at India, at China, and said, hold on. Some of us talked about it being uninvestable. There's nothing of interest over there. People realize there's a lot going on in China in terms of innovation in tech, biotech, all these things. To be honest, on the pure economic front, on the macroeconomic front, things haven't changed all that much. You know, we're not overly bullish in terms of growth, and we still worry about downward pressure on prices. But yeah, you know, the markets I think markets probably have been too gloomy on China and are having another look at it.
Okay. Yeah, fair point. I guess the property problem is still not over, according to latest reports from the country. You agree with that. Neeraj, now for the levels question. Your dollar-rupee view, as well as interest rates. Do you think India becomes attractive on the rate front? Our last inflation number was 3.6. So, you know, even in terms of debt, does India look very attractive?
I actually do believe India looks very attractive on the debt side. And if you look at the government bonds in India, they are among the most stable when you think about the carry-to-wall ratio. And it's still extremely underrepresented in the global portfolios because of the recent opening of the Indian debt market. So I do believe that's a market which remains attractive. It will be slow, but clearly a story of inflows from the global investors. And from a currency perspective, to your point, I think India is moving towards a structural story of shift in the inflation lower. And I think it's a positive story. So it should give stability from a currency perspective. And one of the challenges I always feel is people look back last 10 years, 20 years, 30 years and look at the depreciation, which was in a very, very different era. Lack of infrastructure, food price inflation, volatility. I think it's changing. So in a medium to long term, I'm positive on the currency exchange rate as well as the Indian government bonds and the broader credit markets in India.
Well, that's important. You know, we were factoring in 3.1 or 3.3%. If I looked at the average of the last 20 years, you're saying that depreciation is not called for when you forecast. Lewis,
it should go lower.
It should go lower. Okay, that's important. Lewis, what is your delta on India's growth? I mean, there are some gloomy predictions that the GST collections, auto sales, etc. February exports, I mean, exports and imports shrank. Exports shrank 10%, imports shrank 16%. So is there any downside risk to India's growth?
Downside risks. Lata, I think there are also upside risks. So our forecast is pretty stable, both with regard to how it looked a year ago, and also, you know, so basically it's pretty stable compared to last year, and also we're not planning to make major changes to our forecast. We think that, you know, there have been a few weak months in the second half of last year. It does look like we're overcoming that. So yeah, we don't want to make too big changes.
Okay. Well, thank you very much. I'm out of time, not out of questions. So Lewis and Neeraj, thank you very much for participating in this conversation. I think the takeaways for India look positive at this point in time. The S&P economist saying the growth looks stable in spite of the kind of changes we are seeing in the global geopolitical terrain. And Neeraj saying that India is a long-term, macro story in terms of fixed income and inflation, and of course, therefore, the exchange rate. Those are positives, long-term positives. Wrap up on Bazaar on that note. Chartbusters coming up.
You know, the thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
The Nifty rises above 23,000 for the first time in a very long time. It's led by positive global cues. IT stocks surge as the US Fed holds rates steady. The market has come off the opening highs but still holding about 23,000 for the Nifty. The broader markets, relative underperformer after big outperformance yesterday.
Cables and wire stocks have corrected sharply on intensifying competition within the space as the Adani Group now plans a foray. This follows Ultratech, which announced an entry into the sector last month.
CLSA bullish on Z Entertainment with an outperform rating and a target of 170 rupees a share. The brokerage says risk reward is highly favorable with valuation at rock bottom. The stock surges nearly 4%.
The cabinet extends incentives for UPI transactions up to 2,000 rupees for small merchants. Brokerage Jeffrey says the approved incentives are half of last year and could result in a proportionate fall in adjusted EBITDA. Paytm shares are down by around 4%.
Order wins continue for a lot of the companies as we move towards the end of financial year FY25. Just keep an eye out on Paras Defence and GRSC, Garden Reach Shipbuilders, all of them higher. Paras Defence has won an order worth 140 crore rupees from the DRDO, while Garden Reach Shipbuilders has won a road project in Nagaland, among all the other companies which are spiking. It's a solid start. You're watching us here on Chartbusters. We're live to you from CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Fatakia. Across all parameters, the market's doing well. On the mid-cap index, one would quibble that, okay, it's not gaining as much as the frontline indices. But my point to them is that 1,800 stocks are still in the green. The ones which are losing, of course, are, on account of reasons that have come by, be it increased competition or be it some regulatory risks that we're seeing in the likes of Paytm, etc. But what's interesting is the previous chart that came up, the mid-cap index, briefly slipped into the red. From lower levels, we've seen purchase. So dips are being bought into, and the broader markets, in terms of market breadth, is strong. The frontline indices continue to rally, Hormas.
Oh, the frontline indices indeed. Fourth day of gains now for the index, now above the 23,000 mark for the first time after the 19th of Feb. So it's good going for the benchmark indices. The weekly expiry today as well. So we saw some bit of choppiness in the last few minutes, but now we are back towards the highs of the day. A quick chart check with Sachitanand Duttekar of Trade Bulls and some trading ideas as well. Sachitanand, good morning. Thank you for joining in. Now that we are above the mark of 23,000, do we see a move further higher, or do we see some bit of consolidation now that we have gained almost over 1,000 points now from the lows of the 4th of March?
Good morning, almost. Good morning, Mangalam. I think clearly the trend is very strong. We may see this particular rally getting extended towards 23,400, where its 200-day exponential moving average is placed. Primarily, if you look at the last 3 trading sessions, Nifty IT was not contributing, and we have seen a good strong pullback moves in some of the large cap IT stocks. So probably because of that, we may see this particular rally getting extended. A minor consolidation cannot be ruled out. We may see some slippages of profit booking, but I think the support at 22,900 looks very strong, at least for the day. On the higher side, we may see some bit of consolidation near that 23,100 mark, where the call writers have been confident. So I think there could be some range-bound action within this particular range of 23,100 to 22,900, but eventually we may see this particular rally extending towards 23,400.
Wonderful. What about the Nifty Bank? Facing some bit of congestion around that 50,000 mark, and if you could lace that with your individual stock picks as well, Sachi.
Well, Mangalam, I think for Nifty Bank, the hurdle is very evident at 50,000. So unless we don't see this particular level getting crossed, the chances of a momentum-driven rally look bleak. We may see, the Nifty Bank again displaying a pullback towards 49,500. This is where its 50-day exponential moving average support is also placed. So the range for Nifty Bank, looks very confident. 500 looks 5,000, 50,000 looks like a very strong resistance, but on the lower side, 49,500 looks like a decent support. So we may see oscillation there. On the stocks front, Titan is something that we have also recommended to our clients on the long side. Now, if you look at the overall structure, the stock was in a low top, low bottom sequence, but recently we have seen a good surge in this particular counter. There's a rounding bottom formation on its 60 minutes chart, plus the 3,100 call writers have been pushed behind. So probably we may see this particular momentum getting extended towards 3260, where its 50-day exponential moving average is placed. And that's why we are still recommending building long positions in Titan. The stop loss for the trade can be placed at 3090 on a closing basis. And any pullbacks towards 3130 would again give a very strong, good opportunity from a reward to risk perspective. So we are recommending building long positions in Titan. The second stock on our radar is Nykaa. Now, if you look at the last 2-month structure, the stock has been oscillating within this range of 155 on the lower side and 180 on the higher side. It has started trending above its 50-day exponential moving average today, and that's why we are recommending it from a momentum perspective. We may see a surge towards 178. The stop loss for the trade should be placed at around 165 on a closing basis, and even here some aggressive long positions can be deployed.
All right, Sachitanand, thank you so much for spending time joining us today with your views on the index and specific stocks as well. Titan and Nykaa, his top picks. Taking our focus to the special segment where we get you a few ideas for profit from Money Control Pro. Khushbu Rai of moneycontrol.com joins us today.
In today's idea for profit, we have Repco Home Finance. The company's established position in South India, especially in Tier 2 and 3 cities, offers strong pricing power, but the asset growth numbers has remained below par. However, the structural changes by the new management is proving fruitful, and the disbursement is guided to grow in the range of 25 to 30% on a sequential basis in Q4 FY25. The company also expects gross stage 2 numbers to reduce by 100 basis points QOQ to 10% in FY25, backed by higher recoveries and better asset quality of the newly disbursed loan. Also, the fresh sanction by the NHB in Q3 will lower the funding cost and help the company to maintain margins at the current levels. If we look at the stock performance, Repco has underperformed most peers and is trading at a deep discount. However, we feel that the stock should command higher valuation due to the healthy profitability and benign credit cost. This will, however, be contingent on the company's ability to generate higher loan growth on a sustainable basis.
Right, with that, we'll step into a short break, but don't go anywhere. On the other side is a special conversation lined up with the management of transformers and rectifiers. The managing director, Satyen Mamthura, joins us in our studios to discuss their latest order win, but more importantly, prospects for the company looking forward as well. Welcome back. You're watching us here on Chartbusters. A lot of stocks doing a lot better right now. Aditya Birla Capital has moved to the high point of trade. BSE itself has moved to the high point as well. Remember, the stock has exited F&O ban. We pointed the possibility of that yesterday. And while shipbuilders are doing well, think about shipping companies. Shipping Corp of India is up around 12% as well. So a lot of mid-caps actually seeing a fair amount of traction, double-digit gains for, Shipping Corp of India. That's Garden Reach Shipbuilders up on account of an order win that has come by as well. But speaking about order wins, transformers and rectifiers, that's the company on our radar. From the start of 2025, the company has backed a bunch of orders. We have Mr. Satyen Mamtora, who's the managing director of the company, who joins in. Along with him is Mr. Rajora, who is the CFO of the company as well. Both the gentlemen in our studios. Thanks a lot, sir, for joining in.
Thank you. Good morning to all of you.
Good morning. When we started this year, you had an order book of around 3,700 odd crores.
Yes.
But after you kept winning orders.
Yes.
And the last known order book publicly that you had spoken on CNBC-TV18 here was close to around 4,200 crores.
Yeah.
If you could give us a sense of where does that number stand at right now? The incremental orders that you've gotten so far, are they at a blended margin higher than your 14-15% range? And what kind of order inflows are you targeting for the remainder of this year? That's around 15 days and all of next year.
Yeah. So currently we just won one order from Jetco, which is around 726 crores. The margins are slightly better. Around 16%, yes, and the next year we will be closing at around we are targeting around 3,500 crores, and in terms of that is sales revenue, and in terms of new orders book, we should be close to around 8,000 crores by end of next year.
So that's the order inflow that you're targeting? Or
order inflow, new order inflow we are targeting by the end of next year.
So you're targeting 3,500 crores in revenue is what you said, and then the rest of the sum that you mentioned is for the new order inflow, right? So the current order book that you have, by when do you expect to execute that over a period of time?
So the current order book that we have, 3,500 crores we'll be executing this year, and the remaining is in the first quarter of next year.
Oh, so you mean by this year? You mean by the
coming financial
year? In FY26, right? Fair. And what is the mix in the order book that you're seeing? Your exposure to state government utilities and to enterprises as well?
So major of our order book would be from Power Grid and NTPC and likes, and then other than that we are targeting EPC contractors. And some boards which are our favorites or which are close to us, we also quote to them. So Gujarat being one of them, it is our home board. So we have this is the largest order in the recent past that Jetco has also given to somebody.
What about exports? You had earlier guided for about 25% share coming in from exports, understandably due to weakness in the international markets, that in the third quarter accounted for just about 10% in your overall sales. Where does that number stand?
So that would stand at around 10%. But in the recent past, we as a company have decided that first we will do whatever needs to fulfill the needs of India.
Okay.
So we are targeting now India first, and close to 10% exports is what we are targeting, not beyond that.
But is there a compromise on margins? Is there a possibility that
there should not be a compromise on margins. The margins are almost the same. But we have to currently focus on the needs of India in terms of electrification of India.
Well, Mr. Rajora, you mentioned, you guided for 14% margins. Now, the orders that you've won, as Mr. Mamtora was also saying, that are on better margins. Do you expect that figure to trend higher, or do you stick to that 14% band just because to be on the conservative side?
No, the margins are slightly improving now. Actually, year by year, if you see the margins are improving. Even if you see the quarter by quarter, we are increasing the margins in that way. And our target is to reach to around 17% margin levels in next 2 years' time. So we are actually guided on that side. And basically, the focus is not to increase the margin by increasing the prices. The focus is to bring the operational efficiencies as well as to get the better margins by way of implementing the backward integration activities, what we are doing. So we are expecting that these are going to be the better margins for us, and on the console basis, we'll have the better leverage on the margins once our backward integration activities will be in take place. And you had asked one question that what is going to be our order book by end in next 15 years time. As on today, we have around 5,200 crore order book. And we see that we'll be closing somewhere around 5,200 to 5,300 crore order book.
Maybe about similar levels.
Similar
Because next 15 days, maybe at best 100 crore.
Because we'll have to leverage out the revenue what we are doing in this month also.
So, since you're talking about the next 15 days itself, the first 9 months of this year, 1350 crores top, roughly is what you've done on the top line. Your target was 2,000 crores. You'll cross that, or you'll just about?
We should be around 2,000 crores, 1950 to 2,000, somewhere between that.
With 14.5% sort of margins.
Yeah.
And you had given us a glide path of margin improvement all the way up to 17% by FY27.
Yeah.
Next year, on a 3,500 crore revenue, what are the margins that you would do?
We are expecting somewhere around 15 to 16% margin.
What about the current capacity utilization that you have with the orders that you are winning? Do you plan on expanding capacity going forward as well? CapEx plans for the next year?
Yeah, so we are currently expanding, and our expansion would be finished by 1st April. Our new plant, the expansion will be operational on 1st of April. That will add about 15,000 MVA in the current. And after this, by end of this year, by 1st January, we are expanding to 22,000 more MVA. So our total capacity in terms of MVA should be around 65 to 70,000 MVA.
By
1st January to 2026.
2026.
Okay, so that's the third quarter FY.
Yeah, third quarter FY.
How much do you plan on spending to get to that?
We have almost
basically in entire capex we are expending around incurring around 500 crore rupees capex in the present year and coming financial year, right? And the next capacity expansion of 22,000 crore rupees, 22,000 crore MVA, what he has said, it is going to be on the extra high voltage transformers side.
And extra high voltage, I presume, are
the 400
yes.
kV and the 765 kVs.
They are the need of the hours. Right?
That is where the major focus of India is currently, in terms of laying the cables and electrifying every single town or a village. The 765 and the 400 kV will come in picture, right. And then the distribution transformers or the small power transformers.
You're also entering the solar and hydrogen transformers, and in that, I remember the last time you joined us, you said that you have a head start ahead of everyone else when it comes to capacity addition. If you could give us a sense on where you are on that versus the others.
So currently we will be adding 15,000 more MVA in terms of, approximately 8,000 MVA in terms of solar and solar IDTs and green hydrogen transformers, and around 5,000 MVA in terms of distribution transformers.
Okay, and I'll have to ask this to the CFO. 750 crore QIP provision, when do you launch it?
No, there is no plan as of now. It is basically enabling approval what we have taken from the board, seeing that if any good opportunity comes and we want to leverage on that, right? So then if anything requires, we'll be coming on.
So that enabling provision lasts for a year, right?
Yes.
So how long do you have left for that?
We have entire year left for that.
So no plans as of now.
No, so we're looking at inorganic growth opportunities that if we can find some. It is faster to grow inorganically than grow organically and build plants. And
so we can hear something in the near future?
Sure.
We should.
All right, gentlemen. Thank you so much for joining us today. Wish you good luck for the management there of Transformers and Rectifiers India. We take a short break, and here's a small programming note as well for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards Season 2. Take a short break. Back on the other side. Welcome back. It almost seems like an Ultratech 2.0 moment for these wires and cables companies. The second time in just under a month where most of these are down after competition intensifying in the space after the Adani Group announcing a foray. KEI Industries is now down almost 15%. Polycab is down 9%. So two of them seeing the biggest knock in today's trading session. Of course, Havells and Phenolix too down around 4% each. What is also not doing well though today is Vodafone Idea, and it's a likely setback for the company and Bharti Airtel, and that's because the government sources have told CNBC-TV18 that the proposal to waive off the AGR penalties is no longer being considered. But the telecom department has the option of sending another revised proposal. Ashmit Kumar now joins us with the details. Ashmit, what does this mean for these companies now?
Well, indeed, a setback coming in as far as telecom players, the likes of Airtel and Vodafone Idea are concerned. The players who had been hoping for some relief in the form of an AGR waiver. Bear in mind that the DoT had contemplated and had put forth a waiver program under which there was a proposal for waiving of 50% of the interest component of this AGR demand and 100% of the penalty and 100% of the interest on penalty component. This was the proposal that was floated first by the DoT. It went through the motions, first the DoT, then the Finance Ministry, also went up to the Cabinet Secretariat. However, what highly placed functionaries within the government tell us is that there will be no further consideration under this proposal that had been put forth by the DoT, the Cabinet Secretariat sending it back to the DoT, saying no further consideration. Again, a confirmation being received by highly placed government functionaries. Now, bear in mind that this decision by the Cabinet importantly comes at a time when the Supreme Court repeatedly has refused to budge as far as the AGR demand is concerned. The telecom companies, the likes of Airtel and Vodafone Idea, have repeatedly tried to impress on the court that there could be computational errors, there could be arithmetic errors, there could be possible double counting. However, the Supreme Court refusing to budge, and it is only after the Supreme Court's refusal that the DoT had begun to contemplate such kind of relief. However, we're given to understand no further consideration, at least as far as this proposal is concerned, that shifts the focus back to the DoT. Is there room, is there flexibility for coming out with a revised relief package? That's a question that the telecom minister, that the DoT will now have to answer. Back to you.
Thanks a lot for putting clarity on that, Ashmit. You know, most analysts on the street weren't factoring any sort of relief coming in their models itself, but the optionality of that could have been a positive. But, you know, from a stock market standpoint, a bigger negative for Vodafone Idea and Indus Towers than it is for Bharti Airtel, and which is what we're seeing in the form of reaction as well. Bharti Airtel currently at the high point of trade in line with the way the market's moving. But if you look at Vodafone Idea and Indus Towers, you know, from yesterday's high, they've seen a bit of a knock, and the intraday chart of Vodafone and Indus comes up for you. Right now, we see them lowering further. So at the low point for Indus Towers, and so should you see Vodafone, which is again at the low point of trade itself. So that's about the telecom space. With that, we are wrapping up on this edition of Chartbusters. And as we do that, here's some good news for all you viewers. India's business news leader is now just a click away. That is CNBC-TV18's all-new app that comes up for you on the screen. Instant access to breaking news, in-depth articles, and financial world updates. All of them at your fingertips. You can download the CNBC-TV18 app now from either the Apple Store or the Google Play Store, or just scan that QR code which comes up for you on the screen.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Hello and welcome to this special edition of Market Masters. Known for their skin in the game philosophy, PPFAS has built a reputation for transparency, patience and conviction-led investing. Unlike most other mutual funds that offer multiple schemes, PPFAS operates with just one flagship equity strategy, which is the Parag Parikh Flexi Cap Fund. This, I imagine, does greatly simplify the choice for investors and simplifies things for the fund team in their investing as well. It's a fund house which is well regarded by investors not only for how they operate but also for their returns.
Indeed, talking about the returns, the Parag Parikh Flexi Cap Fund has returned a CAGR of nearly 18% over a 10-year period, handsomely beating its benchmark. PPFAS was also one of the first to give a lot of importance to international investing. In their flagship fund, they invest 65% of the corpus in Indian stocks, while the rest is invested in global stocks.
Well, today we will be speaking with the fund managers at PPFAS Mutual Fund. So let's welcome in Rajiv Thakur, who is the Chief Investment Officer, Ronan Konkar, who is the Co-Fund Manager, Equity and Head of Research, and Raj Mehta, who is Fund Manager, Debt. Gentlemen, great to have all of you with us here. Thank you very much. And lovely that we can do this at a critical time for the markets. Rajiv, let me start with you. When one looks at what you've been doing, one thing which stands out is the amount of cash that you're sitting on, which is about a little over 20%, about 22% or so. And this is higher as compared to, say, September last year, even December, the end of December 2024. Just contextualize this for us. Does that reflect a view on the markets, a cautious view on the markets, or, this is just a function of market gyrations?
So, we've had a consistent stance that most of the time we don't have a very clear view on the market, especially in the near term. Our objective is to deploy the money that has been given to us in, let's say, 25, 30, 35 stocks And as long as we can find those at attractive valuations and have a reasonable spread over sectors and not be excessively weighted in one or two companies or one or two sectors, we would be happy to deploy. What happens is when the valuations shoot up, as was the case last year, that the opportunities are hard to come by. And that's where the cash starts building up. About the question of the cash going up in, let's say, February as compared to late 24, what happens is when equity prices go down, the cash and money market instruments don't go down in value. So automatically the percentage looks higher. It's not that we have been selling more than we have been buying. On a net basis, most days we are buyers in the market. But given that opportunities are tough to come by, there has been some build-up in cash. After the fall that we saw in 25, of course, opportunities have started coming in, and we are looking at other opportunities apart from the stocks that we already own. And I'm hoping that we'll soon be able to deploy if attractive opportunities come our way.
Rajiv, just one question. Do you think, and this is I know, you don't want to commit yourself in the near term, and that's perfectly understandable, but do you think a price bottom after the correction that we've seen is in place? Price-wise, we've seen that low below the just under 22,000, and that will hold now.
So, see, we could toss a coin and judge whether we are at the bottom or markets will be up or down. But let me give you some data points that I am watching and which would give some inkling of where I see at least on a valuation perspective or from the demand supply side kind of readings that we are getting. So recently there were, I think, money control at this event where there was a panel discussion on the IPO market. Now, a number like 5 lakh crores was spoken about. That is the kind of fundraising that is expected from the market. So this is not a small number. At the same time, regular supply keeps coming because ESOPs get exercised, those employees sell shares in the market, QIPs and rights issues keep happening, the older shares which are issued and which are under lock-in, those come out of lock-in and people sell. Also in terms of the valuation parameters, although we are better valued now than we were, let's say, 3-4 months back, but are we at cheap valuation levels? Answer is no. Is there still froth in large pockets of the market? I think the answer would be yes. So bottoming out will happen, I think, stock by stock and sector by sector rather than the overall market bottoming out. So you could have this strange situation where some stocks look attractive and people will start buying them and they could stabilize or start moving up. At the same time, segments which are very, very frothy could see a sustained price correction over a point of time.
So we'll get to where perhaps we've seen a bottom and where there is still some froth in just a bit. But let me also welcome Ronak and Raj into the conversation now. Ronak, so since you all invest about 35% of your corpus internationally, now the question is, has US markets hit a peak? Chinese tech stocks like BYD or DeepSeek have questioned US exceptionalism. You visited China very recently, I think at the beginning of this year. So first, give us your thoughts on the US mega cap stocks. Have they hit a peak? What happens to US exceptionalism? And then US versus China.
Thanks, Rima. Just to give you a correct data point, the overall exposure for the foreign stocks in the portfolio in FlexiCap fund is about 12%. The 35% limit you mentioned is the overall regulatory limit up to which we can invest. And at peak times, we have been somewhere close to about 30% of the fund. But I think since February 22, RBI restrictions have come across to all the AMCs that we cannot repatriate new funds to invest in global stocks. That percentage has been coming down for us as more and more fresh investments have been going into domestic equities. So that's the reason why the percentage is at about 12% for the international stocks. To come back to your question on the US mega caps, so we own 4 of them. We own Amazon, Microsoft, Alphabet, and Meta. And when we bought these companies, the idea was to get a cross-section of different segments in the US tech space. And if you look at technology as a whole, we would like to invest in technology-enabled companies, and they also have their own technology products that they sell. So here we see digital advertising as a space where there's a very strong tailwind of operations growth over a period of time. And that segment also is taking market share from traditional media in many parts of the world. So that segment has been growing well, and these companies have been demonstrating very well. A large portion of Meta's revenue comes from digital advertising platform that they run. A large portion of Alphabet's revenue, Google's revenue, comes from the digital platform that they run. Also, the cloud computing space has been picking up a lot lately. So if you see the IT demand and enterprise demand from cloud computing has been steadily growing over the past decade plus. And that tailwind also has been helping the top players like Amazon, Microsoft Azure, and Google's cloud business that is running. The other part is even the consumer software or the enterprise software part of Microsoft has been doing well as the number of seats have been growing over a period of time across various products that they sell. The SaaS ecosystem has been growing for these companies as well. Even Google has a business in that regard. And if you look at the overall e-commerce penetration in global markets, especially in developed markets, that penetration also has been increasing over a period of time, benefiting an online retailer like Amazon, which also has a third-party seller business. So these are all great tailwinds to have to participate in over a long period of time. And what interestingly happens is these businesses generate so much cash flow that these cash flows can be deployed into R&D for new research, for any other optionality that we can get, which is not something we are paying for, but we are essentially participating in a successful business which is generating operating cash which can be redeployed into interesting opportunities. So that's what's happening in some of the areas. And you mentioned about China and the ecosystem over there. So my visit was in October last year, and the whole idea was to see how the technology ecosystem for electric vehicles has been growing over there, and got a good small cross-section of companies to understand what is happening. And it's very different from what is happening even in the West, developed markets, and even our country for that matter. So I think a lot of businesses in the short run might underappreciate the importance of R&D, but in long run the R&D really helps to scale up efforts and have a optionality of different businesses that they can run.
Have you invested in China, Ronak?
We haven't been. I think from international investors' point of view, China is a very difficult market to invest in. Not because there's a lack of opportunity and valuations are interesting, but the way outside investors invest in China is through something called as a variable interest entity. And these are holding companies listed out of places like Cayman or any offshore countries. And these are the ways outside investors or non-Chinese investors can invest in technology sector in China. So that is a big challenge because you don't get the direct underlying holding for these companies to invest in. So far it has worked. Over the past 30 years this concept has worked. But it's a very one-off kind of a situation where you're not directly owning something, when you have to buy a piece of paper which says that, hey, this is a way you can invest in a country where the regulations and restrictions on the stock market or some of sectors are very difficult to come by.
Raj, US economy, there is considerable fear of it slowing down. There is talk of fear of a recession or stagflation. You look at the macros very closely. Is that a big risk globally?
We track macros, but we don't track it in such detail. So the top-down matters, but what we look at is evaluate companies on a bottoms-up basis, evaluate whether the investing in businesses makes sense or not. So coming to US, so Fed held rates yesterday and said that a couple of rate cuts will happen this year. But broadly, if you look at post-global financial crisis from 2009 till about 2023, the interest rates were kept very low. They kept printing money. So now that era is over and we are moving into higher interest rate scenarios. We are moving into a world where tariff makes headlines almost every day. So volatility will be there. Global macros may be volatile over a period of time. And having said that, our focus is always on evaluating businesses on a bottoms-up basis, though we keep a view on the macros.
You know, since we are on the subject of the US, and just to sort of finish that point off, Rajiv, you know, 2nd of April, they've said the US is going to hand over a tariff number. And of course, Mr. Trump has complained about high tariffs here in India quite a bit, maybe more than any other country apart from China. I mean, I know you do, you know, it's all stock specific, bottom up, but any sense on what, if the number is a high enough number, what parts of your portfolio are impacted? How do you think about this question?
So I have not been worrying too much about this, Prashant, because firstly, the exact policy is unknown. So one day tariff is on, another day tariff is off, then there are some exemptions and carve-outs, and then again the temper tantrums happen, and then the tariff is back up again. A lot of our companies are either participating in the domestic economy, or wherever they are even exporters. In many cases, they are exporters of services, or we have some exposure, let's say, to generic pharma companies, where these are essential things. So I don't think tariff one way or the other will impact the volumes and pricing to that extent. I think net there is realization everywhere that sudden knee-jerk reactions of very high tariffs is not going to create capacity overnight in the US, and ultimately the consumer will suffer. A lot of this, I think, is posturing, trying to get other people to balance their economies. So you spoke about China. The measures in China are to increase domestic consumption and domestic economy rather than just depending on exports. So Mr. Trump is right in that sense that US cannot be a trade deficit company forever for very large amounts, and ultimately some rebalancing has to happen, and that will happen. But let's say even if tariffs are brought down on something like a Tesla, will it change the auto market domestically very dramatically? Unlikely, because they operate in a very high price segment. So adjustments will happen. Will it be a very different morning on 2nd of April? I have my doubts. I think more or less it will be business as usual.
All right, we'll take a quick commercial break here. So much more to talk about, so that's interesting. Will the 2nd of April or the 3rd maybe, for you know, will it be a very different morning here and around the world? You know, Rajiv essentially saying that maybe not, but interesting perspective nevertheless. We'll continue this interesting conversation with the team at PPFAS Mutual Fund. Take that break. See you on the other side.
You know, the thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing, and then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Welcome back. You're watching our special show, Market Masters, and we're in conversation with the top team at PPFAS Mutual Fund, Rajiv Thakkar, Ronak Umkar, and Riyaj Mehta. Rajiv, you told us earlier that the market doesn't bottom out at the same time, the entire market. Some stocks may have already bottomed out and opportunities have started to come in. So incremental cash, where are you deploying? What is the team buying right now?
So far the buying has been in spaces where we already own positions. So for a long time we have been liking the banking and financial services names. So we have been owning 4 private sector banks, and those have been things that we have been buying. We have been, as would be seen from our February portfolio disclosures, we have added positions in some of the auto names that we have, or the public sector companies that we own, or in the pharma companies that we own. Largely it's been the same names. In December and Jan we added a couple of new names to the portfolio, but those are the places where we have been deploying.
Financials. What about IT, Rajiv? Is that an area you like? It's a bit of a non-consensus view.
So in IT, there are multiple reasons to be concerned about, but at the same time, longer term, these companies have been well governed and have been generating a lot of cash flow, etc. So one of the big concerns in IT has been around this role of AI in coding, and how much of an impact there will be on the number of people required and the IT budgets of various companies. That has been one area of concern. The other area of concern has been this accelerating trend of large foreign companies setting up their global capacity centers in India and directly employing people rather than going through the listed IT companies. And the third, of course, has been this new regime change in the US, and what will that do to visas and offshoring and things like that. So various concerns have been there. However, the companies in India have had a track record of managing various challenging environments. So we are neither too optimistic on this space, nor are we completely down and out. It's somewhat of a neutral stance here.
Ronak, what has made you all incrementally more bullish on autos, PSUs and pharma? These are the 3 sectors apart from financials, which is pretty much a consensus on account of valuations. But what has made you incrementally more bullish in the month of February?
So in the auto space, if you look at the domestic auto market, it's in fact a very small market compared to some of the global markets. In a country of size of India, we have a very low auto penetration. That has been the longer term trend which has been captured by some of the domestic players who have built the manufacturing capability in India. They understand the domestic market very well and what kind of products are being bought by Indians. These kind of products are launched by these companies. Whereas if you've seen many of the foreign companies in India, they've not been able to scale except for one player at a meaningful rate in our country, because it's a very cost conscious and a feature conscious market. And that's a unique thing about India, where if you have built an expertise to make in India, to service in India, and also to provide a new innovative product lineup over a period of time with all the safety and price considerations, I think that is a skill set good with the Indian automakers. That's what made us conscious about the opportunity here. At the same time, the company we added, Mahindra & Mahindra, is not just into passenger vehicles. They're also into farm equipment like tractors. They're also into IT services. As a conglomerate, they have been doing a lot of cleanup over the past from capital allocation point of view. And the growth from some of the segments that they operate is also quite positive. So we own a couple of them. We own Maruti Suzuki and we own Mahindra & Mahindra in the auto space. In the pharma space, Rima, essentially it's a basket of pharma stocks. It's not a sector where we are bullish on a particular company, but the way we have been buying these companies is on the back of the tailwind of generic drugs exporting over a long period of time. And India has a capacity and capability of marketing and selling these drugs across the world. And they also cater to the domestic market, which is also growing at a faster rate. So these trends, if you combine across multiple companies, we don't need to pick a single company where the risk of FDA warnings or import alerts can hamper their profitability. But if you build a basket of such companies who have similar characteristics, good balance sheet strength, capability of marketing across the world and even domestically, I think these companies provide a good diversified way of investing in pharma space.
Got that. Rajiv, you used to own Indraprastha Gas, right? But I think you sold that name when the APM gas allocation rules were changed. But cities still do need gas distribution, right? It's still how are you thinking about that space? Stocks, of course, have corrected quite a bit.
Sure, Prashant. So there have been 2 or 3 points which create a lot of uncertainty. One, of course, is the APM gas allocation. The other was around how much profits these companies should be allowed to make. So there were statements from the regulator and from the minister. So that again creates this uncertainty and overhang. The third important thing, since you mentioned specifically Indraprastha Gas, not that we own it or we have any strong view about it, but again, in the media, there have been statements from various authorities saying they want to convert the transportation market in the National Capital Region to electric vehicles soon, so that the pollution levels come under control. Now, that directly hits at the large CNG market in which this company operates. So I have no idea as to when these things will happen, or is the stock attractive enough to buy or not. I don't have a specific view on that, but there are these few factors which are an overhang on the overall environment.
So much change and so much disruption, right? I mean, you own, I think you do own Mahindra & Mahindra in your portfolio, and they are partnered with BYD for their batteries, I think. And BYD yesterday came out with this 5-minute battery charging system. Time taken equal to sort of filling up your car with petrol or diesel. I mean, so it kind of could be an inflection point. But again, I mean, what does that do? When is the question? What does that do to industries like, refining? And so lots of implications which will play out in the coming years, Rajiv. Do you think the rate of change in terms of disruption has picked up quite a bit?
Yeah, I think the only constant will be change and at an accelerating pace. So we have seen this in the way people transact. So the whole UPI and the fintech ecosystem that has come about, the e-commerce, quick commerce, the gig economy, ride hailing, transportation of energy, transportation shifting from internal combustion to EVs, the energy use itself, the pickup in solar and wind over the fossil fuel led power generation. So plenty of change. As you rightly said, one will have to arrive at judgments in terms of which are the companies which will be able to make the transition and which are the companies which will fall by the wayside, and at what pace the transition will happen. Being too early also can be damaging, and being too late also can be damaging. So one has to time the transition well.
Raj, the optimism on banks also stems from the regime change at RBI, the recent liquidity bazooka, expectations of rate cuts. So valuations aside, what are you all expecting from the RBI and the macro indicators?
So very difficult to predict what the RBI will do, but broadly, if you see the measures that they have taken to improve liquidity, be it open market operations or be it dollar-rupee swaps, from an inverted yield curve, we have moved to a flatter yield curve now. So the shorter-term rates have moved down a little bit. But going forward, we expect the short-term rates to move down a little more, whether it will happen in the next monetary policy or after that. But in the calendar year 25, we expect the short-term rates to be softer than where they are right now. And it will move to a more of a normal yield curve that it used to be 2 years back. So that's where we see the interest rates moving.
Okay, well, more questions, but as always, we are positive of time. Raj, Ronak and Rajiv, thank you very much, all three of you, for sitting down with us here at CNBC-TV18. An interesting conversation. I hope the one of many that we will have over the sort of coming months and years as we track the changes in many of these industries that we discussed. Thank you very much for being here on this program. We'll take a quick commercial break here. We continue with the regular programming on the other side. Stay tuned.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. It's another session where the equity markets are doing very well. In fact, all of the indices, the Nifty Bank, the mid-cap as well as the small-cap indices have all built onto the gains that they've been seeing since the start of the week. Quite a lot of news flow, and on the back of that, you're actually seeing quite a lot of price action, and price action even today is quite strong. First on the list, have a look at all of the large cap names, the entire large cap pack. Also remember, tomorrow there is a event of FTSE, so that's also something that will keep Indian markets in focus. The wire and cable company, remember, heightened competition, the entry of a new player now. First it was the turn of the Aditya Birla Group, now the Adani Group too has said that they would be looking at entering this particular space. The entire pack, all of them, these stocks have seen significant selling pressure today. The other stock in focus, remember, is Paytm. There's a note come in, and this particular note from Jefferies has gone ahead and reacted to the government's incentive of close to 1,500 crore for low-value UPI P2M transactions, and Jefferies at this point of time believes that it is almost at half of what it was last year. On the back of that, Paytm today seeing significant selling pressure. Voltas yesterday had an analyst meet. There was a lot of anticipation around the analyst meet that was being held. However, Voltas today is seeing a bit of a cool-off after the analyst meet. And lastly, Z Entertainment seeing some buying today. CLSA has come out with a note. They find risk reward quite attractive at 8 times price earning. They believe the valuation right now is at rock bottom valuations. But moving on, we will have to talk about the entire cable and wire space. Winnie joins in on the back of the rising competition scene. Winnie, what are you making of this entire development?
So absolutely, Vivek, what we're seeing is that the rising competition in cable and wires is continuing, because now, obviously, just yesterday what we saw is Adani Enterprises has said that they formed the JV for this cables and wires foray of theirs, and this is with Kutch Copper, which is the 100% subsidiary of Adani Enterprises. Now, this is in JV with Pranitha Ventures Limited, and they are opening up another company which is named as Pranitha Eco Cables, which is a JV of both these. Now, it's a 50-50 JV. As of now, we do not know how much investments Adani Enterprises is going to be making into this, JV as well. What is the requirement in terms of capex? All we know is that they're going to be engaging in the business of manufacturing, marketing, distribution, buying, selling of metal products, cables and wires. So that is something that we know that there is some bit of a foray. But now what exactly are they going to be doing is something we're watching out for. But do not forget, just in the month of February, we had seen Ultratech Cement making and announcing its foray into the cables wire segment. They are coming with full-fledgedly. Now, they also spoke about, having a capital expenditure of 1,800 crores over 2 years for this cables and wires segment, and they are extending their presence, in terms of construction value chain, was they spoke about. So there is increased competition coming in, and in the last 1 month, whether you look at any of these stocks, KEI, Polycab, Finolex Cables, RR Cable, all of them have seen a fall in the range of somewhere between a 10% to around a 17 to 19% fall that we've seen in the last 1 month. Now, what analysts are saying, they believe that this Adani Group entry, especially after the Birla Group entry, will materially increase competition and competitive intensity into this segment, as well as a possible impact that could come in terms of the EBITDA, as well as the return ratios of these incumbents. That is something that they're watching out for in terms of an impact. But clarity in terms of what is the investment being made by Adani Enterprises, that is something to watch out for, but surely an increase in terms of competition.
Thank you so much, Winnie, for joining us and giving us a sense of what exactly has transpired as far as the cables and wireless space is concerned. But also a good time to welcome Rima. Rima, that was a very good conversation that you all had with the team of PPFAS. What are the key takeaways? And also wishing you a very happy belated birthday.
Thank you very much for that. Pretty much echoing what Ramdev had said, that the market doesn't bottom out at the same time. Some stocks may have already bottomed out, some may be in the process, but opportunities have started emerging. And they've been big believers in banks. 4 private sector banks is what they own, but incrementally, they've been buying, some of the automobile names. They have Maruti, M&M, Pharma as a basket they've been buying, and some, PSU names in the month of February. They also shared the view on the global markets because they have about 12% of their corpus invested in US tech stocks like Meta, Alphabet, etc. But let's get back to our own markets. Z Entertainment is in focus on the back of a CLSA note. Pamakshi is here with the details.
Well, good afternoon, Rima. Z Entertainment is in focus on the back of that note that came in from CLSA. They have an outperform call on this counter, target price of 170, which implies a significant upside from the current levels. The stock, in fact, has seen a slump of almost 55% after the deal with Sony was called off. And in fact, right now, the stock is trading at rock bottom valuations, that is 8 times PE as per CLSA. They believe that the advertising revenue growth will be re-rating the stock. Z is India's number 2 TV network and is also at the same time ramping up its OTT, that is the Z5 business. As far as the EBITDA margin is concerned, they believe that that has already widened by 9 percentage points to almost 16%, and they also see further upside here. They're expecting another 6 percentage point expansion to 22% by FY27. Now, keeping in mind that there could be a 6% ad revenue growth, they could deliver nearly 22 to 33% EBITDA as well as PAT CAGR from FY26 to 27. In fact, when we talk about Z's valuation as a whole, when we look at Z's market cap to sales, stands at 1 times. This is coming in at a 60 to 80% discount as compared to the RIL Disney JV as well as Sun TV network. So therefore, the risk reward in their opinion is highly favorable, and therefore they've given a big thumbs up to Z Entertainment and the stock is surging in trade.
Thank you so much, Vamakshi, for joining us. And Z Entertainment, after a while, you're seeing some coverage coming in the stock high by over 2.5%. But let's now shift focus to the commodity space. Manisha joins in, and today we are focusing on gold.
Well, the current year has seen 16 days when the gold prices have hit all-time highs, and we've seen $3,058 an ounce onto this one. When you look at the Indian markets, well, we've done 89,000 rupees at 10 grams and very close to that 90,000 mark. Of course, GST and making charges are yet to be added to that price there. But the markets are looking at a global economic slowdown, recession concerns as well, with the US Fed suggesting that 0.5% of an interest rate cut is what you could see by end of this year, also has seen support in case of gold. And then it is very strong investment buying that you have seen come in for gold via ETFs. We've also seen gold bonds, gold funds do quite well in the international markets as well. So when you look at the overall prices, well, we started this year with 2650 and we are trading at around 3050 right now. So that has been a $400 of a jump up coming in for the gold prices. And this year, we've gained 2% on week, 4% on month, and 17% of gains in this year itself. And that adds up to 40% of gains in the last 12 months. Well, importantly, even as we are trading above $3,000 an ounce, all global banks and brokerages have now revised their gold outlook to much higher levels than these. You have UBS talking about 2,900 as an average for this year, but Bank of America, Goldman Sachs, BNP Paribas, ANZ are all talking about $3,100 an ounce of an all-time high coming in gold prices sooner than we think. Cities talked about 3,200. De Beer Group talks about 3,300. 3,300 is a level that Saxo Bank also has put out as an expectation. And Macquarie is the most bullish of it all, talking about $3,500 an ounce coming in the next 12 months.
Thank you very much for that. Get into a break. As we do that, here's a reminder. This India's business news leader is now just a click away, introducing the all-new app. Get instant access to all our breaking news, our articles, financial world updates at your fingertips. So don't wait any longer. Download the CNBC-TV18 app now from the Apple Store, Google Play Store, or you could just scan the QR code on your screen. Welcome back. It's a steady and a strong morning of trade. Benchmark indices holding with a gain of more than about 0.5%. The Nifty's crossed the 23,000 mark for the first time since 19th of February. The Sensex is inching closer towards 76,000 with a 450-point gain, and the Nifty Bank hit the 50,000 mark earlier today, but now is just shy of that level. All courtesy the rally that we're seeing across global markets. U.S. markets continue to see a relief rally after Fed stayed on their forecast for 2 rate cuts in 2025, but they also said they see higher inflation and slower U.S. economy due to uncertainty tied to Trump tariffs. CNBC's Steve Leesman has the fine print in the Fed decision.
It kept rates unchanged, 4.25% to 4.5% as expected, and that's despite concerns about higher prices coming from tariffs. It emphasized the uncertainty in the outlook from these changing policies from the Trump administration, but it still forecast rate cuts this year.
If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
Notice no talk of hikes there. Fed officials in their projections raising their core inflation outlook this year by 0.3 to 2.8, most of which is linked to higher tariffs. They lowered the growth forecast by 0.4. That's down to 1.7%, exactly, by the way, matching the CNBC Fed survey. And yet it kept that forecast for 2 rate cuts this year, with the median forecast seeing a 3.9 by the end of the year from the 4.37 now. The takeaway is that Powell made clear he would be watching closely to see if tariff raised prices only one time or became a broader inflation problem. He's pretty cool about it. He basically said he would not be taking any preemptive action. And Mike, I just want to get on a little news right here that I got while I was talking there. Megan Casella, our Ace Washington reporter, has confirmed a Washington Post report where we found that one White House official tells me the total value of goods hit with tariffs on April 2nd could be, quote, in the trillions, but nothing is for sure yet. So there's this idea that there is, as you know, a massive additional wave of tariffs coming. Powell knows about it, but he was pretty cool in the face of it.
Well, with the new policy decision coming in, investors were on the watch for Chair Jerome Powell's comments on tariffs and its effect on inflation. Let's listen in.
You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
Get into a short break. On the other side, we'll get you a detailed analysis on the Rupee rally. Stay tuned.
I thought, I should leave. I should go back to India. We will figure out what is it that we will do. There was no idea for free will. So I came. Rahul also left at the same time. Then we spent almost a month or 2 to figure out, okay, now what next? So it always started from the family, then solving some,
the
consumer problems.
The business plan came later. First,
Always.
But how do we ensure that we're in the
That
same?
has always been the priority. What you see in front of the label is very different than what is on the back of the label.
And then very different from what's actually inside the bottle.
Exactly. I guess so far we are in some 2,000 stores. In next 2 years, we can easily target anywhere between 15 to 20,000, right? When you go deeper into any category, you also understand the good, bad, ugly side of it. It's a misconception, to be honest. I think the percentage of spend required for R&D eventually is much lesser that you need for your marketing. Investing in R&D is much better ROI than always doing it in marketing.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning.
Welcome back to Trading Hour. Well, the Indian rupee has rallied to a 2-month high as the dollar has remained soft, and India's likely current account surplus this quarter has led to covering of short rupee positions. Lata is here with more details.
Well, I can rattle out statistics on rupee's strength. I mean, would you believe it a month ago that we would be talking like this? It is at a 2-month high, plus it is the 6th straight day of gain. If you only looked at today's gain, at its height, it was a 0.25% higher. If you looked at last 7 days, it is 1% higher. And if you looked at from February 10th lows, when it went to 87.95, the rupee has gained 2%. Today, the high was 86.20 to buy a dollar. Now, this sentiment change is both because of a sentiment change in the dollar and the rupee. Dollar has been softening from the mid-January levels of 110 dollar index. That's partly because euro has strengthened, especially after the last week of February and the German deficit. You've seen euro strengthen and the dollar index go to 103.5. Plus the Fed saying that they will persist with the 2 rate cuts has kept sentiment on the dollar softer. On the other hand, sentiment on the rupee has diametrically changed, especially after the February trade deficit indicated. I mean, the deficit was like a 4-year low. Plus, if you counted surplus, it was the current account surplus, or rather a trade surplus, giving the a clear indication that in Jan, Feb, March, we will report a current account surplus, which means more rupees, more dollars coming in than going out. Plus, you can see the FPI dollar outflow also thinning out. It's not yet zero every day. Now, that is leading to all the rupee shorts covering. There are all these corporate treasuries which take positions. They are in a hurry covering their rupee short positions or their dollar long positions. Plus, exporters are selling off their dollars in a hurry. They were probably expecting 87.5, etc. And now by March end, they will perhaps not get that kind of money. That flood of dollars is coming. Reserve Bank in a very comfortable position. Even last week's data indicated they had bought dollars, to prevent appreciation. And even today, the expectation is that they are buying dollars as well as taking old, allowing the old swaps to mature, which means they are selling dollars. They're buying more than they're selling. That keeps RBI in a comfortable position. All told, it looks like the rupee rally is here to stay. And if it is tapering off, then it's more because it is the Reserve Bank which is buying dollars.
Thank you very much, Lata, for explaining that. But it's 2%, right? Appreciation over the last 1.5 months now. But let's move on. Vedanta's Anil Agarwal promises to reduce debt by $3.5 billion by 2027. Ready to exit steel business at the right price. Says prices of aluminium, zinc are seeing premiums like never before. And he vows professional management will run the companies after the proposed demerger and not the family. That's an exclusive.
75% of my personal wealth has been pledged for giving back. This company is not going to run by a family. This company is going to run by top professional, top mind for the country on the having the best of governance. And we have to go through this because India has not seen this kind of ventures, this kind of development, and the trust is building. We have never seen premium on the aluminum what we see today. Highest premium in the zinc is the highest premium. Or gas, can you believe that gas in India you can sell at $10? And same thing on the oil. So it is a time, it shows that how much is the consumption is increasing in India of this metal. If we get our price, we will definitely consider. But as it is, the company is doing extremely well and they are making cash profit and they are very comfortable. But definitely, I would like to put that effort to my other business. If we get a right price, we might sell.
Okay, well, that brings us to a close on Trading Hour. From the entire team, thank you for watching.
India Business Hour drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
You know, the thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Stocks have seen a broad-based rally with heavyweights leading the charge after the US Federal Reserve holds on to its interest rate outlook. IT and auto are the big gainers, while industrials and power are the big drags.
The Vedanta Group will trim $3.5 billion of promoter entities debt by FY27, says Group Chairman Anil Agarwal, adding that he will sell the non-core steel business if it fetches the right price, even as he is upbeat on the aluminum and zinc verticals despite the possibility of US tariffs.
After Aditya Birla Group's Hindalco, now Adani Enterprises has ventured into the cables and wires business with a joint venture. Analysts see the entry of big guns impacting growth and profitability of the incumbents, stock down up to 15%.
The Ministry of Heavy Industries has asked Ola Electric to explain the mismatch in the sales numbers reported by it for PLI benefits and those reflected in the vehicle registrations data. The RTO Mumbai has also carried out inspections in its showrooms.
And the Indian rupee rallies for the sixth day in a row, gaining over 1% in the past week and 2% from its all-time lows as a likely current account surplus this quarter, and slowing FPI outflows turns the sentiment on the currency.
It's a strong session of trade which continues with a rally accelerating on the Nifty as well as the Sensex. I'm Mangalam Malu, with me Hormas Vatakia. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. Looking good for the market, 160 points higher on the Nifty, and this despite lesser contribution coming in from the Nifty Bank this time around, the index which is atop your head, Hormaz. And that's because, the outperformance today is led by the IT pack, which had been earlier underperforming. Maybe better prospects coming in from the globe in terms of no change from the Fed has supported the cause of the IT index after the underperformance that we've seen. No incremental fears, so to say.
Indeed, and looking good, right? There was some bit of a hiccup in the first half an hour of trade, but then it's been all hunky-dory for the markets. The dip that came in, that marginal dip, was very quickly brought into for the index. 160 points higher on the Nifty, now 23,070, and that means there are 1,100 points now from the lows that we made on the 4th of this month. So in 11 trading sessions, the index is up 11 points. And of course, the stocks that are doing well for themselves in today's session, yet again, Shipping Corporation of India was up almost 8 to 10% in yesterday's trade as well, up another 12% in today's session on the Nifty 500. That's the top gainer. The other one is KC International, that's locked in a 10% circuit. Some of the others that are doing well for themselves include the likes of Garden Reach Shipbuilders, building on to yesterday's 20% surge as well, with another 4.5% advance there, 5% higher now on Garden Reach. The other pocket that is doing well for itself today is the city gas space, and that is on the back of a fresh brokerage commentary that has come in, be it the likes of IGL, MGL. Sudarshan is joining in with more details on this. Sudarshan, good afternoon.
Good afternoon, Hormaz. So Axis Capital has today come out with a note, and on the back of that, you are seeing most of the city gas companies are trading higher. So it has initiated coverage on MGL with a buy call, and target here is 1580, and has upgraded IGL to buy, and target for the same is 224. But it has initiated coverage on Gujarat Gas with a reduced call, and target for the same is 390. Some of the catalysts as per Axis Capital: first, all these companies have been taking aggressive steps towards the expansion, and second, CNG economics continues to remain favorable if you compare with petrol and diesel. And third is addressable market size has increased to 55% of, if you look at the total volume of the PV industry, that is passenger vehicle industry, and government policy also remains supportive. So amongst all these three city gas companies, Axis Capital prefers those companies which have higher exposure to CNG, and those companies are largely MGL and IGL, and that's the reason they are bullish on those two.
Take that point, those stocks doing well. In fact, as we speak, a bunch of stocks doing extremely well, Sudarshan. If you look at Geo Financial Services, that has been an outperformer all through this week, continues to do well on that counter as well. The next Nifty entrant, that is, so Geo Financial Services comes up for you. Hindustan Copper has taken a leg up, and most of the gains have come by in just the last 15 minutes or so. Vertical up move is what we'll see. The intraday chart would so suggest on Hindustan Copper. And the other one which is actually seeing some traction is Pidilite. Pidilite has been, relatively muted over the last two trading sessions. Remember, the company held an analyst meet 2 days ago, and now perhaps, we are seeing some bit of pickup on that counter. So we'll watch out for all of this as well. But amidst the stocks which are doing well, there are a bunch which are not doing too well as well. And they primarily belong to the cables and wires sector on the back of possible rising competition, the entry of conglomerates. Vinny joins in with details. Vinny, we saw it first when Ultratech made its announcement, And now you have Adani's looking at the cables and wire space as well.
Absolutely. So now Adani is also looking at this cable and wire space, and now right now what they've done is they've just signed a JV, and they've formed a JV with Pranitha Ventures Private Limited. The JV is a 50-50 JV, which we'll call Pranitha Eco Cables Limited. This is with the 100% subsidiary of Adani Enterprises, Kutch Copper Limited. Now, when you're looking at it, what they've highlighted so far is that they will be engaging in the business of manufacturing, marketing, distribution, buying and selling of metal products, cables, as well as wires. So that is the latest update that we have. We do not have any amount of the expenditure that they'll be making or the investment that they will be making in this front as of now for Adani Enterprises. But like you mentioned, we've seen that increase coming in terms of competition. And Ultratech Cement just last month had announced about their foray into cables and wires. They've announced a capex of around 1,800 crores over the next 2 years. So yes, because of this, we've seen all these stocks in the last 1 month have seen a significant fall coming in. KEI down 17%, Polycab down almost 10-11% in the last 1 month, and we have to factor in today's fall as well. That is also that has also seen a sharp fall. Plus Phenolics Cables, RR Kabel, all of them seeing a sharp fall in this last 1 month. What analysts are saying that obviously there is one more entrant coming in, so some bit of a competition increasing, and that is causing that jitteriness for all these other cables and wires, and a possible impact on the EBITDA front as well as the return ratios for these incumbent cable wires companies is something that analysts are watching out for. The clarity in terms of the amount of investment that Adani Enterprises will be making and what sort of a business that they're looking from this cables and wires foray is something that we still have to wait out for, but some bit of a pressure on the back of increased competition.
It's almost deja vu, right, for all of these companies just in a matter of a few weeks. Now Ultratech earlier and now Adani, most of these stocks taking a bit of a battering in today's trade.
You say deja vu, and as entrants enter, the investors will be like, deja who? Who else is coming in? There is Ultratech, there is Adani's. Similarly, in the paint sector as well, you had Birla's announce the foray, and then thereafter you had a bunch of other companies looking at entering paints as well. Pidilite, we just spoke about, they have a paints business called Haisha, and at the same time you have AkzoNobel, which is on the block. So who is going to buy them? So from deja vu, we'll go to deja vu.
Oh, indeed. It is deja vu and deja vu, right? For the investors, of course, it's not a pretty picture when it comes to this rising competition and the resultant impact on the stock prices. In fact, earlier today, we had a conversation with DSP Mutual Fund's head of equities, Vineet Sambre, who drew a parallel between the paint segment and the cables and wire segment, as Mangalam was just alluding to, with the new entrants entering the sector.
When we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks I think corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large.
All right, so the opportunity is going to be large. He says that maybe, perhaps, because of the price correction that we've seen at lower levels, there could be attractive opportunities as well. Because unlike the paint industry, in the cables and wire industry, the price damage has happened ahead of the market damage itself. So we'll keep an eye out on opportunities out here. Though, time for a short break. On the other side, we focus on the consumption space. Anuj Sethi, who is the senior director at CRISIL, joins in as they expect the FMCG sector to rebound in terms of growth by about 100 to 200 basis points. 6 to 8% growth in FY26 versus 5 to 6% that the companies are expected to post in FY25.
I thought, I should leave. I should go back to India. We will figure out what is it that we will do. There was no idea for free will. So I came. Rahul also left at the same time. Then we spent almost a month or two to figure out, okay, now what next? So it always started from the family, then solving some,
The
consumer
business
problems.
Plan,
or
the business plan came later. First,
Always.
was about how do we ensure that we're in the
That
same.
has always been the priority. What you see in front of the label is very different than what is on the back of the label.
And then very different from what's actually inside the bottle.
Exactly. I guess so far we are in some 2,000 stores. In next 2 years, we can easily target anywhere between 15 to 20,000, right? When you go deeper into any category, you also understand the good, bad, ugly side of it. It's a misconception, to be honest. I think the percentage of spend required for R&D eventually is much lesser that you need for your marketing. Investing in R&D is much better ROI than always doing it in marketing.
साथ
165 points on the Nifty. A lot of these FMCG stocks are actually doing well. So, I mean, not directly FMCG, but Titan, which comes under the consumption space, is doing well. It's been an underperformer, but, the stocks move to the high point of trade. Higher gold prices typically do well for jewelry companies because people tend to prepone their purchases in anticipation of further hikes in gold prices itself. In fourth quarter, you typically have the wedding season and anticipation build up to Akshaya Tritiya as well. We do have Britannia, which has moved to the high point of trade, as have other FMCG consumption names which have moved higher too. So the FMCG index actually comes up for you on the screen. Speaking about the consumption space, in a recent note that has been released by CRISIL, they expect growth of the FMCG sector to rebound by almost 100 to 200 basis points versus FY25 and FY26. They expect 6 to 8% growth versus 5 to 6% growth in FY25 itself. So to discuss the rise of this and the retail sector in quick commerce in particular. Anuj Sethi, who's the Senior Director at CRISIL Ratings, joins in. Anuj, if you could give us a sense of what were the inputs that you, took note of before making this projection, and what is this based on? Is it just a lower base, or is it something incremental that is coming by for the sector as well? And the 6 to 8%, what would be the outperformers? Which, according to you, would be the categories that would grow upwards of 8%, and which would be the ones which would grow below 6%?
Yeah. Good afternoon, and thanks for having me. We expect the recovery will be driven by both urban demand as well as rural demand. And we know that rural demand has been outpacing urban demand, in the last 3 quarters or so. So the factors which will help some recovery in urban demand should be the moderating food inflation, easing interest rates, and also a series of measures which are announced in the union budget to encourage spending, and therefore we expect some benefit to come to urban demand. And rural demand should continue to grow steadily thanks to the allocation which is made for welfare schemes, expectations of a normal monsoon, and expectations that there'll be a reasonable hike in the minimum support prices of crops as well. Having said that, this year our expectation of 6 to 8% growth is based also that there will be some recovery in volumes. It will largely be volume-led, about 4 to 6%, and the balance growth will come through realization improvement. Some players have taken some hikes to pass on the raw material inflation seen in certain categories, whether it is tea, coffee, copra, wheat, palm oil, and of late sugar and milk also prices have gone up. So our expectation is based on that. And the second part of your question as to which categories will do better than others, there are 3 categories, basically food and beverages, which is the largest, almost 50% of the market. And then we have personal care and home care, which is split almost equally, the balance 50%. Of these segments, we expect the food and beverages and personal care will be posing, mid-single digits growth, you can say, while the personal care, the home care segment, which did well last year as well, that should see higher margin closer to 10% in the road ahead.
Right. Anuj, good afternoon. Thank you for joining in. You mentioned that you're expecting this growth to be volume-led. Are you seeing something like that emerge on the ground, at least in the current quarter? What do you anticipate from these companies going into the 4th quarter as the results start trickling in anytime now?
Yeah, we expect some amount of volume recovery. It's already been seen in the rural side. While one more trend, what we have noticed is the larger packs are being less preferred. But the mid-size packs and the small packs, they are seeing quick pickup. And that has also been seeing the fact that quick commerce is growing pretty fast, and it caters largely to the mid and small size pack segment.
Right. Now, what's interesting is that you speak about some price increases coming in on the back of price hikes by the company. I would like to know your thoughts on whether there would be premiumization in this space as well. So if there was an element of mix change and that aids to the revenue, because that would then directly flow down to the operating profitability, which you expected to be flat, 20 to 21% after a 50 to 100 basis points decline in the last fiscal.
Yeah. So some amount of premiumization will happen in certain categories, say like in biscuits, also in personal care and home care. But that will be in very select categories. There again, we are seeing introduction of small packs, which is happening. As quick commerce is expected to grow pretty fast. It already grew at almost 30% last year. A similar sort of growth expected this year as well. So some amount of premiumization will help, but that's built into that 2% realization improvement, which I said.
So does this quick commerce going forward, expecting it to grow at a similar pace, but as competition intensifies within this, do you expect that growth to sustain? And does quick commerce then become the fulcrum of the entire sector when it comes to distribution and thereby ensuring growth?
See, ultimately, quick commerce companies also need to make money. So it will be a balanced sort of thing as they capture market share. Things will settle down, as we move along. But it doesn't take away the convenience, of ordering and having the goods delivered within a short time. So I think both models will coexist. The existing models will coexist along with quick commerce. But the focus will also be of some of the FMCG players to have a greater share of pie in the quick commerce trade as well.
What we're trying to understand from you is that, and this is something that we spoke with PwC this morning as well, where they said quick commerce is growing, but it's growing, it's not growing the pie as much. The pie is still likely to grow in 6 to 8% sort of levels as well, as per your expectations, closer to 10% for the retail industry, as per PwC's expectations. In that, quick commerce is likely to gain market share from traditional trade. So in that sense, is there a benefit of quick commerce for the sector on the whole, where it is not contributing as much to the growth, but it's just substituting one channel for the other?
That's true. It's substituting one channel for the other at the moment. But see, as of now, quick commerce is largely restricted to the metro cities, the urban areas. That's the reason why, it's not adding to the overall pie. But, it's more a convenience type of shopping, if you were to call it that.
But is there any, what do you call, case for quick commerce to continue to grow at this pace even beyond tier 2? Because there are challenges, right? A lot of people who are in the quick commerce space say that tier 1 and metros are where they see maximum traction. Maybe the economies of scale may not be as favorable when they move beyond. So then the expectation of the consumption basket improving by virtue of quick commerce moving beyond metros stands questioned.
Yeah, it can be a more metro-centric sort of arrangement, if I have to call that. Whereas the traditional channels plus the other e-com channels, they are also spreading their baskets, wider into more pin codes, if I have to call them. In fact, e-commerce has a significant amount of penetration in pin codes, even more than a traditional model, I would say. So all models will coexist, but quick commerce is more going to be a metro-centric sort of model.
All right, final question before we let you go. Is there any particular specific trend that is calling out to you right now amidst all of that you're seeing? Any micro trend which you believe needs to be watched out for? And from a risk standpoint, what are the risks to your thesis of 6 to 8% growth?
Right. See, one more trend, what we have been observing is that the traditional FMCG companies are also looking at increasing adoption of digital channels, and they are targeting acquisition of D2C brands as well. Besides, of course, what I said, the trend of lower price packs to counter competition, which rose significantly in the last couple of years, especially in the rural side. There were a lot of regional brands which performed better. So I think that is one. Second, the risk to the forecast is obviously if we have a subpar monsoon, I think the rural demand, which accounts for about 42% of overall demand, I think that could take somewhat of hit. And then there could be down trading, again, going back to regional brands, etc. I think that's the largest risk we see.
All right, Anuj, thank you so much for sparing time, joining us with your outlook on the FMCG sector, and looking forward to having you more often on the platform. There's the interaction there with Crystal on the FMCG sector. We take a short break. We take the market at the highest point of the day now, the Nifty nearing 23,100. Somil Mehta of Mirae Asset Sharekhan joins in on the other side with a quick chart check and some trading strategies. Stay tuned.
Welcome back. At the high point of trade, as we were expecting this morning itself for the momentum to accelerate, and the mid-cap index, which was underperforming by a bit, at the start of the show, has now also picked up pace. It's up around 2/3%, and this despite, the not so big contribution coming in from the Nifty Bank today. So if you look at the key indices, we have the Nifty as well as the Nifty Bank in focus. What's contributing the most on the way up today is the IT index, which is up around 1.5%. There were, some issues with the mid-cap and the small-cap index which moved off highs. But through the day, we've seen more stocks advance than the number of stocks which have declined. So if you look at, the advance decline ratio, again, after a bit of volatility in the first half of trade, post 11, it has moved back to looking like a train track itself. And that's positive for the market. Both the Nifty as well as the Nifty Bank are now above their 50-day moving averages. The next key level to watch for the Nifty Bank would be above 50,000, which would be, the 100-day moving average. And the same for the Nifty is closer to 23,500. But that's far for now. Today, it's a Thursday. It is the weekly options expiry. So the strategy that we're talking about today, Hormaz, is called a strangle, where you sell a call and a put at different strike prices. The sale is taking place on the 23,000 put, with 18 rupees premium, telling you just below 23,000 is strong support coming in. But on the way up, the 23,100 call writers are fairly active as well for a premium of 18 rupees, telling you that if the Nifty goes beyond the 23,120 mark, there could be some bit of supply coming in. But the way the market is positioned right now, it seems like there may be a bit of a melt up beyond that range itself. Why do I say that? Because the Nifty, after this up move, is still at 2380, and we are seeing, in the money puts being written. 23,100 put has seen a bit of writing. So the street believes that the market would move much higher, and this in the money put would go out of money. And you've also seen some punt buying at the 23,250 call. 23,250 call is currently available for 1.85 rupees, 2 rupees. So people want to take that punt for the last 1 hour or so, whether the market moves higher. If it moves higher towards that, the 2 rupees becomes 3 or 4 rupees, them gaining a 33 to 50% in just, one trading session in a matter of couple of hours as well. But these are, remember, high risk punts that option buyers are taking. A lot of short positions added on names like KEI Industries and Havells. We've seen weakness in the cable space itself. Some long positions added on Bharat Forge, and we have Macrotech developers as well, seeing some long positions being added. Just keeping an eye out on Manappuram and Polycab. Manappuram, we pointed out yesterday, may exit F&O ban. That happened, and now today the chances are it may re-enter F&O ban. And with the kind of open interest that we've seen on the short side on Polycab, chances are this stock as well enters the F&O ban. So the cable space is in a bit of a worry spot, with Polycab likely to enter the F&O ban space.
Since you mentioned strangle, a pertinent question to ask is, are the bears getting strangled in this market right now?
If the Nifty sustains above this 23,100 mark for a bit, the call writers or the bears at that point in time may get strangled, may get squeezed.
We'll ask that question to Saumil Mehta as well of Mirae Asset. Sher Khan is joining us. Saumil, good afternoon. Thank you for joining in. 1100 point recovery now on the index in last 10 or 12 trading sessions. Do you expect some more consolidation here, or do you expect the index to move higher now to 23,500? And also couple that up with your stock recommendations as well.
The momentum is definitely very strong, and I'm not expecting any consolidation or maybe a intraday sideways movement, but not like a correction or anything. Nifty is trading about 20 and 40 daily moving average. The next target is 200 daily exponential moving average, which is around close to 23,400. So that's my target. Support would be 40 daily exponential moving average, which is 22,880. So that will be a very crucial support going forward in the very, very short term. And yes, I'm expecting the momentum to continue because FMCG, IT, and auto, all oversold sectors have started moving up. That's very good news at this point of time, because if the markets, if Nifty has to move up 500 points from here, the oversold stocks has to move up. So yes, looks good. My stocks would be Asian Paints. That'll be my first pick. Stop loss would be 2240 and target would be 2450. My second pick would be from the IT space, mid cap IT, Bsoft, Birlasoft. Stop loss would be 395 and target would be 445. And my third pick would be SBI Cards. Stop loss would be 835 and target would be 890.
All right, Saumil, thank you so much for sparing time, joining us with your views on the index and on specific stocks as well. Take a short break, more on the markets on the other side. Stay tuned.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business.
Welcome back. Nearing 23,100 now is the index, and it continues to build on to those gains, almost 200 points higher now on the Nifty. Some of the stocks that continue to do well include the likes of Fine Organics, that's up 5.5%. Capital market linked names like Kfin Technologies is up almost 6%. Bharat Forge has sprung up into the list of gainers, 4.5% higher on that stock as well. So Bharat Forge having a good day. At the highest point of the day now is the stock. Also doing well is GSPL, Gujarat State Petronet, is up 4.5% in today's session. Mangalam highlighted Titan at the start of the trading session, 3.75% higher there as well. Some of the stocks that are not doing so well though, other than the wires and cables companies, include the likes of CAMS. We had the management today on CNBC-TV18 where they spoke about the road ahead for the company, 3% down on that stock. Tanla Platforms, after a gravity-defying surge over the last few trading sessions, is down 2.5%, seeing some bit of profit booking. And Paytm, of course, down 4% after a sharp surge in a couple of days earlier as well. But Vedanta, that was the big interview that we had yesterday, where Chairman Anil Agarwal has promised to reduce debt by $3.5 billion by 2027. He also said that he's ready to exit the steel business provided he gets the right price. And he also said that the prices of aluminum and zinc are seeing premiums like never before. And he also vowed that professional management will run the companies after the proposed demerger comes through, and not the family. That is an exclusive. Listen in.
75% of my personal wealth has been pledged for giving back. This company is not going to run by a family. This company is going to run by top professional, top mind for the country, on the having the best of governance. And we have to go through this because India has not seen this kind of ventures, this kind of development, and the trust is building. We have never seen premium on the aluminum what we see today. Highest premium in the zinc is the highest premium. Or gas. Can you believe that gas in India you can sell at $10? And same thing on the oil. So it is a time, it shows that how much is the consumption is increasing in India of this metal. If we get our price, we will definitely consider. But as it is, the company is doing extremely well and they are making cash profit. And we are very comfortable, but definitely I would like to put that effort to my other business. If we get a right price, we might sell. We have a full plan that we will be completely reducing our debt on the parent company in 3 to 4 years' time. This year, 25, we are going to reduce $1 billion debt. 26, we are going to reduce another $1 billion debt. And 27, we are going to reduce $1.5 billion debt. I have always said two things. In India, very, very important is drill, baby, drill, dig, baby, dig. That's what the whole world is saying. If you look at the President Trump, or you look at Trump, and I was the one last 25 years. 25 years consistently, I have not changed my business.
All right, interesting conversation out there with Anil Agarwal of Vedanta. He said, dig baby dig, much before drill baby drill from Donald Trump. But with that, we'll slip into a short break of the news that the market is doing extremely well. And we got some good news other than the market as well, which is the CNBC-TV18 app, which is live for all you viewers. It's India's business news leader, just a click away, which is this app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips itself. You can get this app from either the Apple Store or the Google Play Store. If not, then just scan this QR code, which is right on your screen.
On YouTube at CNBC-TV18, weeknights at 7 p.m.
You know, the thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Welcome back. Continuing our focus on stocks that are doing well today. One of them is Zee Entertainment, and that's on the back of a CLSA note. Vamakshi is here with more details on that. Vamakshi.
Well, Hormaz, CLSA has come out with a report on Zee. They have an outperformed rating, target price of 170 rupees per share, which implies a significant upside from the current levels. Keep in mind that the stock has slumped by almost 55% since its merger deal with Sony was called off. And with that, the valuations right now at 8 times PE are at the rock bottom for this counter. The CLSA is highlighting that they believe as ad revenue picks up, there is potential for the stock to re-rate. In fact, Zee is India's #2 TV network and is also ramping up its OTT or Z5 business. The margins have already widened by around 9 percentage points from the lows, and the margins are now at 16%. CLSA believes that there is still room for margins to improve by nearly a further of 600 basis points to nearly 22% by FY27. Now, assuming an ad revenue growth of somewhere around 6%, they believe that the company could deliver 22 to 33% of EBITDA as well as PAT CAGR in FY26 to 27. As far as the valuations are concerned, Zee's market cap to sales is at 1 times, which is coming in at a nearly 60 to 80% discount as compared to the RIL Disney JV as well as Sun TV network. So therefore, when you look at the risk reward ratio, that is highly favorable in favor of Zee Entertainment. It's a big upside that CLSA sees, and resultantly the stock is up in trade.
Absolutely. One of the very interesting points that CLSA also made is that they expect the stock to double over the next 12 to 24 months. So, Vamakshi, thanks a lot for that. Take a short break. On the other side, Manisha Gupta joins in with Siddhant Kamath, who is the director at Naturals Ice Creams. You would not want to miss out on that conversation. We'll be right back. Stay tuned.
Welcome back. And Natural's ice cream plans to debut on the quick commerce platform with certain flavors in the first phase. The company sticks to its no IPO stance. To discuss more about summer season outlook and expansion plans, we have with us Siddhant Kamath, director of the company. Siddhant, hi. Early and intense summer. It clearly is a good time to be in an ice cream business, would you say?
So, of course, for us, this financial year, we had a target of opening around 15 more stores, and we are on the right path. We opened our last store, 176 store in Kota. So we are on a runway to close at 180 stores by end of this financial year. So we are looking at year-on-year opening 15 to 20 stores, and we are growing roughly around 20 to 25%. So we are quite positive. With the new facility, with the new expansion of our manufacturing, we anticipate to take these numbers to the next level. Our target is to be 300 stores, double our store footprint in the next 3 years.
So 176 stores now, and nearly 180 is what you're targeting by the end of this financial year, and 300 stores in the next 3 years is the sense coming in. But Siddhant, also talk to us about the revenue growth that you're anticipating going forward from here.
So right now our gross retail sales is roughly around 600 crores. We are quite positive we will be 620 by the end of this financial year. Our manufacturing turnover will close at around 320 crores. So we are quite positive for the next financial year, because the season, of course, April, May, June contributes roughly about 40% of our top line. So we are anticipating minimum 25 to 30% growth.
Are you also looking to add any more new flavors? What are your offerings this new summer season? And are you also looking at more distribution channels now, especially with the way people are ordering ice cream sitting at home?
Yeah, I mean, two new interesting flavors. Of course, we're known for our seasonal flavors, whether it is mango or we're going to see Kala Jamun also in season in the flag end of April. But what we are very excited is we're going to make a debut on quick commerce. So we're quite excited for that. We're going to be launching on Instamart and Blinkit. So that is something new in terms of sales channel. In terms of flavors, see, we are known for our seasonal flavors. So of course the focus will be on mango, Kala Jamun, lychee, the seasonal summer fruits. We are trying something new, tropical flavors as well. With the likes of pineapple, strawberry, guava. It's a fusion of all of these three fruits. So looking forward for an exceptional season. And pretty much excited for our quick commerce debut.
Right. So Siddhant, let's slightly talk more about that then. And when is this quick commerce debut taking place, and which flavors are you targeting, and what cities are you also looking at?
Yeah, of course, we'll not go with the entire SKU. But we are looking at our top bestsellers, the likes of coconut, roasted almond, chocolates, mango, of course. And we're going to debut in, let's say, in Delhi NCR is going to be our pilot store, followed by Bangalore and Mumbai. Primarily the metros we're going to target, and then we'll follow it up with tier 1, tier 2 cities as well.
As the season brings in, are you also planning to launch sugar-free, low-fat flavors this time?
Yeah, I mean, the R&D team has been working a lot. See, for us, we are natural. So, so when I say natural, it's made with 3 ingredients. That's milk, fruit, and sugar. We're not looking to changing our DNA or our core. But yes, we are looking at variants where probably we substitute the sugar with a natural, preservative or a natural sweetener. We have successfully launched in Mumbai, Pune, and Bangalore our no added sugar range, and we are looking to extend this range to other parts of the cities, because we are seeing huge demand, especially in tier 1, tier 2 cities as well, for these flavors. But yeah, the focus also is going to be on introducing sorbets and also introducing non-dairy ice cream, which is vegan also, as an alternative to our consumers.
All right, there's a lot of stuff coming in this summers then. Siddhant, I remember the last conversation I had with you and you had told me that you're not looking at an IPO. Is the stance the same? Is there a change in thinking within the family?
Yeah, I mean, we are a family business. I'm a second generation entrepreneur, and we don't live quarter to quarter. We are living family to family. So no plans for IPO right now. We have a very, very determined vision and strategy in place, and that is what we are working towards.
All right. Until the next time then, Siddhant. But it's interesting to understand that every time you see summer coming in, there is more national and definitely more regional players within the ice cream space. And in the last year or so, we've seen more international players come into the segment as well. How is competition treating you and what does it mean for growth?
I mean, competition is growing. That means the category is growing, and I'm very, very thrilled that as the competition grows, the ice cream industry is growing. And when the ice cream industry is growing, we are seeing huge consumption also. I mean, the credit also goes to e-commerce and quick commerce because it's making ice cream more accessible. And also post-COVID, what we have seen is that people are investing in refrigerators, better quality refrigerators, because they understand the value of stocking up. So we have seen a huge demand in consumption. And when there is growing competition and a lot of acquisition, IPO, also the private venture also getting active in this space is very encouraging because it's the ice cream category is winning here.
All right.
All right, Siddhant, thank you so much for sparing time.
Hormuz, I can tell you, as Siddhant said, there's mango, lychee, kala jamun, pineapple, sorbets, non-dairy, vegan ice creams, and of course, he talked about guava ice creams. So I think this summer
is spoiled for choice, I guess. We're spoiled for choice, and so are we. But we look forward to that. If only we had some on our desks right now, you'd be definitely having some. But with that, it's a wrap on this edition of Halftime Report from Manisha, me, Mangalam, and the team that put this show together. Thank you so much for watching. Business Lunch takes you through the half hour for lunch.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe,
Stocks see a broad-based rally with heavyweights leading into the charge after US Fed holds on to the rate cut outlook. IT services and autos are the big gainers while industrials and powers drag. Vedanta Group will trim $3.5 billion of promoter entities' debt by FY27, says the group chairman Anil Agarwal, adding that he will sell the non-core steel business if it fetches the right price, even as he is upbeat on aluminium, zinc verticals, despite the possibility of US tariffs. After Aditya Birla Group's of Hindalco and Adani Enterprises has ventured into the cable and wires business, a joint venture with a joint venture for Adani Enterprises, analysts see the entry as a big guns impacting growth and profitability of incumbents. Gold scales to a record high of 3,056 per ounce dollar mark, buoyed by the uncertainty over US tariffs, geopolitical developments, and investments in buying. Experts forecast a range of $2,900 to $3,500 per ounce. The Indian rupee rallies for the 6th straight day, gaining 1% over the past week and 2% from its all-time lows. As a likely current account surplus this quarter and slowing FPI outflows turn sentiment on the Indian currency. Hello, good afternoon. You've tuned into Business Lunch, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. The 4th consecutive day that we're seeing that the markets continue to gain, so not a bad Thursday coming in, and this is Nifty weekly expiry. Despite that, we have seen the Nifty continuing to gain that momentum. Look at the Nifty 50, 23,100. Around that mark is what the Nifty is at. Nifty Bank holding on to gains of almost 0.4%. Mid and small cap not seeing an outperformance, but yes, that's also managing to hold on to gains today. Nifty mid cap 0.5% up. Nifty small cap also is seeing that gain in today's trading session and holding on to gains of almost 0.4%. Both the mid and small cap did slip into the red, but that recovery came in, and that is what it is holding on to. Nifty IT today is the top sectoral gainer. Yesterday we had seen a bit of a drag coming in for Nifty IT, but today it's the top sectoral gainer, 1.5% gains there. Most of the sectors are trading in the green, so not much of a concern on that front. But yes, that's how the market shape up is looking like as of now. But let's move on and talk about the Indian rupee. That has rallied to near 2-month high as dollar remained soft, and India's likely current account surplus this quarter led to the covering of short rupee positions. Lata is joining in with us to give us more details on this front. Lata?
Well, I can rattle out statistics on rupee's strength. I mean, would you believe it, a month ago that we would be talking like this? It is at a 2-month high, plus it is the 6th straight day of gain. If you only looked at today's gain, at its height, it was 0.25% higher. If you looked at last 7 days, it is 1% higher. And if you looked at from February 10th lows, when it went to 87.95, the rupee has gained 2%. Today, the high was 86.20 to buy a dollar. Now, this sentiment change is both because of a sentiment change in the dollar and the rupee. Dollar has been softening from the mid-January levels of 110 dollar index. That's partly because euro has strengthened, especially after the last week of February and the German deficit. You've seen euro strengthen and the dollar index go to 103.5. Plus the Fed saying that they will persist with the 2 rate cuts has kept sentiment on the dollar softer. On the other hand, sentiment on the rupee has diametrically changed, especially after the February trade deficit indicated. I mean, the deficit was like a 4-year low. Plus, if you counted surplus, it was the current account surplus, or rather a trade surplus, giving the a clear indication that in Jan, Feb, March, we will report a current account surplus, which means more dollars coming in than going out. Plus, you can see the FPI dollar outflow also thinning out. It's not yet zero every day. Now, that is leading to all the rupee shorts covering. There are all these corporate treasuries which take positions. They are in a hurry covering their rupee short positions or their dollar long positions. Plus, exporters are selling off their dollars in a hurry. They were probably expecting 87.5, etc. And now by March end, they will perhaps not get that kind of money. That flood of dollars is coming. Reserve Bank in a very comfortable position. Even last week's data indicated they had bought dollars, to prevent depreciation. And even today, the expectation is that they are buying dollars as well as taking old, allowing the old swaps to mature, which means they are selling dollars. They're buying more than they're selling. That keeps RBI in a comfortable position. All told, it looks like the rupee rally is here to stay. And if it is tapering off, then it's more because it is the Reserve Bank which is buying dollars.
Okay, thank you so much for that, Lata. But let's talk about the cables and wires segment. We have a new entrant coming in here. Adani Enterprises have now formed the JV for its cables and wires foray. This came in as an announcement yesterday. The 100% subsidiary of Adani Enterprises, that is called Kutch Copper Limited, that is the one that will form a 50-50 JV with Pranita Ventures Private Limited. They'll form a new JV which is called Pranita Eco Cables. They will be doing the business of manufacturing, marketing, distribution, buying and selling of metal products and cables and wires. We don't have the amount of, the capex that Adani Enterprise will be making in this month so far. So that is going to be interesting to watch out for. But do not forget, last year that announced that they will be making those investments. Kutch Copper Limited is setting up a plant in Gujarat for copper, and $1.2 billion is the investment they're making on that front. That's still under construction. Now, obviously, in Feb, we had that announcement coming in from Ultratech Cement side that they are pouring into the cables and wires side. 1,800 crores capex over the next 2 years is what they've highlighted. So the increased competition is a bit of a worry for the players who are already there. When you look at it, what analysts are highlighting, that this entry by Adani Group will be, intensify the competition in this industry. There could be a possible impact a bit in terms of the EBITDA for the industry as well as in terms of return ratios for these as well. So that is why in the last month specifically, since post the announcement of Ultratech foray and today Adani Enterprises foray that they're talking about, we've seen all these stocks see a sharp decline in this last 1 month, around 8 to 17 to 19%. In that range, all these stocks have seen fall in this month. So keep an eye out on that. Important updates on that front. But another big development and a stock that we should focus on is Ola Electric. That's the one. Now, that's facing fresh set of issues that have come in. The Ministry of Heavy Industries is seeking some details on sales data and some inspections are there. Parikshit is joining in with us to give us more details of what is this exactly shaping up there. Parikshit, good afternoon. And what are these new set of issues now on Ola?
Well, Ola Electric is facing questions on multiple fronts. One is the discrepancy and the mismatch in vehicle registration data versus what the company is claiming to have sold in the month of February. Now, Ola Electric sent a notification to the stock exchange saying that they sold 25,000 vehicles in the month of February, but as per Vahan data, they sold around 8,600 or 8,700 odd vehicles. They say that this is because they're renegotiating contracts with their vehicle registration agencies, and this is why they are not delivering vehicles that have been purchased by customers. So now the Ministry of Heavy Industries is seeking details from them as to why there is this mismatch and to explain this better. So a set of queries have been sent to them. The government is also watching out for the case that has been filed by Rosemerta Digital Services against Ola Electric in the NCLT for non-payment of dues. So very important developments there. At the level of state governments, several inspections have been done by RTO teams at Ola Electric showrooms in Punjab, Pune, Karnataka, Mumbai, also Jabalpur, to see whether their showrooms have valid trade certificates or not. And in many cases, they found not to have valid trade certificates. In fact, there were 36 locations that were inspected by authorities, RTO authorities in Maharashtra, including Pune, and around 34 scooters have been confiscated as well. Similarly, in Jabalpur, there have been inspections, and the company has been asked why some unregistered scooters are lying at showrooms. So lots of questions there for Ola Electric, and very soon we could probably hear from other state departments as well.
Okay, Parikshit, thank you so much for giving us those latest updates. We'll keep an eye out on more updates coming in from the other state departments as well. That's the latest coming in for Ola Electric that we have. As of now, the stock is down 2.3% in trade. But let's move on and talk about the telecom space. And in a likely setback for Airtel and Vodafone Idea, government sources have told CNBC-TV18 that the proposal to waive AGR penalties is no longer being considered. But the telecom department has the option of sending another revised proposal. Ashwat Kumar is joining with us to give us more details on this. Ashwat, what does this mean for the companies now?
Well, indeed, a setback coming in as far as telecom players, the likes of Airtel and Vodafone Idea, are concerned. The players who had been hoping for some relief in the form of an AGR waiver. Bear in mind that the DoT had contemplated and had put forth a waiver program under which there was a proposal for waiving of 50% of the interest component of this AGR demand and 100% of the penalty and 100% of the interest on penalty component. This was the proposal that was floated first by the DoT. It went through the motions, first the DoT, then the Finance Ministry, also went up to the Cabinet Secretariat. However, what highly placed functionaries within the government tell us is that there will be no further consideration under this proposal that had been put forth by the DoT, the Cabinet Secretariat sending it back to the DoT, saying no further consideration. Again, a confirmation being received by highly placed government functionaries. Now, bear in mind that this decision by the Cabinet importantly comes at a time when the Supreme Court repeatedly has refused to budge as far as the AGR demand is concerned. The telecom companies, the likes of Airtel and Vodafone Idea, have repeatedly tried to impress on the court that there could be computational errors, there could be arithmetic errors, there could be possible double counting. However, the Supreme Court refusing to budge, and it is only after the Supreme Court's refusal that the DoT had begun to contemplate such kind of relief. However, we're given to understand no further consideration, at least as far as this proposal is concerned. That shifts the focus back to the DoT. Is there room, is there flexibility for coming out with a revised relief package? That's a question that the telecom minister, that the DoT will now have to answer. Back to you.
Thanks so much for that, Ashwat. But on that note, we're slipping into a very short break. But don't go anywhere, because after the break, we'll get you details from the Federal Reserve's latest policy decision. Stay tuned for that.
A success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
You know, the thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crewed flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Welcome back and thanks for staying tuned into Business Lunch on CNBC TV18. Now let's move on. The Federal Reserve announced its latest decision after a two-day policy meet and has decided to leave interest rates unchanged. CNBC's Steve Leisman is joining in with us to give us the latest here.
The Federal Reserve leaving interest rates unchanged at its March meeting in the range of 4.25% to 4.5%, but emphasized the uncertainty in the outlook linked to policy changes coming from the Trump administration. Throughout his press conference, Fed Chair Jay Powell made clear that the Fed is not especially confident in its outlook, but is in its current policy.
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy.
Fed officials in their projections raised their core inflation outlook for this year by 0.3 to 2.8%, most of which was linked to higher tariffs. They lowered the growth outlook by 0.4 for this year to 1.7%, and yet it kept its forecast unchanged for 2 rate cuts in 2025. Here's what the Fed chair said when asked how the Fed would navigate higher inflation and lower growth.
That's a very challenging, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say we don't have that situation right now.
Powell repeated that the Fed was focused on 2 options: cutting if there's clear economic weakness and holding rates steady if inflation ends up being a problem. He continued to not mention rate hikes as an option. Steve Leisman, CNBC Business News.
Okay, and the Federal Reserve held the rate steady but has cut the growth forecast as tariff fears grow. Following this, President Donald Trump has reacted to the Fed's decision on Truth Social. He writes that the Fed would be much better off cutting rates as U.S. tariff starts to transition their way into the economy. Do the right thing. April 2nd is Liberation Day in America. And now the Fed chair has said that the economists outside of the Fed have moved up their estimated chances of a recession, but such a severe economic downturn is still not likely. The U.S. Treasury Secretary Scott Bessent reflected the chairman's statement, saying that there was no reason we need to have a recession. Listen in.
But what I can guarantee you is that there is no reason we need to have a recession. I think that there's the economy in the first quarter is doing better than the media is reporting. I think we're seeing some very good underlying data from credit card companies, from banks. I think that the airlines, which reported some bad passenger numbers, a big amount of that is from federal employees who are not flying right now. So the underlying economy is healthy. There is no reason we have to have a recession. We're going to get this spending under control. We're going to bring manufacturing back home, and we are going to make the country more affordable for working Americans.
Okay, that was all about the U.S. Federal Reserve's rate decisions that came in overnight for us. But on that note, we're going to slip into a very short break now. And after the break, we bring you the latest update from the Gaza conflict. Welcome back to Business Lunch on CNBC-TV18, and moving on to some updates from the Israel and Hamas war. Now, the IDF has begun ground operations against Hamas in Gaza days after the government blamed the group for violating the ceasefire. Here's a report on that.
The Israeli military said on Wednesday its forces have resumed ground operations in Gaza, and it said this is footage of their troops patrolling Gaza City. The military said its operations have extended Israel's control over the Netzarim corridor, which bisects Gaza. It described this as a, quote, focused manoeuvre aimed at creating a partial buffer zone between the north and south of the enclave. The move comes on the second day of airstrikes in Gaza, which have killed dozens, according to local health workers. Gaza health officials said Tuesday's airstrike killed over 400 people, marking one of the highest single-day death tolls since the beginning of the conflict. The United Nations said an Israeli airstrike had killed a foreign staffer and wounded several workers at the site of a UN headquarters in central Gaza City on Wednesday. But Israel denied this, saying it had hit a Hamas site, where it had detected preparations for firing into Israeli territory. Israel warned the onslaught was, quote, just the beginning. Both Israel and Hamas accuse each other of breaching the truce, which had offered respite for Gaza's 2.3 million residents after 17 months of war, which had reduced the enclave to rubble.
Hamas refused offer after offer.
Israeli Prime Minister Benjamin Netanyahu said that he'd ordered strikes because Hamas had rejected proposals to secure a ceasefire extension until April. Meanwhile, thousands of Israelis demonstrated against Netanyahu and his government on Wednesday. Many said the renewed fighting risked the lives of the remaining hostages still held by Hamas since October the 7th, 2023. The war was triggered by a Hamas-led attack on southern Israel on October the 7th, 2023, in which gunmen killed some 1,200 people and took about 250 hostages, according to Israeli tallies. Since then, Israel's campaign has killed more than 49,000 people in Gaza, Palestinian health authorities say, and caused a humanitarian crisis. Israel has accused Hamas of using Palestinian civilians as human shields. Hamas denies this and accuses Israel of indiscriminate bombings.
Okay, and with that, we're absolutely out of time on this edition of Business Lunch, leaving the Nifty at 23,166 levels. So 50 further points higher from when we started the show. Nifty up almost 1%. But with that, we'll wind down this edition. So thank you so much for tuning in. Up next, your Midcap Radar.
Terrific Thursday continues on Dalal Street as we start the final 120 minutes of what has been a wonderful weekly options expiry session, particularly if you are a bull. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Fatakia. With me, as always, is Vivek Iyer. Vivek, good afternoon. It's turning out to be a good afternoon indeed.
Terrific Thursday, you put it perfectly. It's a strong, broad-based rally that we're seeing across all of the indices. Benchmark indices doing very well. The broad end of the market doing very well. Advanced decline ratio very, very strong. Absolutely nothing to complain about this Thursday. But we have quite a lot lined up on the show. Let's start off with the top headlines. Stocks see a broad-based rally with heavyweights leading the charge after US Fed holds on to its rate cut outlook. IT services and autos are the big gainers, while industrials and power drag. Mid-cap index too near the day's high.
After Aditya Birla Group's Hindalco, now Adani Enterprises has ventured into the cables and wires business after Ultratech with a joint venture. Analysts see the entry of big guns impacting growth and profitability of the incumbents.
Paytm, weekend trade. The cabinet extends incentives for UPI transactions up to 2,000 rupees for small merchants. Jeffrey says the approved incentives are half of last year and could result in a proportionate fall in adjusted EBITDA.
CLSA is bullish on Zee Entertainment with an outperform rating, 170 rupee price target. The brokerage says that the risk reward is highly favorable with valuations at rock bottom. It expects the stock to double in the next 12 to 24 months.
NCC gains in trade after it secures a 2,100 crore rupee order from Andhra Pradesh Capital Region Development Authority to construct roads and allied construction activities on a lump sum contract basis. Stock up over 2%.
$23,170 on the index now at the highest point of the day, building on to the gains. And how is the Nifty 260 points higher on the index? And this is despite the lack of contribution from the Nifty Bank. The broader markets, barring a pocket of the cables and wires companies, are also continuing to do well. In fact, the Nifty Bank too is now perking up in the trading session. The mid-cap index, after a bit of a hiccup at the start of the trading session, is doing well for itself as well. But we'll get to the markets in just a bit. We begin the show by focusing on Mahindra Lifespaces. The company recently signed a license deed for a 19-acre land parcel in Tamil Nadu. Now, to discuss this and more, Amit Kumar Sinha, who is the Managing Director and CEO at Mahindra Lifespaces, is joining us now. Mr. Sinha, good afternoon. Thank you for joining in. If you could tell us more about this land parcel that you have acquired in Tamil Nadu. When do you expect this to start accruing into you? What is the kind of revenue potential that you are seeing from here?
So thank you for having me. I think this is a land parcel that we have sold to Nihon Park Rising. So this is part of our industrial business. As you know, industrial business, we have 5 parks, including the one called Mahindra World City, which is a partnership with Tamil Nadu government, TIDCO. So we have multiple marquee multinational clients who have found our industrial parks very attractive to set up their businesses as part of China Plus One, Bangladesh Plus One strategy. So Nihon is a major Japanese client and had been looking at India participation for quite some time. And we had the perfect land for them at our World City, Chennai. So this is part of their entry into India in a significant way. So it is part of our industrial business, which is quite big for us. 19 acres, that means they will set up a large investment in Tamil Nadu to support Indian as well as global requirements.
Mr. Sinha, actually that clears quite a bit of doubts that we had regarding this particular development that you had put onto the exchanges. So what we understand is, as part of the lot of land that you hold in the Mahindra World City, this is one particular lease agreement that you signed with a Japanese client. So now give us the contours of this particular agreement that you signed. What is the period for which this particular lease agreement has been signed? What is it an upfront payment that you will be receiving from your client, or is this an annuity-based payment? And also, along with that, Q4 has been quite solid in terms of news for your company. Anything else expected in the last 10 days?
So let me answer your question. So you're right. This is a sizable deal. The 19-acre parcel would be quite substantial for any company. The contours of the deals are one-time lease payment, as we call it, but it's a sale payment. So they pay us, let's say, X amount, and given this is Q4, we are in the quarter end period, I can't go into the specific details of the deal term, but it's a one-time payment. And then as they come in and they own this land parcel for, let's say, 99 years of lease, there is something called O&M, operations and maintenance, that we charge to them on a per acre basis, on a monthly basis. So that's the recurring annuity business, but that tends to be not major. The upfront payment is the major part of the contribution. So that's how that's being designed. But Q4 is going to be hopefully good for all of us. We are working hard towards closing it, but we are in the final stretch. A few deals, efforts underway will hopefully close the year in a solid footing.
Mr. Sinha, once again, thanks for clarifying that as well. So, could you give us a sense that come FY26, when they do come on board, with them and along with the other clients at Mahindra World City, both in Chennai as well as Jaipur, what will be the total percentage of top line that the rental part of the business or the annuity part of the business that has O&M, what will be that proportion? And also FY26, what is the expected top line? So that will give us a sense of what is the kind of growth we can envisage.
Yeah, so let me just highlight. So I'll give the industry. We have residential business and industrial business compared to some of our peers who have residential and commercial. And commercial has a bigger annuity business because you don't sell those office assets. You get lease premium every month. In our industrial, as I explained, you get an upfront payment, which is called lease premium, but it's actually sale for perpetual lease. So slightly different. For our industrial business, we have 5 industrial parks, including Chennai, and we have Chennai World City and Origins Chennai, World City Jaipur, and then we're going to bring to market Pune, and we also have in Ahmedabad. Across all 5 industrial parks and world cities, our guidance has been we will be able to get a top line of somewhere between 400 to 500 crore per year. And it's something that will stay that way for some time before we start to launch any new, let's say, a new industrial park. And that will continue to be there. It's an attractive business for us. In terms of F26, I think that guidance is quite clear that we are trying to get to 400 to 500 crore in that business.
Among commercial and industrial, residential and industrial, which one do you think will lead the growth towards your FY28 plan? One sentence answer, Mr. Sinha.
Residential will be 80% of our top line, maybe more, because the residential pre-sales is a much bigger part.
Right.
Now, even the revenue realization of the project that we are launching will start to happen in 28, 29. So from a revenue recognition, which is slightly different, even residential business will become significant by that time.
All right, Mr. Sinha, thank you so much for sparing time and joining us. Wish you good luck for FY26 as well. We take a short break. Up next, we connect with the management of Tata Communications on their launch of Vayu, which is a next-gen cloud fabric designed to reduce cloud costs. Stay tuned.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? it takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies.
Welcome back to Mid-Cap Radar. Well, a bit of divergence seen as far as insurance companies are concerned. Have a look at a lot of the life insurance stocks. A lot of the life insurance stocks today are doing very well in the session. Look at Max Financial, look at ICICI Prudential, HDFC Life, SBI Life. All of these stocks doing quite well in the session today. But what's not doing very well is actually the general insurance names. Some data came out yesterday, and Kotak Institutional Equities actually says that February was not a very good month as far as the general insurance names are concerned. And ICICI General Insurance now trading near the day's lowest point, and that stock is down almost 2%. So within the insurance space, life insurance doing well, general insurance not doing so well. ICICI Lombard, that particular name, down over 2%. What's also doing well? Look at telecom. You did see some negative news yesterday, but Bharti Airtel has put that behind it, and the stock now up almost 4%. Bharti Airtel, one of the top gainers as far as the telecom pack is concerned. Vodafone Idea Farmers continues to sulk.
It continues to sulk, right? I saw some movement from the off the highs of the day yesterday's session as well once the news came out. But some interesting names that are springing up now. RHI Magnesita, that is the top gainer on the Nifty 500. It's up 16% in today's session, and with this surge, it has almost reversed all the losses that it had made so far this year. It was down around about 17 to 18% year to date so far, and with this move, it has nearly reversed all of those losses. 16% higher for RHI Magnesita. Spark is the other one, Sun Pharma Advanced, SPARC. That too is up 14%, and most of these moves have come over the last few minutes. There you can see 14% higher there for Spark.
Even a name like Bharat Forge up almost 5%. You know, it's been an underperformer recently, but Bharat Forge, even as we
speak, the entire defense space that's doing well for itself. But yes, on to corporate, continuing with corporate conversations. Tata Communications has launched Vayu, a next-gen cloud fabric designed to reduce cloud costs and manage multi-cloud complexities. To discuss this about the new launch and a lot more, Rachna caught up with Bhaskar Gorti, the Executive Vice President of Cloud and Cybersecurity Services at Tata Communications. Listen in.
So Vayu Cloud is both a new branding and a new AI cloud. And under that umbrella, we have brought in over a decade of experience of being a cloud provider. So we were in dedicated hosting, we have done multi-tenant hosting, we have done public cloud hosting. So we have over the years taken the journey of being a full-fledged cloud service provider. We launched Edge a couple of years ago, so we took the cloud to the edge, and now with AI. So all of that together is our Vayu Cloud, which is unified, it's optimized, and it's purpose-built.
Right. So how does it differentiate from an AWS or an Azure or other offerings that are available in the market?
So in a couple of ways it differentiates. Those are just infrastructure in a platform. They are not purpose-built. They're generic platforms that are built for everybody. They are definitely have scale. We are focused on enterprise market only, and we are focused on building specific use cases for customers. We have industry clouds like government, BFSI. So it's very purpose-built and unified. And at the same time, we also bring a cost perspective to it. There is complete visibility and cost control. And we are, 25% or more cost effective in the way we have engineered these products, and we provide services. So we are a complete true full service
like
provider.
a one-stop shop.
One-stop shop, yes.
Okay. Security is a very big concern with cloud, especially when you cater to purpose-driven solutions. How do you sort of comply with the frameworks of a DPDP or RBI or SEBI?
Absolutely. So security is not something that we have bolted on. Security is natively built at every layer of our, if you look at our digital fabric, it has network fabric, it has cloud fabric, interaction fabric, and IoT fabric. But security is a horizontal. So we have first built security in the platform layer, in the network layer, and the infrastructure layer. And then on top of that, for certain industries, there are certain regulatory compliances. The government has certain guidelines by which we have to do data sovereignty, data residency, so we have those certifications. For BFSI, we have certain RBI, SEBI regulations, so we support that. And then, of course, consumer protection is also an important aspect of it. So we provide security across all three layers, and we provide auditability.
Right. We're also living in such interesting times when AI is evolving every single day. Every day there's a new update. It's so dynamic that we're also quite excited as tech enthusiasts to look at how it reshapes and how it sort of reworks into our lives. How does Vayu as an infrastructure work around, let's say, NVIDIA GPUs, which are demand of the world? How does AI come into the picture here, and it sort of complements whatever's available already in the market?
Sure. So as I said to you, Vayu is cloud, edge, AI. It's a continuum. So AI is a part of Vayu, a cloud offering. Our overall cloud offering brings infrastructure, platform, and then we have using NVIDIA GPUs, but that's only a GPU infrastructure. We have a whole data centers built on top of that and platforms. So we are definitely supportive of silicon diversity. But we started with NVIDIA, it's NVIDIA certified, and we will add more silicon diversity as time progresses.
You know, off late, in fact, just yesterday there was a report on the performance of Tata Communications and how phenomenal it has been in the past quarter. How does Vayu coming into the picture further take your margins and your profits ahead?
See, it's all about growth. So we have invested a lot in over the years, and especially in the last 2-3 years, in engineering a unified platform. So our growth rates are pretty aggressive, but not unrealistic, is what I would say. So the growth is the big factor.
400% rise in profit was quite unrealistic.
I'm not talking about the profit necessarily, but it's the growth we are commensurate to, we want to beat the industry growth rates. We want to be ahead of the industry growth rates so we get a bit better market share.
So how does Vayu, what is the outlook with Vayu coming in the picture from next quarter? What percentage of growth do you see it contributing to the overall growth rate?
See, we don't split out specific portfolio elements of ours to the market. We talk about what is our digital portfolio revenue and what's our data revenue, and we are part of the digital portfolio. We're part of the digital portfolio, so that's what I would say, our growth ambitions. And believe me, our growth ambitions are pretty aggressive.
That now there's more focus on becoming a comtech rather than just a telecom. Can you take us through that? What is the rationale behind it?
It's our evolution. You look at it as we were a networking company. Then we're into a cloud and cybersecurity. So we are moving forward as the industry is moving, and in some cases leading ahead of it. I'm a cloud and security software product guy, right? So we want to bring people like me and our teams. We are hiring a lot of people here who do know network but are not network people, because it's like I always use this analogy. There are two games, both are played with bat and both are played with the ball, and both score is measured in runs. One is baseball and one is cricket. I don't think any famous cricketer has become a famous baseball player, not a famous. So it's the same thing. So network is a completely different industry. So the expertise in that is definitely there in the company for the last 20 years. So we are on the platform and infrastructure side building the capabilities for the last 10 years, and we'll go forward.
the management of Tata Communications there on their new launch called Vayu. We take a short break. On the other side, we get you our special segment, Midcap Movers, to tell you all of the stocks that are buzzing in the broader markets. And mind you, there are plenty of them. Stay tuned.
I thought, I should leave. I should go back to India. We will figure out what is it that we will do. There was no idea for free will. So I came. Rahul also left at the same time. Then we spent almost a month or two to figure out, okay, now what next? So it always started from the family, then solving some, consumer problems.
The business plan came later. First,
Always.
But how do we ensure that we're in the
That
same?
has always been the priority. What you see in front of the label is very different than what is on the back of the label.
And then very different from what's actually inside the bottle.
Exactly. I guess so far we are in some 2,000 stores. In next 2 years, we can easily target anywhere between 15 to 20,000, right? When you go deeper into any category, you also understand the good, bad, ugly side of it. It's a misconception, to be honest. I think the percentage of spend required for R&D eventually is much lesser that you need for your marketing. Investing in R&D is much better ROI than always doing it in marketing.
The key news makers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
The thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crewed flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Welcome back. 900 higher on the Nifty, almost 300 higher. Oh, no, sorry, 900 higher on the Sensex and 300 almost higher on the Nifty. But what's leading the charge in the broader markets? Vamakshi is here to tell us just that. Vamakshi, good afternoon.
Well, good afternoon, Hormas. Yes, the broader indices are doing quite well, but not as much as the benchmark indices. Let's first look at some of the stocks that are gaining momentum in trade today. This list includes SCI. That stock is surging by almost 15.5%. KEC International as well, up nearly 8%. And look at the gains on RHI Magnesita. In the last 1 hour or so, that stock has really picked up nearly 15% as well. Emcure Pharma is the next one we're watching out for, 7.5% higher. Apart from that, let's also focus in on some defense counters, because those are the stocks that gained in the trading session yesterday and continue to see some good momentum build on today as well. GRSE, that stock is up nearly 5.8%. So far in the last couple of sessions, that stock has surged by almost 30%. Paras Defense is up nearly 6%. Bharat Dynamics and BL continue to surge in trade. Apart from that, we also have a few metal names that are flying away in trade today. Look at Welspun Corp, Hindustan Copper, Nalco, as well as Ratnamani Metals. All of these counters are surging in trade. On the flip side, there are some stocks that are losing out in such a strong market. This list includes other housing. We're seeing some profit booking out here. Paytm, another, there's a news flow out there, down nearly 3%. LG Equipment as well as Vijaya Diagnostics are some of the laggards in trade. As a pack, the cables and wires segment is down and out in trade. When we look at KEI Industries, down 13%. Very strong downward moves on Polycab, Finolex as well as RR Cable.
Thank you so much, Vamakshi, for joining us and giving us a sense of what exactly is transpiring in the broad end of the markets. We are leaving you with mid-cap radar ending on a very, very strong note. The mid-cap, small-cap indices, very strong. Both of them up well over 0.5%. On that note, it's all the time we have on this edition of mid-cap radar. Your stocks will return.
Hello, good afternoon. You've tuned into Mutual Fund Corner on CNBC-TV18. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. Today, what we're going to be discussing is money market mutual funds. They have long been a popular cash management tool for investors looking to park cash in the short term. Now, there are money market ETFs too, but what is the difference between these two? They've recently started picking up a bit of a pace. Globally, they were big, but in India, there's a recent increase in terms of pace over here. Which is a better option for individual investors looking to preserve capital while earning some returns? That is all that we'll be discussing. And to get all those answers, today we're joined by our expert, Saloni Sanghvi, founder of My Wealth Guide. Saloni, thank you so much for joining with us on the show. It's a pleasure having you on the show. Let's start with the basics, right? Because not many people in India know about this. What is a key difference between money market funds and money market ETFs, particularly in terms of risk, return? What are we watching out for here?
Thank you so much for having me on the show. This is an interesting topic because, as you said, not too many people know about money market ETFs, etc. So what are money market mutual funds? They're basically mutual funds that invest in short-term, highly liquid, low-risk instruments like treasury bills, commercial paper, certificate of deposit, all with a maturity of less than 1 year. And these are actively managed by the fund manager who will make decisions on the portfolio composition. The returns for these funds are based on the NAV, which is essentially the value of all the underlying securities that the fund has invested in. So they provide stable and predictable returns, usually similar to the prevailing bank FD interest rates. And they typically have low volatility. However, because they're actively managed, there is a chance that there could be some amount of manager risk basis the fund manager decisions. Now let's look at money market ETFs. These are basically exchange-traded funds that passively track an index of short-term debt instruments. So unlike mutual funds, ETFs are traded on the stock markets like stocks, and you can buy and sell them anytime through the day. So the price is influenced by demand and supply as well as the underlying NAV, which can create fluctuations. And they also have market risk because of this. Also, sometimes in case of ETFs, the bid and ask spread, which is the price at which someone wants to buy and the price at which someone wants to sell, could be wide, especially if the volumes are low. And, this happens often in volatile markets. So overall, returns from money market ETFs are slightly lower and slightly more volatile than mutual funds.
Okay, so money market ETF slightly more lower, slightly more volatile is what you're saying. Also, we'll come to the return part again separately, but how do liquidity, accessibility differ in both this as well? Is there a difference in terms of liquidity, especially for short-term investors from both these factors?
So, like any other mutual fund, money market mutual funds, you can buy or redeem only at the end of day NAV. So if you want liquidity in the middle of the day, there's no intraday liquidity that you will get. And you cannot take advantage of intraday price fluctuations. You must wait, for end of day, you will get the NAV and then the money comes to you within a day. In terms of accessibility, you can directly, invest via the AMC or online, or there are multiple platforms available. You can also go to their branches and invest in money market mutual funds. Now, in case of ETFs, they are traded literally like stocks. So you can buy and sell at any time during market hours. The only thing is that for ETFs, you would need to have a demat account and a broking account to transact. And funds hit your account in a day. But during the day, it gives you a lot more flexibility. So you could, sell these ETFs to buy stocks and vice versa if you need to be.
Okay, so for ETF, yes, it may give you a bit of a lower return versus those money market mutual funds, but accessibility in terms of liquidity through the day, that's higher for ETFs, is what I'm understanding correctly, right?
Exactly.
Okay. Also, what is this concept of floating NAVs in this money market ETF, and how does that impact investors? How should you be reading this?
Okay. So floating market NAV is basically the real-time market value of the underlying assets. So what is the value of where these ETFs have invested? And this can vary through the day. Variations, of course, minimal because they have lower volatility. But floating rate NAV basically gives greater price transparency because they're moving intraday and not just at the end of the day NAV like mutual funds. Just to give you an example, suppose an ETF has an NAV of 100, but because of the trading, because of the buying and selling, it could trade at 99.95 or it could even trade at 100.05.
Okay. Saloni, coming to that point in terms of returns. Now, this is specifically an option more likely for someone who wants to preserve that capital while earning some bit of a return. And this is the short-term side that you want to look at in terms of an option. When should one look at money market funds and ETF funds? What is better in terms of returns? You did say ETFs is better, but how much better? What does money market fund give? What does these money market ETFs give normally as a return? And why is one better than the other in terms of an option for an investor right now?
So I feel for most investors, money market mutual funds are a better option. Because, the returns, the NAVs are less prone to market fluctuations, resulting in more consistent returns. So the consistency is higher. And in fact, returns have also been higher. So if you look at the last 1 year returns of money market funds on an average, they were around 7.4 versus 6.2 for money market ETFs. Of course, the money market ETFs in India are largely invest in overnight instruments. So we should compare them to overnight funds, which have similar returns. But, this return is just one part of the story. There is also no impact of bid-ask spread when you're investing in a money market mutual fund. There are no brokerage or transaction charges, STT, etc. None of that is there. And in fact, surprisingly, the expense ratio also is lower for money market mutual funds. So the expense ratio on an average is 0.17% versus 0.35 for, the ETFs. And ETFs, if you were looking at expenses on the overnight funds, that is even lower, which is 0.09%. Also, I think in terms of taxation, while that has changed over the last few years, you have dividend-based ETFs, where they give you a dividend instead of the price increasing, your units increase essentially. Now, in that case, you're actually taxed on the dividend every single year instead of when you just redeem the funds. So in a money market mutual fund, you would only pay tax when you actually redeem the funds. In case of dividend-based ETFs, you would actually pay tax every single year on that. So I think considering most of these parameters, for most people, money market mutual funds are a far better option.
Okay. Surely, considering those factors, Saloni, I just have a follow-up and I want to understand, right? Obviously, there are a lot of moving factors right now in the market. You have interest rate cycles going on, inflation concerns across the globe, right? So how do all these factors play in money market mutual funds and ETFs? In the current scenario also, is then money market mutual fund a better bet? And how do those returns fluctuate with these rate cycles as well?
So I think, again, because, they invest in instruments which are less than 1 year, the fluctuation within the money market mutual funds is far lower than other categories of debt. Usually if you see over the long run, they have returns of around between the band of 6 to 8%. So say, for example, if interest rates were to go down, you would get a slightly better return in the money market mutual funds in the very short term. But over the long run, they kind of give you stable returns within that band.
Okay. So stable return within that band is what we are watching out for. Okay, Saloni, and in terms of obviously overall, if you've looked at in terms of the global market fund for India, like you mentioned, it's just been in the year, right? In the recent times that you're seeing this come up. Last 1 year, I believe, is what you mentioned when we've seen a pickup coming in for this. So globally also, how do you see those returns normally for these? Are they much higher? Or, for India, the story is just beginning here in the money market fund. And what are we watching out for here?
So I think globally, one factor is that, the expense ratio is lower for the ETFs. So that directly feeds into the return. Globally, we've seen that money market or debt ETFs have a higher return versus their counterparts in mutual funds. Also, it gives you a lot of flexibility, where you can utilize them during the day as well. So I think globally, the situation is a little different versus what is there in India. But given that in India, most ETFs in this space have only been launched in the last 1 year. So I feel as they become more mature and there is more volume and liquidity as they pick up, I think the expense ratio should also ideally come down. So then that will again directly play into the returns that you earn.
Okay, Saloni, thank you so much for explaining all of that to us. Right now, we're going to slip into a very short break, so do wait by with us. On the other side, we'll continue this discussion as well on money market funds as well as ETFs, so don't go anywhere. Welcome back. Thanks for staying tuned into Mutual Fund Corner on CNBC-TV18. We still have with us Saloni Sangvi, founder of My Wealth Guide, to talk to us about money market mutual funds as well as ETF funds and how they differ. What are the benefits for you as an investor? Saloni, let's continue this discussion and then I beg your pardon for that. How should investors decide between actively managed funds as well as passive kinds of ETF funds while considering the cash management strategies that they have?
The cash management usually involves managing idle funds, safely with easy access while earning some returns. Now, choosing between actively managed money market funds and passive ETFs depends on the objective of the investor. Actively managed money market funds are great, if you prefer a professional fund manager, you want more predictable returns, stable NAVs, without needing intraday liquidity. Passive ETFs are ideal if you're, actively trading in stocks, you already have a demat account, and you want intraday access to your funds, in case if there are opportunities that open up. So I feel depending on what the objective is, that's how you would choose the instrument that works for you.
Okay. Saloni, what I want to also understand is if a conservative investor is there, right? What should they consider? Money market mutual funds or money market ETFs? Which is a better option for them?
I think for a conservative investor and for most investors, money market mutual funds would be a much better option versus ETFs. As I said, the single most advantage of ETFs is intraday liquidity, which most people don't require. So for most people, the advantages of money market mutual funds are far better and higher.
Okay, so money market mutual funds, as you're saying, for most investors, like you mentioned before as well, is a better bet. Even if you're a conservative investor, it makes sense to look at this option. And obviously, better option if you're a very short-term trader. This is for a short-term bet, but can money market ETFs ever be, which situation is that a better option than one could look at then? That's how I want to frame up my question then.
Right. So I think, as I said, ETFs can be traded during market hours. You can buy and sell during that. That means that cash is immediately available to you, if you want to invest in other listed instruments, stocks, etc. So it's very easy for you to instantly sell money market or, debt ETFs and buy other stocks or assets during the market hours. You don't have to wait for the end of day, and for a day for the funds to come to you. So in those cases, I think ETFs has a great use case and is very, useful for that. They, of course, also eliminate fund manager risk because it's tracking an underlying index. So I think in this case, this is the best option, especially if you're trading actively or you want to take opportunities, of the market, say a stock has fallen, markets have fallen, etc., and you instantly want to invest, then these ETFs are a great option.
Okay, thanks for that, Saloni. Also, can you highlight any specific money market funds or ETF funds that are currently available, particularly as a strong investment option right now? What is there for an Indian investor here?
So multiple AMCs offer money market mutual funds, and the returns here have been around 7.4 to 7.8% in the last 1 year. One can look at investing in any of them because they're managed with a similar style. I would ideally prefer a fund with a higher AUM. So in case if there's ever redemption pressure, that can handle it. For ETFs, it's better to look at growth-based ETFs versus dividend-based ETFs. This is what happens in a growth-based ETF is that the value or the price of the ETF keeps increasing in line with the returns. Whereas in a dividend-based debt ETF, the price remains the same, but your units increase. So what happens in that case is you'll end up getting a lot of fractional units, which you cannot sell. Because in India, you can only sell minimum amount quantity is one stock. So if you have fractional units, you will not be able to sell the entire amount. So I would recommend, in money market, any AMC with a large AUM in that fund is a good option, and growth-based ETFs if you're looking at that.
Saloni, but looking at this return, which was spoken about, right? 6-7% for ETFs and mutual funds, around the 6 to 8% range. Why is it a better option than fixed deposits, right? Because I am getting similar benefits at fixed deposit side. So what would that be as a comparison then?
Right. So, see, FDs, of course, is the safest option, because usually a bank is issuing it, RBI is monitoring it, etc. So in terms of risk, FDs are the safest option. But there are two disadvantages in case of FDs. One is if you're making a short-term FD. So, for example, if you're making a 3-month, 5-month FD, you're not going to get that 7.5%. You will get a much lower rate, which is the rate for that period. Secondly, if, you have to liquidate the FD, say you've made a 5-year FD, you need funds in a year. So in that case, you would have to pay a prepayment penalty, plus the interest which is prevailing in that time for the 1-year period is the interest you will get. So I feel these are two big advantages that money market mutual funds have over an FD. And I also forgot to mention the taxation aspect. While the tax on both is the same, in FD, because you're getting the interest every year, you're paying tax on that every year. Whereas in a money market mutual fund, you're only paying tax when you actually redeem the fund. So you're not necessarily paying tax every single year. So I feel these are the advantages that money market mutual fund offers at a marginally higher risk.
Okay. And, what I also want to know is in terms of for a new investor who is just starting out, what are the key factors that they should watch out for before they actually enter into money market funds or ETFs? What is the strategy that they should be following here?
So if any investor is beginning the process of building their portfolio or even evaluating their existing portfolio, first, I feel they should start with their target asset allocation. That is based on, their risk-taking ability and their goals, as in when they need the funds. Based on that asset allocation, that will help them decide how much they need to invest in debt, equity, gold. Equity is essentially for long-term wealth creation. Debt is for stability, regular income, and short-term liquidity. And gold is for inflation protection and diversification. Now, once you have this allocation, money market mutual funds or ETFs can be used as part of that debt allocation. They're great for capital preservation. It's a good debt cushion to your portfolio to protect your capital. They can also be used as emergency funds. Portion can be allocated to short-term needs and emergencies. And also temporary parking of funds. Say, for example, you have surplus cash or you've sold some assets and you're waiting to utilize and deploy that money elsewhere. So these can be good instruments for parking your money there.
Saloni, given that money market funds normally reinvest in short-term debt instruments, right? Do they carry any sort of a reinvestment risk that also an investor should watch out for?
Completely, they would definitely carry a reinvestment risk because, unlike an FD where your interest rate is locked in for the period, in case of money market funds or even ETFs, your returns or your interest in that sense varies basis what interest rates are prevailing in the market. So, for example, if RBI decides to cut interest rates, say they cut them by 0.5 bips, so that will substantially obviously reduce your returns on your money market funds and ETFs. So there is definitely a high amount of reinvestment risk, but given that interest rates don't vary largely over a period of time, it's not extremely high.
Okay, and Saloni, as an asset allocation overall of my mutual fund portfolio and as an overall strategy of investment, does this make the cut to make some allocation to this front, or are there other options? How should they be looking at this right now? And what % should maybe be going to money market funds if they're looking on the short-term side, but overall strategy?
Right. So I think anything that anywhere where you need funds for the next 1 year and maybe even your emergency corpus should definitely be allocated, in money market funds, because that is short term and you get a good interest rate even for shorter periods of time. For anything that is beyond that period, you can look at other debt instrument options, but anything that is more immediate in nature should definitely be allocated to money market funds. It's difficult to give an accurate percentage because, of course, everyone's asset allocation varies depending on their own needs. But I think this is how you look at it: 12 months of expenses plus emergency corpus.
Okay, Saloni, thank you so much for joining in with us. This is such a topic that people don't understand, so I had to ask you those basics as well. But thank you so much for explaining us in detail what the strategy should be for an investor to invest in such kind of funds and who benefits from this. But with that, we are absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, you have Closing Bell to take you through the last hour of trade.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng is down 1.5%.
It kept rates unchanged, 4.25% to 4.5% as expected.
Inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging.
The body for PLI scheme and the FAME scheme and the PM E-Drive scheme is now looking at why there is a mismatch between the data that Ola Electric is reporting publicly, around 25,000 scooters sold in February versus 8,600 that have been registered in Vahan.
We, by the way, closed above the 40-day yesterday, but only marginally, about 30-point beat on the 40-day.
We are worried about, as a overall, what will happen, but Vedanta will be less impacted.
There's a 0.5% higher open once again, 23,000 plus on the Nifty.
The investment climate overall is becoming very, very challenging.
Most of the time, we don't have a very clear view on the market, especially in the near term. It's another session where the equity markets are doing very well.
It is at a 2-month high, plus it is the 6th straight day of gain.
Strong broad-based rally that we're seeing across all of the indices.
Well, the bulls are, should I say back? I think they are back. We can say they're back.
Now. 4 days in a row, so I think.
Absolutely. And 300 points now. And, momentum is also maybe back. Fingers crossed. And it's looking good. It's a good-looking screen. Broader markets are doing just fine. Not extraordinary. 2:1 advances to declines. Bank Nifty is super strong, so no complaints. This is Closing Bell coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Rupee. Guys, hi.
Hi, good afternoon. And today I definitely want to see that FPI number. Not sure. But looking at the nature of this rally, because it's not a few, 4 or 5 Nifty stocks that are taking the index higher. Everything is up. IT, banks have been doing really well. Even Reliance, large parts of the market are moving higher today.
The top performing sector is the oil and gas index. And, and what this is now doing is that we were talking about taking it day on day. But the fact is that even from a slightly larger degree time frame, so, for example, the correction, the market peaked out in late September, so the high in October, September last year. Even from that time frame, which is slightly longer, I think you can consider this as a bit of a breakout. So, we are breaking out, and it's good to see that. The level we put out in the morning was 23,060. That is the first kind of resistance. That's comfortably taken out. So, it's been rapid, right? Monday, 20-day went. Tuesday, you had the 40-day exponential average, which went. Yesterday, the market inched higher. and now we're actually looking at retracement levels. The next level is basically around 23,600, which is now we're starting, as I said, from the larger time frame, the high of September to the absolute low. The 38% retracement of that is about 23,600, and then we'll see if we're able to get to it in this current leg, then the 50, then the 61.8, etc. So, and gains are holding. And if anything, actually, if you just look at the Nifty intraday chart, gains picked up. Actually, things perked up exactly at about 1 o'clock, and the market started moving higher and took a leg up. For the week so far, Nifty is up 3.5%. The Nifty Bank is up 4%. All sectors in the green. Everything. Advance decline, of course, is a more reasonable 2:1 in favor of advances. So, a pretty good session, all told. Rima.
Well, higher now for the fourth day in a row, and the Nifty has surpassed 23,200 mark for the first time since the 13th of February. And from our early March lows, which is just sub about 21,967, the Nifty is now rallied close to about 5.5%. Now all eyes, and today, by the way, we've also crossed the 50-day moving average, which is close to about 23,000. It's the Nifty weekly expiry today. All sectors in the green, but the sectors which are leading from the front include IT, auto, oil and gas, many of the defense names. So if you pull up the Nifty gainers list, you would see a Titan, a Bharti Airtel, two-wheeler names like Bajaj Auto, Eicher Motors, oil marketing companies, BPCL, IT names across the board. Fed, saying that they will continue with the 2-rate cut is helping the sentiment on IT names. Banks have also advanced past the 50,000 mark. The Nifty banking index is today above the 50,000 level, and now the next level to watch will be the 200-day moving average on the Nifty Bank, which is 50,950.
Absolutely, it's a really big wide movement, and I'm guessing there's a lot of shorts that have been covering, and we've seen that through the course of this week because the momentum has made the shorts run for cover. We saw that yesterday as well, coupled with the fact that today is anyway expiry, so perhaps the moves get a little more exaggerated and pronounced. On the mid-cap screen, there was a bit of a scare. Early in the morning, the index suddenly dipped into negative territory, but since then it's recovered. There you can see there was some volatility, but it has recovered. And again, there are plenty of stocks that are flying around on all sides of the spectrum, PSU, non-PSU, financials, etc. Just some examples. Let's talk about some of the big movers and shakers at this hour. Amber, for instance, 6.5% on the upside over here. KEC International, 8% on the higher side. Welspun Corp, 8%. So it's cutting across sectoral lines. These are well-tracked stocks. And they seem to be getting snapped up today. Lots of names. Spark, Sun Pharma Advanced Research, up 15% as we speak. There's also AstraZeneca. So a couple of these healthcare names are also doing really well. And the whole PSU momentum seems to be intact. GAIL, IOC, Aircon, just some names. And obviously in the large cap screen, there's ONGC as well. Some of these names that are having a pretty good session, at least for the time being. The question is now, what should you do in the last hour? Market is in absolutely fine form. Let's get to Mitesh and get some advice going. Mitesh, good afternoon. Once again, it's bulls in control. It's been a great week so far. What would you do last hour?
Good afternoon, Survi. So, we maintained that 23,100-150 was the near-term target and a positional target of 23,550, 600. I think Prashant was alluding to same levels. I think that's where there are retracement levels. That's where there are weekly moving averages which are modified. And I think very likely that, around those levels, you will see a serious correction. So while after a 3-4 day kind of a rally, you might get an hourly, 2-hourly kind of a decline. But that candle gave when the Nifty, gives off about 100-150 points. But broadly, the direction is on the upside, and very likely that we should do about 23,550, 600 in the next few days. So in that sense, maintain a positive bias. On the stock side, I have a buy on Britannia, and after a long time, FMCG names come on the list. So Britannia is a buy with a stop at 47.70. Look for target of 49.40. And CDSL, which has been a recommendation earlier as well, now is a fresh buy. Keep a stop below levels of around 11.50. Look for targets of 12.10.
Thank you, Mitesh, for that. So Nifty headed higher, 23,550, 23,600 is the level Mitesh is now eyeing. But let's talk about cables and wires under pressure today on the back of rising competition in the sector. Vinny is here with the details. Vinny, first the Birla Group with Ultratech Cement, and now the Adani Group. No respite here.
Absolutely. So we're seeing increased competition coming in this cable and wire space. Now, Adani Enterprises has formed a JV for this cables and wires foray. Its subsidiary, 100% subsidiary, that's Kutch Copper Limited, has actually planned a 50-50 JV. This is with Parnita Ventures Private Limited, and this JV is going to be called Parnita Eco Cables Limited. This is the JV, and the details that we have so far is that they're going to be engaging in the business of manufacturing, marketing, distribution, buying and selling of metal products as well as cables and wire segment. Now, other than that, what we don't know the amount of investment that Adani Enterprise will be making. But previously, and in 2024, the company had said that it's Kutch Copper Limited, they will be investing $1.2 billion. This is going to be to set up a 1 million ton per annum copper plant, and this is going to be in Mundra, Gujarat. So this plant is still under construction. Is it going to be a part of this as well? And will the products be coming in from this side? What is going to be the benefit from this front? These details are still left, and this is something that everyone is watching out for in terms of clarity. Do not forget that, in Feb 2025, that's just a month ago, Ultratech Cement also announced its foray, like you were mentioning. So that is interesting because they have announced a capex plan of 1,800 crores capex in the next 2 years. So these two big entrants coming in into cables and wires has kept, the peers a bit jittery and increase in terms of competition, and a bit of a pressure has come in on all these other peer companies, whether you look at a KEI or Finolex Cables, because of the entry of increased competition coming in here and a possible impact in terms of the EBITDA as well as return ratios for them as well.
Big fall. KEI Industries is down close to about 14%. We had this chat with DSP Mutual Fund's head of equities, Vineet Sambre, and he drew parallels with how the paint stocks reacted when the incumbents were hit by rising competition. Listen in to his comments.
When we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks I think corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large.
Okay, so severe price damage on these stocks once again today. That was beneath earlier with the DSP view. We have Deven Choksi joining us on this leg of the show. Deven, good afternoon. Great to have you as always. Let's get your opinion. I mean, these cable and wire guys, once they got hit because Ultratech decided to enter, now Adanis are entering. At that time, what the companies told analysts was that there's not much reason to worry because scaling up in this business takes a lot of time. But the market clearly is worried. Your thoughts?
Yes, sir. Very good afternoon. Well, as I see it, I think the Adani's larger play is basically integration from the base metal to the end product. And that's where I think their major amount of growth program appears to be. Now, given the fact that I think the entire cable and wire industry is a market capitalization in the listed market across all the companies, somewhere around 1,40,000 crores, out of which about half of it belongs to Polycab and rest of it I think belongs to rest of the others. Adanis have basically shown the appetite to, I think, do inorganic growth. So in my viewpoint, I think if they have to really integrate themselves with the back-end metal production along with, I think, the further production of cables and then the distribution in the marketplace, probably I think it is safe to assume that I think some of the companies which are prominently in place, I think could become the acquisition target. So today they may have reacted negatively, but going forward, I think keep an eye on them. They could possibly be the acquisition targets, I think, in the marketplace. And that's where I think the industry is going to play out well as I see. Consolidation, of course, but at the same time, the bigger players entering into it could probably grow the size of the market faster than otherwise, as we assume.
Deven, would you buy any of the stocks today in anticipation that they will become future M&A candidates?
So Finolex is one company which is available at a valuation which is quite compelling at this point of time. Given the kind of distribution reach they have created, given the brand they have, and the valuation at which they are putting currently is not far too expensive. So certainly, I think this company has had some amount of promoter-related issues, and because of that, I think they have not commanded higher valuation compared to others. But in my viewpoint, I think the business-wise, they probably, I think, remain relatively more formidable player if one wants to, I think, integrate or get into some kind of inorganic growth proposition with them.
Okay, all right, got it, Devin. Just wait on. We have more stocks and more things to discuss. Z is another stock that's been in focus today. CLSA is getting a little optimistic on Z, perhaps saying that the worst could be over. There could be some business improvement from here on. Let's go across to Vamakshi for more details. Vamakshi, fill us in.
Well, so it will be not just a little optimistic, but a lot optimistic on Z. That is because they've given a target price of almost 170 rupees per share, which is a significant upside as compared to the levels that the stock is currently trading at. They have an outperform rating on this counter. They say that the stock has slumped almost 55% since the deal with Sony was called off. And in fact, the stock as of now is trading at a rock bottom valuation. The PE is 8 times. So therefore, they say that the risk reward is highly favorable for Z. They believe advertising revenue-led growth will re-rate the stock. They also highlight that Z is India's #2 TV network and is also at the same time ramping up its OTT presence, that is the Z5 business. They believe that the margins have already widened by around 9 percentage points to around 16% in the quarter gone by, and they're expecting further improvement to come through. In fact, they're expecting the margins to reach the 22% mark by FY27. Now, assuming that ad revenue grows at almost 6%, they believe that the EBITDA as well as PAT could grow at a CAGR of almost 22 to 33% in FY26 and 27. As far as the valuations are concerned, Z's market cap to sales is at 1 times, which is coming in at a 60 to 80% discount as compared to the Reliance Disney JV as well as Sun TV. So therefore, they say that the risk reward is highly favorable, and that is the reason why they've gone ahead and given a very bullish call on Z, and resultantly the stock is surging higher.
Devin, any thoughts? Z, I think it's been a while, months maybe, since we last discussed this one. But what do you make of it?
So Prashant, I think the re-rating is possible given the kind of a discounted valuation at which Z is quoting. But I look at this subject a little bit more differently now. The entire media entertainment business is no more a content play alone. From pure content play, I think it's more of a distribution play, and distribution on various platforms. Be it broadcasting platform or a streaming platform, I think you are required to have significantly large amount of presence of the customers in each and every product vertical or each and every program vertical that you may have. That is why clearly the Jio Star combination appears to be, I think, scoring significantly over combination like Z. So in my viewpoint, I would think that Z probably will have to wait, though the re-rating cannot be ruled out in this kind of momentum. That is not ruled out, but at the same time, the fundamentals, I would think more confident about, I think, how the proposition is emerging for JioStar as a combined entity.
Devin, did your team hear the Voltas analyst call? Stock is down close to about 1.5%. In a nutshell, the company did talk about focus on volumes, increasing their market share, regaining what they lost. But the street still seems to be a little concerned on the margin trajectory on account of higher competition, and therefore they may not be able to pass on higher raw material costs, etc. What was your key takeaway? Because the stock is down post the analyst call.
Yeah, I haven't had the chance to discuss with my analyst about the call, but I would understand that I think on one side, the demand scenario is emerging stronger. On the other side, I think it is not easily translating into the higher amount of margins for the company. Though compared to third quarter, I believe that I think our team believes that the fourth quarter would be relatively better on margin front as well. But nobody has a complete handle on it as to how much it will be growth as far as growth is concerned. So maybe once I catch up with the team, probably I think we'll have get more insight about what has been discussed on the call.
MobiKwik, the stock has been all over. The listing price was about 440. Stock peaked at 698. Then subsequently, very recently, it fell to levels of about 231. In the last 2 days, there was this turbocharged rally in the stock. And today, again, the stock has fallen. So it's been all over, down from levels of 231 all the way up to 698, which was the recent peak. Your thoughts on MobiKwik?
Either it is a trader's delight or it's a trader's nightmare. I think I do not know where exactly I think one would stand in this kind of situation. Fundamentals don't change, and frankly, I think this kind of businesses would require significantly large amount of time to justify the valuation in which they are quoting. I'm not a firm believer of, I think, paying a high valuation, even though I think these businesses have the opportunity to grow at a better rate. But the fact remains that I think everything is priced in, and if you are paying a fancy price to this kind of a company, I think that could possibly create a higher amount of disturbance in the portfolio. So maybe I think I would skip the entire proposition. Though as a consumer, I think I would love to use some of the consumer tech companies, the platform companies. But as an investor, I would be extremely choosy about adding them into the portfolio.
One more stock, let me throw a very similar name at you. I mean, it has really driven people up the wall, down the wall. That's this diamond certification company, Devin, the International Gemological Institute, right, IGI. And there's a wide debate out there about whether their business model itself is under question because now it's all about lab-grown diamonds, etc. Any thoughts if you've seen the business, if you've seen the stock?
Well, I think one will not write it off this particular entire subject of certification, because there is a market for the natural diamonds where this certification business will continue. And a significantly large market is also emerging in the jewelry segment from the lab-grown diamond space. So certainly lab-grown diamond is more of a commodity kind of a product vis-a-vis, I think, the asset product that we would like to treat the natural diamond as. And that is where probably I think the certification theory does not hold any kind of a value. And given that kind of a situation, in my viewpoint, I think probably if you are betting purely on the certification related income and the revenue per se, and I think asking that it should come from the lab grown, then probably I think I'm not a believer of that particular idea. I would think that I think over a period of time it will get more crystallized. But as of now, as we see, lab grown diamond probably is becoming more of a commoditized product activity vis-a-vis the asset activity in the natural diamond space.
All right, Devin, great catching up. Thank you very much for those insights. And we'll continue this at a later date. Well, the market is looking super strong, 1% higher on the Sensex. Nifty is up about 1%. And broader markets, of course, are doing well as well. We'll take a quick commercial break here. Some good news as we take that break. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the app, the CNBC-TV18 app, from the Apple Play Store or the Google Play Store. Just scan the QR code on your screen now.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
You know, the thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Well, the question is, are we, and it may seem strange that we still maybe prefacing the questions by this thought whether we are out of the woods finally. I mean, we're about 1,500 points, maybe more, from the lows that we saw, the absolute lows that we saw. But I said this yesterday as well, there are still people, and absolutely reasonable people, who would be wondering whether this is it, or there is one more kind of it's going to be painful, and whether this is just one of those bounces, a steep one at that, but that's about it. Let's put this to Tushar Pradhan, who's with us, director at Hexagon Partners. Tushar, good to have you with us here. Good afternoon. What do you think, Tushar?
Well, that's a tough one, because generally at the start of the year, we agreed that this was going to be a difficult year, simply for the fact that there were too many international events. There was overvaluation in domestic markets. There was pressure on earnings, which all indicated that the market was not going to be a smooth ride. And it kind of proved itself, because February was especially brutal, but it began probably September onwards last year. I would think that there has been some correction in terms of valuations from where they were. And practically, if you look at a 1 year rolling behind you, most of the gains which were there at the start of the year, last calendar year, they've all gone, they've disappeared. So we are practically back to where we were probably by February of 2024. Now, that's saying a lot, but which means that if we were to say that the market should take some speed from here, I think there are two things we should focus on. One is the continued momentum in earnings growth, which again, March being a very, very crucial quarter, we should get some benefit of. Second is the kind of selling that we've seen from the FPIs for so long. I don't think that is going to be a perpetual case, which means that the turnaround whenever it happens. And many times in markets, all of these things come at one time. So as all of the other negatives came at one time, I think the positives could also come back at the same time. And I think we might also see a bounce back. I have a strong feeling that as we began the year on a very bad or a bearish note, I think we'll end the year in a very different note. That is my call.
Do you want to hazard a guess how we'll end the year, Tushar? Different means what?
Different means then definitely better than where we are today. Because we began the year with looking at, as I said, a host of negatives, including the fact that maybe earnings were not really that strong as well. But I think the FY25 picture, having now gone behind us, we are talking about FY26 as the current year in a few days from now. and FY27 becomes 1 year forward. And I think that is something which is very, very strong from my perspective in terms of earnings numbers, and the EPS number can really be a big surprise on the upside. So all of those will get, kind of somehow discounted in the price somewhere during the end of this year. And that's why I'm saying probably by the end of the year, we'll be in a much better space than where we are.
You think we can get back to our all-time high levels?
To history, that has always been the case. So that's a safe yes, but maybe not within the year. But why not? I mean, if the earnings surprises come strong by the second quarter of the next year, I think we can see something like this by December. So I'm pretty happy about that.
A quick word on wires and cables. Increasing competition, stocks are getting derated. At Hexagon Partners, how have you read the entry of two large players in this particular segment? Did you all own it in any of your portfolios?
No, I thought it was one of the sectors that I think we missed out on, but we were happy that we weren't part of it, simply for the fact that when we were aware of what was happening in the cables business, the multiples of most of the businesses were at a level where I could not understand why they would trade at those levels. Because at the end of the day, it is a commodity which is very accessible and very easily available. So why would companies actually continue to trade at these levels? And that is more or less justified when you have some strong competition coming into the market. You will just destroy the valuation, because now you have a plethora of suppliers as opposed to earlier there were maybe a 4 or a 5 member set. Having said that, I think if the earnings continues to grow, it will have to now grow for more players than before, which becomes very challenging as a sector. And especially of a sector where the barriers to entry might be slow or low, sorry. It doesn't really, make sense to kind of hold them. At that time, at least that's when we thought. And even now, after the big, drop in valuations, which is almost halved, the valuations still are not really at the place where I would place a manufacturing unit like that at. So we're happy to, not own them. And I think something similar to what happens in the paints business is something that we are seeing here in a much more dramatic fashion. But that's what competition does to all.
Yeah, I know. It's for the market. It's like once bitten, twice shy, right? We've seen the pain in the paints segment and still not recovered. I mean, still waiting for things to really meaningfully improve, and therefore the fear around wires and cables. Take that point. Tushar, just give us 1 minute. There's a important and interesting story that's come in on X. We'll just address it and then get back to that conversation with Tushar Pradhan. Now, this is regards to a petition that has been filed in the Karnataka High Court. X has contested the government's takedown directives issued under Section 79 of the IT Act. We have Ashmit joining in with the details. Ashmit, so what exactly is X contesting here?
Well, the Elon Musk-owned X is up in arms, especially when it comes to the takedown powers of the centre. Bear in mind that the centre has been issuing takedowns under the IT Act, under the IT rules. And to be specific, the power that they cited is under Section 79. Now, what does that mean? Under Section 79, the government can suspend the safe harbour protection that social media companies like X have. And it is under the threat of that removal of safe harbour protection that takedown threats have been issued. That is what X has appealed against before the Karnataka High Court. X has essentially challenged the use of this power, saying that this is unconstitutional, this is illegal, and this is arbitrary. X's petition before the Karnataka High Court, in fact, goes on to call out, to flag concerns with respect to legality of the Sahyog portal. This Sahyog portal was introduced by the Government of India to allow for smoother transitioning and communication of takedown orders to social media entities. That is what X is up against, saying that we don't want to be a part of that. Also, in fact, X in its petition very clearly points out that this trend of issuing takedown orders is in clear violation of a 2015 Supreme Court judgment. In that Supreme Court judgment, it was very clearly pointed out, it was very clearly directed that any and all takedown orders will be as per Section 69 of the IT Act. And the Section 69 is relevant because it prescribes various procedures and safeguards that need to be followed when issuing these takedown orders. And that is what X is flagging, saying that these takedown orders are not only non-compliant with the Supreme Court judgment, also non-compliant as far as these provisions of Section 69 are concerned. And with that, asking for release from the Karnataka High Court. And also, let me also take this moment to, in fact, draw in a caveat here. Important to point out that this is unrelated to the Grok issue. That is an independent inquiry that the centre has initiated, where it's looking to seek answers as to why Grok is generating the kind of unhinged responses that it is. This is independent of that. These are two independent issues. But nonetheless, on the issue of takedown orders, X knocking on the doors of the Karnataka High Court.
All right, unhinged responses. Ashman, thank you very much for that. That is, our colleague Sante has put together, she asked, just to kind of figure out, because over the weekend, I think this was a big thing. There was lots of this stuff being posted on social media, and people were asking Grok stuff and putting out stuff. Sante has asked her own questions. And, I think she's going to be putting that piece out on at least social media a little later. So...
Do you remember any answers?
Stuff. I have a few, but I can't. We'll wait for the stuff to go out. But incredible. You got all these tools now, which kind of really, speeds up things.
Absolutely.
You got ChatGPT, Perplexity, starting to be widely used now. And of course, now you got Grok as well out there. Tushar, so your view is positive, and to the question of whether all-time high by the end of the year, why not, right? So what will lead the market there? What are you most bullish about?
I think clearly, I think the ones which have been laggards so far, which is the financials, and which are key in terms of where the economic growth will come from. I think those are the ones which will lead, because if they start to move, which they haven't for a long time, then you will get a very significant momentum in index movement. And I think that's really where it will come from. Because otherwise, your mid and small cap companies are not going to do much heavy lifting as long as the index, as far as the index is concerned. So which means that you need the heavyweights to move. And I think that is really where the confidence comes from, because the heavyweights have not moved at all. Whether you take any of the biggies, especially now that the IT pack took a big severe beating some time back, they've come back a little bit. You've seen the financials also, they've taken a big hit. They are trying to come back. If you take absolute valuations, I think they are now significantly lower than the longer term averages at what they've traded at. And I think even if they go back to the longer term averages, you get a significant move in the market. So that's really where the confidence comes from at a top market down level.
Okay. Tushar, we were just talking about wires and cables earlier, and you were obviously cautious in that space for reasons that you explained. I want to just talk about the other sector. Typically, these are themes that start working when it's the season, literally, summer. So I'm talking about some of the consumer durable players, room air conditioners, etc. Beyond just playing that theme for the next couple of weeks, do you see some merit here, reasonable growth, valuations, etc.? How's the overall, consumer durable segment looking?
No, as I said, I think we are actually quite constructive on this space for two reasons. One is that there has been a significant move to increase consumption levels in this country. And if you remember, already, of course, the budget is a forgotten subject. But all of the kind of benefit that a large section of India's population is going to get from absolutely zero tax on their income now, which are a large number of filers, have to find, some place for this discretionary income to go to. And what better than a summer season to, install a new AC or, get yourself a purifier or whatever that means. I think this is something which is going to be I would say, a multiplier effect, where you have regulations going in your way. You have significant discretionary income, and the fact that seasonality, etc., is lending you to push in a certain way. And as I said earlier, also these impacts could be longer term in nature, and I think there might be a significant improvement in terms of the demand situation as we go into the summer and beyond. So I think this is a space which is something to watch out for.
All right, Tushar, thank you very much for joining us. Appreciated your thoughts and insights here on CNBC TV18. We'll take a quick commercial break here with news that the market's up 280 points. Nifty Bank is up 0.75%, and market breadth holding very, very strong. Take a break. See you on the other side.
Welcome back here with us on Closing Bell. Defense stocks obviously have been on a bit of a tear. Yesterday, they were all surging up and about quite a bit. Now, sources are telling us that the Defense Acquisition Council is all set to meet today. The Cabinet Committee on Security has also cleared a 7,000 crore rupee purchase of artillery systems manufactured by Bharat Forge, which explains some of the excitement around that stock. It's up about 5% as we speak. We have Parikshit joining in with more details. Parikshit, defense stocks definitely all powered up and charged up. But tell us more.
Well, definitely. And this is one of the biggest Make in India orders in the defense sector that is going to the private companies in the recent past. As you rightly said, this is a 7,000 crore order. The total number of howitzer guns that are being acquired through this program is around 307. They will be used to equip 15 artillery regiments of the Indian Army. So these are Indian-made howitzers, a 52 caliber, 40 kilometers of range, which is one of the highest in the world for such weapon systems. Because 60 or 65% of the components are locally sourced, the self-reliance will be very high and Indian Army will be able to maintain them very easily as well. 60% of this order is going to Bharat Forge and 40% to Tata Advanced Systems Limited. We've been told that the deliveries will begin in the second year of the order and have to be completed within 5 years. That's not all. A major Defense Acquisition Council meeting is going to take place and they will be clearing an acquisition of BrahMos cruise missiles for both the Army and Air Force. This is going to be a big order. At the same time, DAC is considering the acquisition of 400 Astra air-to-air missiles, the acquisition of 60 indigenously developed Varunastra torpedoes for the Indian Navy is also on the cards, and Bharat Dynamics is the manufacturer for this Varunastra torpedo. And the government overall has been working to speed up timelines for acquisition of critical defense systems, arms, ammunition, and missiles for all the three forces.
All right. So defense very much in focus. Yesterday there were the shipbuilders and today you've got the others which are starting to move as well. Parisha, thank you very much for that. Well, Mitesh is back with us with fresh trades, short term though, what to buy or sell today for reverse trades tomorrow. Mitesh, what do you have?
So, Prashant, I think, despite the fact that the markets now on the hourly charts are getting close to slightly overbought levels, will maintain a long stance given the fact that there is no sign of apparent profit booking or weaknesses yet. On the stock side, I would take a BTST on Dr. Reddy's. I think that's a stock which has moved well in the last 2-3 days and is showing good potential. So buy here or BTST here with the stop at 11.75 and look for a target of around 12.10 for tomorrow. And the other one is Gas Authority of India Limited. That's GAIL, just at the averages. So actually, this can be, once it crosses today's high of 169.5. So buy here with the stop. Once it crosses 169.5, then take a stop at about 166 and look for a target of 175. More of a short-term trading call.
Dr. Reddy's and GAIL. Thanks, Mitesh, for that. Let's turn our attention now to the insurance sector, which has seen a flurry of activity this week. A total of 5 major deals were either announced or finalized, making it one of the most eventful weeks for the industry. Yash is here with the details.
Well, Reema, just going by the numbers of transactions which have been announced in India's insurance sector, it clearly has been the most eventful week in the life of, Indian insurance sector. In the last 7 days itself, a total of 5 large deals have been either announced or they've been consummated. Let's go by the date. On March 13th, Baba Ramdev's Patanjali Ayurved, along with the Dharampal Satyapal or the DS Group, announced acquisition of about 98% stake in Magma General Insurance, valuing the company at 4,500 crore rupees. Adar Poonawalla will be selling nearly 75% stake in Magma General Insurance to Patanjali Ayurved. Also, Patanjali Ayurved will have about 74% stake in the company. They will pay about 3,330 crore rupees, and the DS Group will own about 24.5% stake for about 1,100 crore rupees. The next announcement came on March 17th. Bajaj Finserv and its promoter companies announcing acquisition of 26% stake held by Allianz in both life and general insurance joint ventures. Bajaj Finserv and its promoter companies will be paying about 13,780 crore rupees for a 26% stake in Bajaj Allianz General, valuing the company at 53,000 crore rupees. The deal being done at about 4.9 times FY24 price to book value and 2.6 times times FY24 price to GDPI. Also, Bajaj Finserv and its promoter companies will pay about 10,400 crore for a 26% stake in the life insurance entity, valuing that company at about 40,000 crore rupees. This deal being done at about 1.84 times price to embedded value on a FY24 or a trailing basis. Now, who will acquire how much of Allianz's 26% stake? The first listed company, that will be Bajaj Investment, that will be acquiring about 19.95% stake, Bajaj Finserv about 1.01% stake, and Jamnalal Sons about 5.04% stake. On the very next day after this, which was March 18, came the next announcement. Hinduja-backed IIHL announced completion of acquisition of Reliance Capital. Through this, Hinduja Group will own 100% in Reliance General Insurance and 51% in Reliance Nippon Life Insurance. Hinduja Group will also consider listing of the two insurance entities in a period of about 2 to 3 years. On the same day, that was March 18th, LIC CEO told CNBC-TV18 that LIC will announce an acquisition of a health insurance company. As per LIC, the talks are at an advanced stage and LIC will look to acquire not a majority but a significant stake in the company. Reports suggest that LIC could be looking at Manipal Cigna Health Insurance for the stake acquisition. As far as the final deal is concerned, that of course came today, March 20th, where about Prudential PLC, which is present in the asset management as well as the life insurance industry in India, has said that they will be forming a joint venture along with HCL Group, Shiv Nadar's HCL Group, to enter the health insurance industry in India. Prudential PLC will be holding about 70% stake in this health insurance venture, and Vama Sundari, which is essentially the parent company or the promoter company of HCL Group, will be holding about 30% stake. So 5 large deals in just about 7 days. Still Friday remaining. God knows what's in store for that one.
God knows. Yes, thanks very much for that. So, well, there are lots of deals, lots of insurers. And of course, I mean, this is insurance, but take a look at what's happening in, sector after sector. Newer entrants, increased competition in a lot of areas. Cables and wires, of course, we highlighted. There is insurance and many others that we've told you about. Paints is another sector, and so on and so forth. Well, we'll slip into a quick commercial break here. We're going to come back with snippets of our conversation with Rajiv Thakkar, the CIO and Director of PPFAS Mutual Fund. We spoke with him about what he likes, what the fund house is buying at this point. Stay tuned.
In terms of the valuation parameters, although we are better valued now than we were, let's say, 3-4 months back, but are we at cheap valuation levels? Answer is no. Is there still froth in large pockets of the market? I think the answer would be yes. So bottoming out will happen, I think, stock by stock and sector by sector rather than the overall market bottoming out. So you could have this strange situation where some stocks look attractive and people will start buying them and they could stabilize or start moving up. At the same time, segments which are very, very frothy could see a sustained price correction over a point of time. The buying has been in spaces where we already own positions. So for a long time, we have been liking the banking and financial services names. So we have been owning 4 private sector banks, and those have been things that we have been buying. We have been, as would be seen from our February portfolio disclosures, we have added positions in some of the auto names that we have, or the public sector companies that we own, or in the pharma companies that we own. Largely, it's been the same names. In December and Jan, we added a couple of new names to the portfolio, but those are the places where we have been deploying. A lot of this, I think, is posturing, trying to get other people to balance their economies. So you spoke about China. The measures in China are to increase domestic consumption and domestic economy rather than just depending on exports. So Mr. Trump is right in that sense that US cannot be a trade deficit company forever for very, very large amounts, and ultimately some rebalancing has to happen, and that will happen. But let's say even if tariffs are brought down on something like a Tesla, will it change the auto market domestically very, very dramatically? Unlikely, because they operate in a very, very high price segment. So adjustments will happen. Will it be a very different morning on 2nd of April? I have my doubts. I think more or less it will be business as usual.
Welcome back. A little more than 5 minutes left to close what's been a solid session for our markets. Good Thursday. The Nifty up 280 points, not perhaps closing at the day's high, so not above 23,200, just shy of that. But fourth day running that markets have clocked in gains, and in the last 4 days, we've covered considerable ground. Bharti Airtel, Titan, Britannia, Bajaj Auto, BEL, BPCL. So the gainers are cutting across sectors. Mayuresh Joshi, head of equity research at William O'Neill, is now with us on the show. Mayuresh, do you think there is still skepticism about this rally that we're seeing? Will it falter at higher levels, or do you think it has more legs to go?
Afternoon, Rima. I think there is still belief that the markets might actually go down. And that's because of the kind of selling pressures that we've seen over the last few months. And obviously, I think the macro conditions, which have not changed much over the last few weeks as well. So again, I think there is some bit of skepticism that still exists in the market. But in our opinion, as we've seen in the past as well, and the report that we carried a few weeks back, I think there were a lot of indicators that were pointing out that a large part of the price damage has been done by the market. Earnestly, nobody was expecting a 1,200-point rally to probably come through, in my opinion. Yes, there were shorts in the system, Rima. But again, I think this rally has been phenomenal over the past few days. Whether this persists or not over the next few weeks, I think we'll come to know. But again, I think you have to be a little bit more sector and stock specific in these markets.
Okay, fair enough. So let's talk about those specific stocks and sectors where you're seeing opportunity. Mayuresh, hi, good afternoon. So, I mean, the broader mid-cap market seems to be getting some sort of its mojo back. Here, let's talk about some pockets. Defense got very excited. Our colleagues just told us that there is a Defense Acquisition Council meeting as well today. Would you buy anything in defense?
Afternoon, Surabhi. No, again, I think the big picture stays with defense because most companies are loaded with order books over the next 6 to 7 years. So I think the revenue visibility obviously persists for that periodicity of time. The orders have come with decent margins as well. And therefore, I think as they execute well, you're probably going to see the net results in terms of operating leverage, better EBITDA performance, and better absolute bottom line numbers probably come through. Obviously, the sector and the stocks within those sectors had moved a tad bit too much for comfort over the last few months and last few quarters as well. And obviously, the correction that you probably saw in the markets, defense stocks got beaten down the most. Obviously, a few stocks within the space would be execution was not at par, and therefore analyst expectations and what they delivered in terms of earnings were a little bit of a mismatch. But in our own sense, again, I think the big picture argument stays with defense, the ratings and rankings as we see it in markets with India, and a lot of parameters that we look at from a cancelling perspective. I think the space probably looks good. Bharat Electronics is something that you should have your own watch list if you don't. The shipbuilders apparently also have done phenomenally well over the past few days. But here again, I think the rating rankings look very, very superior. So something like a Cochin or a Mazda might actually carry on their momentum as well.
The capital market plays, Mayuresh. Novama, for example, is making a bit of a comeback.
Afternoon, Prashant. I think within the space, again, I think asset managers is something that that looks decently poised. And therefore, I think you're probably looking at the construct in terms of the asset ownership as far as equities is concerned. It's very minuscule compared to the global and the emerging market average as well. The SIPs that are expected to continue, the expectations in terms of number of households, the ultra HNI households, which might actually double from 8 lakh to 16 odd lakh over the next 2 to 3 years, will need financial advice in some form or the other. And therefore, I think asset allocation for these households itself is going to be a very key criteria for the next few quarters and years, and the help of professional asset managers as well. So absolutely. I think asset managers is something that is showing up on our screeners and filters that can probably do better with the capital market.
Okay, but I mean here the asset managers maybe are going to be in focus as well. By the way, you've looked at this. Something is happening in Kaveri Seeds, Mayuresh?
No.
I mean yeah, sorry. Go on.
No, did not have a look at that, Prashant. So sorry for that. But again, I think the expectations in terms of La Nina conditions actually evolving. I think I read a couple of more reports which are probably indicating to that. I read an Australian agency report as well, which bodes well for the rural sector as a whole. You've obviously seen a good Rabi output, a harvest and an output expected as well. And therefore, with La Nina conditions evolving, Kharif season might be equally good, followed by an equally good Rabi season as well. And therefore, I think all these rural players, seed companies, fertilizer companies, agrochemical companies, tractors, might actually remain in focus. Because if the rural economy comes back strongly, I think the proxy to all of them might actually start doing well in terms of reported numbers. So,
quick word on Z. CLSA believes the stock could double in the next 12 to 24 months. Valuations at rock bottom, 8 times PE.
Beaten down, bouncing back, but I think it's all about numbers, Rima.
So wait and watch.
Oh, absolutely.
For the numbers to play out.
Wellspun Corp, any thoughts here? The pipe maker, Mayuresh?
Remain extremely positive. Prashant, as a clear disclaimer, I think we've added that stock to our portfolios just today. And therefore, I think the kind of dominance that Welspun has, one of the 3 large global line diameter pipe makers in the world, there is a huge scope as far as the capex is concerned, both from the domestic side, where there is expectations of 11,000 odd kilometers expected to be put in terms of city gas, in terms of sewerage pipes as well. And as well as Saudi Arabia and US, where they're having a huge capex probably done because of the orders and the expectations in terms of the spending that will come through from their economies as well. So numbers holding up, more than 15,000 crores worth of order book, and operating leverage and ratings and rankings look absolutely fat. So again, biased here, and then we continue holding this stocks.
All right. Okay, Mayuresh, we will just take a breather for a second. Let's quickly recap today's close, and then we'll come back for more questions. It's been a good day. Not quite at the highest point of the day, but nonetheless, with a 260-point move, the bulls will take it with both hands. 23,200 may have to wait for another day, but otherwise, it's been a big up move. I mean, let's talk about the Nifty movers. It's a big Nifty day, actually, even better than the mid-cap index. Bharti Airtel, 4%. Titan, almost 4%. There's Bajaj Auto, 2.5%. Britannia, Eicher Motors. You've got names like HUL. Overall, consumer stocks have had a decent session today. Tata Consumer. Beyond that, auto has also been a very solid spot. Eicher Motors, Bajaj I mentioned. There's M&M that's seen buying. Hero Moto also on the upside, so looking good out there. Then a lot of the large cap names have contributed very well. TCS, finally tech stocks stopped falling after the drubbing they got earlier this week. TCS up about 1.5%. There are names like Reliance that have done really well today. And financials continue to chug along. HDFC Bank, for instance, up over 1.5% in today's trading action. Actually, everything in the market was fine. Bajaj Finance took a bit of a break, slightly lower. IndusInd Bank fell. But apart from these 2 or 3 stocks, practically everything on the Nifty in the green today.
Well, absolutely. And, a solid session. And it kind of sort of is looking good for the week as well after a while, right? There's already a 3% week for the Nifty and about a 4% week for the Nifty Bank. Although for the mid and small cap indices, oh wow, small cap index this week, that is last Thursday's close. Friday was a market holiday. So we basically have a 6% gain on the Nifty small cap index this week. And I think for the mid cap index, the number is 6% as well. So it's very sharp turn is what we've seen after last week was a bit of a break and we went sideways. But from the lows, looking really smart now. We'll take a quick commercial break here. Thank you for staying with us in Closing Bell. But markets forward will come up. Rima and I'll take you through what to watch out for as you come back tomorrow.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building.
The market continues to reclaim lost ground amidst Fed interest rate decision. Nifty peaks to 23,100 mark for the first time in a month. The Sensex reclaims the 76,300 mark. IT stocks stage a strong comeback after losses yesterday. Auto and metals were among the top gainers as well.
KEI Industries polycap stocks crack in trade. This is after Adani announces its entry into the cables and wires business with a joint venture. This comes weeks after Ultratech made a similar foray. Analysts see the entry of big guns impacting growth and profitability of the incumbents.
The Ministry of Heavy Industries has questioned Ola Electric over alleged discrepancy in sales data. Sources say while the company claims 25,000 vehicles were sold in the month of February, only 8,600 vehicles were registered. This is as per the Vahan portal. That is a CNBC-TV18 exclusive. Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we try to capture everything which is useful, which is going to be useful for you as we look ahead and come back to the next trading session. I'm Prashant. With me, my colleague Reema. Reema, hi.
Hi, good session for markets, right? Extending gains, the Nifty almost at the 23,200 mark. We'll talk more about it in the next 20 minutes. We'll talk about the markets, the big news, the key developments in the Lal Street, the top corporate voices, and the big events to track ahead. But the recovery rally marches on, 4th day in a row.
I think we should be headed to, fingers crossed, don't want to jinx it, 23,600 maybe next, because, we've kind of moved away from looking at, and, there are still enough people who are looking over their shoulders, and there's a fair bit of covering, etc., kind of activity happening. So it's not all clear. But the market's now got some legs, gains are broadening out, etc. And that's why I'm saying we are not looking at hourly averages or even sort of, short-term daily averages. You're looking at slightly larger time frames here. And the reason I say 23,600 is because that is the 38% retracement of the big fall, from the full fall, which is from the peak late September, October to the recent lows. So that's about 400 points away from where we left off today. So just under 23, 200 is where we close today. Now, so that's the broader picture, which, of course, this has also meant that the week is turning out to be pretty good. For the Nifty, it's 3%. For the Nifty Bank, it is 4%. That is last Thursday is close to today. And, of course, the mid and small cap indices, 6% each. So very, very clean, and, market's been trading confidently all of the last 4 trading sessions without really any hesitation, even when we've had Wall Street, which has been which kind of sold off. Last night, of course, that was not a problem, but yesterday that was an issue, and the market just sort of looked ahead and shrugging those losses off. And that gives you more confidence that maybe, this has got more to go here. Reema.
Well, from the March lows, it's been a swift 1,200-point recovery on the Nifty. From sub 22,000, we're now knocking on the doors of 23,200. All sectors closed in the green, but the sectors right on top of the list were defense, oil and gas, autos. The Nifty Auto Index up 1.5%. IT closed up in the green, 1.25% higher on the Nifty IT Index, but came off a tad bit from the day's high. Let's also tell you what we have for you on our show today. Top movers and shakers with Hormis, individual stocks. We'll cover that. Adani Enterprises powers up with its entry into cables and wires, while Ola Electric hits a bump with discrepancies in its sales data. On the flip side, Zee Entertainment surges following a bullish CLSA note. So we'll get you more on that, and then the big events to watch tomorrow, Friday's trading session. But first up, it's over to Hormis. Let's get a handle on the big movers and shakers.
continuing to move on from where we left off over the start of the week, and it's been a good week as Prashant was just mentioning. And of course, you can't leave out the top heavyweights on the index for the kind of moves that we've seen in today's session, be it HDFC Bank, be it Reliance, be it TCS, all of them contributing, and most of them also ending at the highs of the day. The star, of course, being Bharti Airtel, 4% higher in today's session as well. Defense stocks continue to shine. Most of them had taken a very, very severe drubbing from their highs, but they're recovering from the lows now. Bharat Dynamics in focus ahead of the meeting later this evening. Bharat Forge also ending at the highs. Garden Reach after yesterday's 20% circuit up another 4.5%. So good going for the defense names. Some other newsmakers on the back of order wins, acquisition announcements. GPT Infra won an order at one point, was up almost 13%. Automotive Axles also announced a pact earlier, just before minutes before closing, ending 6.5% higher. KPI Green, NCC both winning orders, and good gains there as well. Stocks that did well on the back of volumes, and Shipping Corporation, a strong day yesterday, a stronger day today as well, 10.5% taken here. KEC International, Welspun Corp moved towards the later half of the session, 7.5% higher on very strong volumes. And lastly, the accident of the day, can't not ignore this segment, the wires and cable stocks. Only the RR Kabel was the one that survived the onslaught, ending in the green, but most of the others, KEI, Polycab, 6 to 12% lower. Back to you guys.
Thank you very much for that. Devin was telling us that some of them may even emerge as acquisition targets, and he's watching for Finolex cables in that list. Let's invite Mayuresh Joshi of William O'Neill and Richard Jain of Motilal Oswal Financial Services on the show now. Gentlemen, thank you again for joining in. So Richard, first, where are we headed in terms of the Nifty? The Nifty Bank crossed that 50,000 mark after a while. Prashant is looking at 23,600. What's the level you're looking at?
Yeah, hi, very good afternoon, Rima. Very good afternoon to everyone. If you look at this rally of last 3-4 trading sessions, it's a broad-based rally. And mainly, the factors that worried our market since the month of October, one of them was the dollar index, which rallied from 100 to 110. And second was the FI selling. So both these factors, have turned favorable for our markets off late, where the dollar index have cooled off from the high of 110 to 103 now. And even if you look at the FI's figures, they have not been net buyers aggressive in the cash segment, but at least in the index futures, they have started covering the short positions, where the long-short ratio has improved from 15% to 27% as on yesterday. So I think if they continue to cover their shorts and move towards 40, 45 or 50%, then I think this should take the Nifty further higher. The first level that we are watching out is the 200 DEMA, which is around 23,400. And then, of course, as Prashant indicated, that 23,600, which is also the 38.2% retracement of this entire 4,000 points correction that we have seen from 26,000 to 22,000. So 23,400, I think, would be the first one where 200 DEMA is placed, followed by 23,600. I think those levels should be tested.
Absolutely. And, will it happen immediately, or... actually 2 days more like what we've had so far. It'll get the job done, but we'll see if that is indeed the case. Let's, talk about that, the last set of stocks which Hormuz highlighted, which is the accident of the day, which is cable and wire companies. So, just recently the stock sold off with the Ultratech announcing an entry, and now it is the Adanis announcing an entry. Some recovery from the day's low, but not very much. Vinny is here with details. Vinny, take it away.
So absolutely, clear pressure that came in for these cable and wire stock names. And why? Because that increase in terms of competition, like you were mentioning, in the segment. Adani has announced that they will be forming a JV for the cables and wire segment and foray over there. Kutch Copper Limited, which is a subsidiary of the company, 100% owned subsidiary of the company, has formed a JV with Pranitha Private Limited. They will be forming Eco Cables segment and JV. This is going to be manufacturing, marketing, distributing, buying, selling metal products as well as cables and wires. We do not know the amount of capex that Adani Enterprise is going to be putting in on this one, but analysts are saying that this is surely increasing competition for the players in terms of who are already there. Do not forget, just last month for Feb end, when we saw that Ultratech had announced its foray into cables and wires segment, and this is mainly that they had announced that 1,800 crore capex is what they'd announced over the next 2 years. Analysts are saying that this could impact overall the EBITDA pool of the industry and impact coming in for these players who are already there, as well as in terms of the return ratios. That could see some bit of an impact on that front as well. Increasing competition, a bit of a worry coming in for these other players in terms of peers. That is why we're seeing that these stocks have seen pressure coming in, especially since the end of Feb to now. We're seeing clear fall coming in for these stocks.
Thank you very much for that. Mayuresh, these stocks were first overwhelmed with the kind of valuations they were trading with. And then Ultratech entered, and now the Adani Group, and the stocks have just been in sort of a free fall. KEI was at levels of 3,800 before the arrival of Ultratech Cement or announcement of Ultratech Cement. Now it's down to 2,800. Where from here? Is there more weakness in store?
Again, I think for the new facilities to come up, whether it's Ultratech or Adani, I think it's going to take time. So there is no two ways about it. And therefore, at least for the next few quarters, I think the existing players are probably going to enjoy the benefit in terms of sustained market share that they have, pricing at their best as well. But with these two players coming in, the expectation specifically for organized players is that pricing might not go down, in the sense that there might not be any massive price cuts like you've seen in the paint sector. And therefore, I think what kind of market share gains do they take, whether it's from organized or from the unorganized market, is to be seen. And therefore, I think there will be some element of pricing which will remain circumspect. How will volumes play out once these players enter the market is going to remain circumspect. And that's where the fear is. In my own sense, I think looking at how the fundamentals are moving out, how the RS ratings are shaping out, these stocks might actually go into huge time consolidation as we speak.
Okay, all right. Vinit Samre of DSP Mutual Fund also had a viewpoint, and he kind of compared this to what happened with the paint sector. It's interesting. I mean, of course, here the damage is happening almost now, immediately. With paints, it was a little different. Listen in.
When we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years, it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks, I think, corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large.
All right, the opportunity is large, but it's also obviously that is also attracting more players, as what we can see. Now, the currency market is also looking stronger. The rupee is rallied for the 6th straight session, gaining 1% over the past 1 week and 2% from its all-time lows. This is on the back of likely current account surplus this quarter and slowing FPI outflows as well. I mean, the sentiment turning in equities also is a huge sort of factor for the currency market as well. Those are sort of changes which are coming up on your screens right now. Mayuresh, one influences the other, chicken egg, right? I mean, but of course, what is your sense? This is how important a factor is this? Any equity implications really?
Again, I think we were just mapping out a large part of how the dollar index has probably moved over the past few years and in the past few corrections as well. And looking at the rhetoric that's probably playing out in the US, there is expectations that the currency should stabilize as we speak. And then that's probably a global view that we are taking at Video O'Neill. Obviously, I think the core beneficiaries with a depreciating rupee were obviously IT and pharma. But to a large extent, I think even these companies hedge their foreign currencies to a large extent. And even if they incrementally keep on depreciating, I think the incremental benefits do not probably flow through. As the currency strengthens, and I don't think the rupee will strengthen quite significantly. I think it's going to be a slow, drawn-out process. But it's positive from a macro perspective if it just stabilizes. Because whatever gains we are getting, as an example, with lower crude prices, I think they were getting offset with a depreciating rupee as well. That was affecting the trade and the current account deficit as well. To a large extent, macros improve. Any reporting sector, specifically like textiles, like pharma, like IT, might just benefit a tad bit because of the depreciating rupee.
Okay, let's get to the other story. The Ministry of Heavy Industry questions Ola Electric over alleged discrepancies in its sales data. Sources say while the company claims 26,000 vehicles were sold in February, only 8,000 vehicles were registered as per the Vahan portal. That's not all. The company's also landed into trouble with Maharashtra RTO authorities. Parikshit is joining in what he's learned from his sources. Parikshit.
Well, yes, Ola Electric now facing questions on multiple fronts. Let's begin with the action by Ministry of Heavy Industries. The Ministry of Heavy Industries is the nodal body for the auto industry, overseeing the incentive outlay under the PLI automotive scheme and also under the PM E-Drive scheme. So Ola is a beneficiary of both these schemes. So they have now sought details from Ola Electric as to why is there a difference between what Ola Electric has told the exchanges as to 25,000 vehicles sold in the month of February versus 8,700 that have been registered in the MORTH portal. So they want to understand why this has happened. Secondly, the government is also following the case that has been filed by Rosemerta Digital Services, their vehicle registration agency, against Ola Electric. This is to the tune of 22 crore rupees. So the outcome of that case is also being watched. At a separate front, state transport authorities have been carrying out inspections. Officials have been visiting Ola stores in Punjab, Madhya Pradesh, also Maharashtra, Karnataka, to see if the stores, the 3,500 Ola stores in the country, actually have valid trade certificates or not. In some cases, they were not found to have trade certificates. Scooters have been seized. We believe around 30 to 36 scooters have been seized in Maharashtra alone, in Pune and Mumbai. This is because unregistered scooters were found. Trade certificates were not there with these experience centers. So not very good news for Ola Electric on multiple fronts. Having said that, we did send a detailed query to the company. They are yet to respond formally, but sources close to the company say they are confident of achieving all their sales targets for the month of March and also completing deliveries for the month of February as well.
Okay, Parisha, thank you very much for that. Ola, of course, has been in a bit of a free fall. Although earlier this week, one of these days, you had a big move on the upside as well, but more often than not, it's down. About 51 odd rupees, 52 or so is where that it ended. Z Entertainment is another one of those bombed out names. CLSA, the broker, is projecting the stock to double in value over the next 12 to 24 months. What are the triggers? Vamakshi is standing by with details. Vamakshi.
Well, Prashant, CLSA has come out with a report on Z Entertainment. They have an outperform rating on this counter, target price of 170 rupees per share, which implies a significant upside from the current levels. They say that the stock has slumped by almost 55% after its merger deal with Sony was called off. And in fact, the stock has hit a rock bottom valuation of 8 times PE. They believe that advertisement revenue-led growth will be a key rating trigger for the counter. Keep in mind that Z is India's #2 TV network, and in fact, they're also improving their presence in the OTT space through their Z5 business. Keep in mind that the company's margins had already widened by around 9 percentage points to 16% in the quarter gone by, and CLSA expects that the margins could further expand to 22% by FY27. Now, assuming that ad revenue grows by 6%, they expect an EBITDA and PAT CAGR of anywhere between 22 to 33% in FY26 as well as 27. As far as valuations are concerned, Z's market cap to sales stands at 1 times, which is coming in and at a 60 to 80% discount as compared to the RIL Disney JV as well as Sun TV. So therefore, they believe that the risk reward in this counter is highly favorable.
Thank you. Oh, sorry.
All right, Vamakshi, thank you very much for that. Now, I was just asking Mayuresh, we talked about Ola, we talked about Z, both completely bombed out, right?
Boom, yeah.
And Mayuresh, I don't know if you have a view on either of those, Ola or Z.
No, so again, I think Prashant will wait it out because I think there are far better stocks to look at within the broader markets. They have also corrected significantly. The valuations have become inexpensive and they're making good bases as we speak. So I think better companies to look at in the broader markets.
Ruchit, you want to come in on Ola or Z Entertainment?
The technical trend still remains negative for both of them. Yes, post the recent correction, the momentum readings are oversold and we could see some pullback moves. But frankly, these counters have shown a big underperformer, not only during the corrective phase, even when the markets were going up. So I think it's better to wait for a bottom-out approach where either high top, high bottom structure with good volumes come in, then only one should look for buying interest later on. But no, not the kind of stocks where would recommend any kind of bottom fishing here.
Okay, all right. Earlier on Closing Bell, Mayuresh was, of course, talking about one of the big volume-led gainers, which is Welspun Corp, 7.5% higher today. And almost about, actually, it's one of those names which never corrected in the fall that we saw from the highs. Nothing, but it corrected about, I think, 10-12%, that's it. and it's basically back at highs once again. So that is Welspun. Ruchir, just very briefly, 10 seconds, any thoughts on Welspun Corp and also KEC, which has come up very strongly from the lows?
I think Welspun is looking quite positive. Today's breakout has also been accompanied by very high volume. So I think, and as you said, it was a relative outperformer even during corrective phase. Then we should head higher toward 930, 940 as per the retracement levels. KEC International, I think 900 would be the crucial level to watch out for where 200 DMI is placed. So as of now, taking this just as a pullback move for now could extend this pullback towards 900.
Okay, number one volume-led gainer today on the NSE, KEC there. Thanks very much, Ruchir, for joining us. Mayuresh, appreciate your time here on CNBC-TV18. We'll take a quick commercial break here. We'll come back, some corporate voices that we got through the course of the day and some events to watch out for tomorrow.
Startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key news makers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. Let's take a quick look at the key corporate voices that we had through the course of the day on the channel. Transformers and Rectifiers, that is TRIL. The management was with us. They've guided for 3,600 crore rupees in revenues and order inflow of about 8,000 crores for FY26. On the margin front, the company says they are aiming for a 17% margin over the next 2 years, largely led by operational efficiencies.
CAMS was also in focus after the company signed an agreement with LIC to provide insurance repository services. The management said the company is nearing 80 lakh e-insurance account holders. While insurance repository business is not large right now, it currently accounts for less than 2% of the total revenue. But the management is expecting solid growth, 25 to 30% growth in that business next year. They also added that the company's repository business is currently not adding anything to the profit margins, not significantly, but it does expect to see double-digit EBITDA growth going ahead.
Well, okay, let's talk about events to watch as we come back tomorrow. Vamakshi is here with what to watch out for on Friday. Vamakshi.
Well, good afternoon, Prashant. It's the last trading day of the week, so obviously we'll be looking out for the weekend. But jokes apart, L&T will be in focus. The board meeting is scheduled tomorrow to consider fundraising plans by way of debt issue. Keep an eye out on Samvardhana Motherson as well. Board will be considering interim dividend for FY25. As far as corporate action is concerned, keep an eye out on Greenlam. The stock goes ex-date for bonus, which is in the ratio 1:1. A couple of other stocks that are actually going ex-dividend include CG Power, NMDC, as well as IRFC. But apart from that, keep an eye out on the FTSE adjustment, which will take effect tomorrow. 40 new stocks will be included in the FTSE, in the FTSE India Index. And on the back of that, keep an eye out on 361 WAM, Ajanta Pharma, Apar Industries, among several others.
Thank you very much for that, Vamakshi. But we do agree, Friday is the biggest Q to watch out for. But that brings us to a close in this edition of Markets Forward. Thank you very much for watching. Don't go anywhere. More news and updates continue on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Indian equities continue their rebound for the fourth day as US Central Bank's decision to keep rates unchanged sparks a rally across Asia. The Sensex and the Nifty surge over 1% higher. The Nifty crosses 23,200 for the first time since the 13th of February. All sectoral indices close in the green, led by the IT sector.
Sentiment is quite negative at this time. And that probably has to do with, turmoil at the beginning of an administration that's making, big changes in areas of policy.
U.S. Federal Reserve maintains the status quo on benchmark interest rates for the second consecutive time as it anticipates Trump's tariffs to push inflation higher, but hints at least 2 more rate cuts this year. U.S. President Trump disagrees with the Fed, says the central bank would be much better off cutting rates. The rupee strengthens to an 8-week high before giving up some gains on profit booking, marks its longest gaining streak in 14 months. Oil prices inch higher on the back of renewed tensions in West Asia and a decline in U.S. fuel inventories. The government seeks details from Ola Electric over discrepancies in reported sales and vehicle registrations. The company claims that 25,000 vehicles were sold in February, but only 8,600 vehicles were registered. As per data on the Vahan portal, Ola Electric says that all vehicles would be delivered only after their registrations are completed. The Cabinet Committee on Security approves a 7,000 crore rupee deal to procure advanced howitzers from the Indian defence equipment manufacturer. Sources say that Bharat Forge will account for 60% of the order book and Tata Advanced Systems for the rest. Social media platform X moves the Karnataka High Court against the Indian government's power to take down content under the Information Technology Act, argues that such orders are in violation of a Supreme Court judgment. The Apex Court in March 2015 had declared that content could only be blocked through a competent court order or under Section 69A, which deals with the clause of national security. Donald Trump says he expects India to lower tariffs on U.S. imports substantially, but adds that his administration will impose reciprocal tariffs nevertheless on the 2nd of April. India and the U.S. had reached an agreement to finalize the first phase of multi-sector bilateral trade agreement by fall this year. President Zelensky says he has accepted the ceasefire on Ukraine energy targets that Putin agreed to earlier this week, calls his telephonic conversation with President Trump as positive, very substantive and frank. This was the first conversation between both leaders since their showdown in the White House last month. Israeli airstrikes into the Gaza Strip continue. Close to 60 people reportedly killed overnight as per local hospitals. Hamas says mediators have stepped up efforts to halt the Israeli offensive. Well, those are the headlines, and we'll start with a closer look at what's been the fourth consecutive day of gains on Dalal Street. Indian equities joining the Asian markets that rallied after the US Federal Reserve decided to keep rates unchanged, but also signaled that they're not done with cutting rates just yet. This makes it the longest winning streak for Indian equities in nearly 2 months. The Nifty closing 283 points higher, 23,190. The Sensex up almost 900 points, a 360-point gain there for the Nifty Bank, and the Nifty Mid-Cap Index building on yesterday's move, 320 points higher there for the mid-cap index. Prashant is standing by to detail the day's trading action. Prashant, another good day for the bulls.
It's been a fantastic week so far, and today, of course, we once again build on what we did yesterday. The Nifty Bank, mid and small cap indices, everything looking very, very good. And we've kind of come out of some of the shorter term ranges now, and we are in a position after the last 1,500 odd points from the lows that we've seen on the Nifty, that we can look at some of the larger degree time frames. I mean, for example, after the big move that we had, and by the way, the momentum really picked up mid-afternoon at about 1 o'clock or so. But after the gains we've had, now we are in a position to sort of look at levels like 23,600, etc., which are retracements of the big fall from the highs late last year to the lows that we've had. So, fair bit of repair and recovery, especially as far as large caps are concerned, but broader markets also doing very well. Advanced decline actually was about 2:1, not, hugely, not 3:1 or 4:1, but very, very decent once again. Now, on the large caps, there was Bharti, Titan, Britannia, BPCL, Bajaj and Aisha, which did very well. On the downside, there were very few names, 1 or 2 names with losses, but 1.5%, 2% odd. Now, in the broader space, what did we see? You had moves coming through in names like KEC, which was a big volume-led gainer, Amber, there was Shipping Corporation of India, Welspun Corp was up about 7%, RHI Magnesia, K Fintech was a big mover. Bharat Forge, Spark, Nuvama, capital market play, slowly, steadily rallying about 15% from recent lows. Kaveri Seeds has had a fantastic run, I think at a 52-week high. MCure, EQ Lightings is some of the other names which participated. In terms of losses, the big hits came through in the cables and wires segment. KEI, Polycab, Havells, really, some of the big volume-led losses. Paytm saw some profit booking, so did MobiKwik. These have done very well recently. Ola Electric, there was news here. HBL was up 15% yesterday, gave back some. Vijaya, Finolex Cables and Max Estates were some of the other names. So very solid gains, 3.5% so far with 1 day to go for the Nifty and 4% plus for the Nifty Bank. Back to you.
All right, Prashant, many thanks for joining us. That was the equity market action. In the currency markets, the rupee rallying to near 2-month highs as it strengthened against the greenback for the 6th day. It is now 2% stronger than the all-time lows that it hit on the 10th of February. Latha standing by to take us through what's driving the rupee higher. Latha.
Sentiment of the rupee has diametrically changed, especially after the February trade deficit indicated. The deficit was like a 4-year low. Plus, if you counted surplus, it was the current account surplus, or rather a trade surplus, giving the a clear indication that in Jan, Feb, March, we will report a current account surplus, which means more rupees, more dollars coming in than going out. Plus, you can see the FPI dollar outflow also thinning out. It's not yet zero every day. Now, that is leading to all the rupee shorts covering. There are all these corporate treasuries which take positions. They are in a hurry covering their rupee short positions or their dollar long positions. Plus, exporters are selling off their dollars in a hurry. They were probably expecting 87.5, etc. And now by March end, they will perhaps not get that kind of money. That flood of dollars is coming. Reserve Bank in a very comfortable position. Even last week's data indicated they had bought dollars, to prevent appreciation. And even today, the expectation is that they are buying dollars as well as taking old, allowing the old swaps to mature, which means they are selling dollars. They're buying more than they're selling. That keeps RBI in a comfortable position. All told, it looks like the rupee rally is here to stay. And if it is tapering off, then it's more because it is the Reserve Bank which is buying dollars.
All right, Latha, many thanks. And here's a little more about the big international news that's been driving global markets today. The fact that the US Federal Reserve did not throw a curveball. As was widely expected, it did keep benchmark interest rates steady for the second consecutive time, indicating that at least 2 rate cuts are still likely later this year. The FOMC statement says the US economy's growth this year is expected to be slower than the forecast from 3 months ago. The statement also noted an increase in uncertainty around economic outlook. The Fed chief added that the Trump administration's policies appear to have tilted the U.S. economy towards slower growth, while a good part of the higher inflation expectation was due to President Trump's tariffs. U.S. President Trump disagreed with the central bank's decision in a post on social media platform Truth Social. The president said the central bank would be much better off cutting rates. Steve Leisman is here with more on the Fed's decision.
The Federal Reserve leaving interest rates unchanged at its March meeting in the range of 4.25% to 4.5%, but emphasized the uncertainty in the outlook linked to policy changes coming from the Trump administration. Throughout his press conference, Fed Chair Jay Powell made clear that the Fed is not especially confident in its outlook, but is in its current policy.
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. The point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy.
Fed officials in their projections raised their core inflation outlook for this year by 0.3 to 2.8%, most of which was linked to higher tariffs. They lowered the growth outlook by 0.4 for this year to 1.7%, and yet it kept its forecast unchanged for 2 rate cuts in 2025.
We understand that sentiment is quite negative at this time. And that probably has to do with, turmoil at the beginning of an administration that's making, big changes in areas of policy. And that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more at the price level.
Powell repeated that the Fed was focused on 2 options: cutting if there's clear economic weakness and holding rates steady if inflation ends up being a problem. He continued to not mention rate hikes as an option. Steve Leisman, CNBC Business News.
Steve, many thanks for joining us. And staying with rate action from around the world, China's central bank has also kept its key lending rates unchanged as the country plans to boost growth and stabilize its currency in the face of rising trade tensions. China's one-year loan prime rate was held at 3.1% and the 5-year rate was maintained at 3.6%. The 5-year rates have remained stable since a 25 basis point cut in October. President Donald Trump has said that he expects India to reduce tariffs on American goods. In an interview to the Breitbart news network, Trump said that he believes India will lower tariffs substantially. However, he will be initiating reciprocal tariffs starting the 2nd of April. Trump also added that India is among the countries with the highest tariffs across the world. This is, of course, a reiteration of the statements that President Trump has been making for a while now. Meanwhile, President Trump said that he had a very good telephone call with Ukrainian President Zelensky. The White House also said that President Trump has promised to help with a Ukrainian request to source more air defense batteries from Kyiv. Meanwhile, Zelensky said he had signed up to the partial ceasefire that Russia had agreed to a day earlier. He also described the call with President Trump as positive and frank.
Найпредметніше і позитивно.
Over the recent period, this is probably the most substantive conversation we've had. The mood was right and the conversation was sufficiently detailed. We discussed our next steps and the demand for partial ceasefire.
Щодо частково. І оце моє бачення. І президент запитав...
President Trump asked if there is an understanding that America could restore a nuclear power plant occupied by Russia. I told him this: if it's possible to modernize, invest money, etc., we are ready to discuss it with you. But we only spoke about one plant.
Про одну станцію, яка знаходиться під тимчасовою окупацією Росії.
That's President Zelensky. Now back home, Ola Electric faces regulatory heat. Sources have told CNBC-TV18 that the government has sought details from the company on the mismatch in sales and registration data. Parikshit is standing by to take us through what seems to be the issue here. Parikshit, take us through what the problem is that the government is looking into.
Well, Ola Electric is now facing questions on multiple fronts. Let me begin with the action that is unfolding at the Ministry of Heavy Industries. Ministry of Heavy Industries is a nodal body for the automotive industry, for the implementation of the PLI scheme for the auto industry and the PM e-drive scheme. Ola is a beneficiary of both. Now, they are trying to find out why there is a discrepancy between what the company is claiming via stock exchange notification that 25,000 scooters were sold in February versus what the Vahan portal or the vehicle registration portal of the government shows as 8,700 vehicles sold in February. So they're trying to understand how this big gap has actually taken place. At the same time, there are also investigations, inspections taking place at the level of transport commissioners in different states. We can tell our viewers about what's happened in Punjab, in Madhya Pradesh, in places like Indore and Jabalpur, also in Maharashtra and Karnataka for that matter. In fact, there were 36 locations which were inspected by Maharashtra RTO authorities over the last 2 days, and we believe 34 to 36 scooters have been actually seized because they did not have proper registration documents. Trade certificates were not found, and most of the inspections that are taking place around the country through complaints of certain people, all of them relate to either the showroom or the experience center not having a fire certificate or a trade certificate. So trouble really building up for Ola Electric on multiple fronts here.
All right, Parikshit, many thanks for joining us. Now, the government-appointed Cabinet Committee on Security has approved a 7,000 crore rupee order to procure advanced howitzers from the Indian defense equipment manufacturers. The acquisition has been cleared for 307 gun systems, and deliveries will be complete within 5 years of placing the order. Bharat Forge will account for 60% of the order book, and Tata Advanced Systems will account for the rest. Indian Overseas Bank has launched a qualified institutional placement to raise up to 2,000 crore rupees. The base size of the issue will be 1,000 crore rupees, and the bank has the option to increase the issue by another 1,000 crores. The state-run lender has fixed the price at nearly the QIP had been fixed at nearly 43 rupees. That's a discount of 2.5% of the stock's closing price yesterday. Adani Enterprises has now announced its entry into the wires and cables segment. In an exchange filing, the company said its wholly owned subsidiary, Kutch Copper, has completed the incorporation of a joint venture company, Pranitha Eco Cables. Vinny Motiwala joins us now with more. Vinny, again, we're seeing a lot of pressure on the cable stocks this afternoon on the back of Adani pouring into this space. Take us through what the ambition is.
Absolutely. So we're seeing increased competition coming in this cable and wire space. Now, Adani Enterprises has formed a JV for this cables and wires foray. Its subsidiary, 100% subsidiary, that's Kutch Copper Limited, has actually planned a 50-50 JV. This is with Parnita Ventures Private Limited, and this JV is going to be called Parnita Eco Cables Limited. This is the JV, and the details that we have so far is that they're going to be engaging in the business of manufacturing, marketing, distribution, buying and selling of metal products as well as cables and wire segment. Now, other than that, what we know, we don't know the amount of investment that Adani Enterprise will be making. But previously, and in 2024, the company had said that it's Kutch Copper Limited, they will be investing $1.2 billion. This is going to be to set up a 1 million ton per annum copper plant, and this is going to be in Mundra, Gujarat. So this plant is still under construction. Is it going to be a part of this as well? And will the products be coming in from this side? What is going to be the benefit from this front? These details are still left, and this is something that everyone is watching out for in terms of clarity. Do not forget that, in Feb 2025, that's just a month ago, Ultratech Cement also announced its foray, like you were mentioning. So that is interesting because they have announced a capex plan of 1,800 crores capex in the next 2 years. So these two big entrants coming in into cables and wires has kept, the peers a bit jittery and increase in terms of competition, and a bit of a pressure has come in on all these other peer companies, whether you look at a KEI or Finolex cables, because of the entry of increased competition coming in here and a possible impact in terms of the EBITDA as well as return ratios for them as well.
Vinny, many thanks. And speaking of the Adani Group, the conglomerate is in advanced talks to acquire the India unit of Dubai-based realty developer MR Group. Reports suggest that the transaction will be valued potentially at $1.4 billion. The deal could include an unlisted Adani unit infusing about $400 million. In January, MR Group said they were in discussions with certain Indian companies, including Adani, about a potential stake sale in MR India. Prudential PLC will set up an Indian health insurance company in partnership with a subsidiary of the HCL Group. Prudential PLC subsidiary will hold a 70% stake in the venture, while HCL Group's Vama Sundari Investments will own the remaining 30%. We will head to a break, but up next, social media platform X moves the Karnataka High Court against the Indian government's power to take down content under the Information Technology Act. That and more when we return. Social media platform X has moved the Karnataka High Court against the Indian government's power to take down content under the Information Technology Act. It has argued that such orders are in violation of 2015 Supreme Court judgment. Ashmit is standing by to explain this. Ashmit, take us through the contours of X's plea in the High Court.
Well, Elon Musk owned X, taking objection to these takedown orders, seeking legal relief and knocking on the doors of the Karnataka High Court. What X has essentially said is flagged has been the use of Section 79. Now, under Section 79, the centre has the power to take away safe harbour protection from social media platforms, and by doing that, Centre can make these social media platforms liable for individual posts like users such as you and I may put out on this platform. Now, that is something that X has objected to, saying that this threat of taking away the safe harbour protection is being coupled with these takedown orders, and that is something that is illegal, that is arbitrary, that is unconstitutional. In fact, X has flagged this entire Sahyog portal that was introduced by the centre. This portal was introduced for essentially automating these takedown orders which can be issued to social media platforms. X is saying nothing doing, we don't want to be a part of it, we don't want to be a part of the Sahyog portal. Not just that, X in his petition has also flagged that a 2015 Supreme Court judgment very clearly pointed out that there are safeguards in place under the IT Act, under Section 69, such as the requirement of a court order, such as there being the requirement of a review committee. None of these safeguards are being complied with, and therefore these takedown orders are in blatant violation of the Supreme Court verdict. So with that, X seeking relief from the Karnataka High Court. And also important to point out that this issue of takedown orders is independent of responses being generated by Grok. That inquiry which the centre has launched, which the centre is probing X on as to why is Grok generating the kind of responses that it is independent of these takedown orders. These are two unrelated issues regarding the same company. X, for now, at least as far as this petition is concerned, before the Karnataka High Court seeking relief against the takedown orders.
Ashmit, many thanks. A parliamentary committee report on the Prime Minister's internship scheme has highlighted that only 48 crore rupees have been spent till February versus 2,000 crore rupees allocated for FY25. The report also highlights that the budget for the scheme has been sharply increased to over 10,000 crore rupees with an aim to support 15 lakh internships. The panel also questioned the significant rise in allocation and urged the government to ensure smoother execution before scaling up. Israeli airstrikes into the Gaza Strip continue, with local hospitals reporting close to 60 deaths overnight. Hamas says that mediators have stepped up efforts to halt Israel's offensive, but no breakthrough yet. The US has carried out airstrikes on Houthi targets in Yemen's capital, Sana'a. This was in response to Houthi attacks on Red Sea shipping. The strikes hit multiple areas in the region, injuring at least 9 people. In national news, at least 1 security personnel and 22 Maoists have been killed in 2 separate encounters in Chhattisgarh's Bastar division. The operation took place in the districts of Bijapur and Kanker. Search operations underway to locate more Naxals in the area. Punjab police has launched an eviction drive at Shambhu and Kanori border points, removing protesting farmers and dismantling their temporary structures. The border points had remained closed for over a year due to the ongoing protests. Several farmer leaders were detained. Farmer bodies have slammed the AAP government and announced that they would hold sit-down protests across the state. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with sport.
When we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks I think corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large. I think for me, if you ask me, I still consider that March quarter will be again looking like downgrades of earnings from where we were, and this is coming from the commentaries we are listening from the managements. It's a bit cautious, and I think you guys are also talking to the management. There's no real recovery which is broadly seen across different segments. In some form or fashion, the macros eventually should sort of turn as we see that monetary fiscal, some bit of that space is easing out with the stance taken by RBI. So and the hope is that consumption should start seeing revival maybe towards the end of this year.
The thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing, and then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
Hello and welcome to this special edition of Market Masters. Known for their skin in the game philosophy, PPFAS has built a reputation for transparency, patience and conviction-led investing. Unlike most other mutual funds that offer multiple schemes, PPFAS operates with just one flagship equity strategy, which is the Parag Parikh Flexi Cap Fund. This, I imagine, does greatly simplify the choice for investors and simplifies things for the fund team in their investing as well. It's a fund house which is well regarded by investors not only for how they operate but also for their returns.
PPFAS was also one of the first to give a lot of importance to international investing. In their flagship fund, they invest 65% of the corpus in Indian stocks, while the rest is invested in global stocks.
Well, today we will be speaking with the fund managers at PPFAS Mutual Fund. So let's welcome in Rajiv Thakur, who is the Chief Investment Officer, Ronan Konkar, who is the Co-Fund Manager, Equity and Head of Research, and Raj Mehta, who is Fund Manager, Debt. Gentlemen, great to have all of you with us here. Thank you very much. And lovely that we can do this at a critical time for the markets. Rajiv, let me start with you. When one looks at what you've been doing, one thing which stands out is the amount of cash that you're sitting on, which is about a little over 20%, about 22% or so. And this is higher as compared to, say, September last year, even December, the end of December 2024. Just contextualize this for us. Does that reflect a view on the markets, a cautious view on the markets, or, this is just a function of market gyrations?
So, we've had a consistent stance that most of the time we don't have a very clear view on the market, especially in the near term. Our objective is to deploy the money that has been given to us in, let's say, 25, 30, 35 stocks And as long as we can find those at attractive valuations and have a reasonable spread over sectors and not be excessively weighted in one or two companies or one or two sectors, we would be happy to deploy. What happens is when the valuations shoot up, as was the case last year, that the opportunities are hard to come by. And that's where the cash starts building up. About the question of the cash going up in, let's say, February as compared to late 24, what happens is when equity prices go down, the cash and money market instruments don't go down in value. So automatically the percentage looks higher. It's not that we have been selling more than we have been buying. On a net basis, most days we are buyers in the market. But given that opportunities are tough to come by, there has been some build-up in cash. After the fall that we saw in 25, of course, opportunities have started coming in, and we are looking at other opportunities apart from the stocks that we already own. And I am hoping that we'll soon be able to deploy if attractive opportunities come our way.
Rajiv, just one question. Do you think, and this is I know, you don't want to commit yourself in the near term, and that's perfectly understandable, but do you think a price bottom after the correction that we've seen is in place? Price-wise, we've seen that low below that just under 22,000, and that will hold now.
So, see, we could toss a coin and judge whether we are at the bottom or markets will be up or down. But let me give you some data points that I am watching and which would give some inkling of where I see at least on a valuation perspective or from the demand supply side kind of readings that we are getting. So recently there were, I think, money control at this event where there was a panel discussion on the IPO market. Now, a number like 5 lakh crores was spoken about. That is the kind of fundraising that is expected from the market. So this is not a small number. At the same time, regular supply keeps coming because ESOPs get exercised, those employees sell shares in the market, QIPs and rights issues keep happening, the older shares which are issued and which are under lock-in, those come out of lock-in and people sell. Also in terms of the valuation parameters, although we are better valued now than we were, let's say, 3-4 months back, but are we at cheap valuation levels? Answer is no. Is there still froth in large pockets of the market? I think the answer would be yes. So bottoming out will happen, I think, stock by stock and sector by sector rather than the overall market bottoming out. So you could have this strange situation where some stocks look attractive and people will start buying them and they could stabilize or start moving up. At the same time, segments which are very, very frothy could see a sustained price correction over a point of time.
So we'll get to where perhaps we've seen a bottom and where there is still some froth in just a bit. But let me also welcome Ronak and Raj into the conversation now. Ronak, so since you all invest about 35% of your corpus internationally, now the question is, has US markets hit a peak? Chinese tech stocks like BYD or DeepSeek have questioned US exceptionalism. You visited China very recently, I think at the beginning of this year. So first, give us your thoughts on the US mega cap stocks. Have they hit a peak? What happens to US exceptionalism? And then US versus China.
Thanks, Rima. Just to give you a correct data point, the overall exposure for the foreign stocks in the portfolio in FlexiCap fund is about 12%. The 35% limit you mentioned is the overall regulatory limit up to which we can invest. And at peak times, we have been somewhere close to about 30% of the fund. But I think since February 22, RBI restrictions have come across to all the AMCs that we cannot repatriate new funds to invest in global stocks. That percentage has been coming down for us as more and more fresh investments have been going into domestic equities. So that's the reason why the percentage is at about 12% for the international stocks. To come back to your question on the US mega caps, so we own 4 of them. We own Amazon, Microsoft, Alphabet, and Meta. And when we bought these companies, the idea was to get a cross-section of different segments in the US tech space. And if you look at technology as a whole, we would like to invest in technology-enabled companies, and they also have their own technology products that they sell. So here we see digital advertising as a space where there's a very strong tailwind of operations growth over a period of time. And that segment also is taking market share from traditional media in many parts of the world. So that segment has been growing well, and these companies have been demonstrating very well. A large portion of Meta's revenue comes from digital advertising platform that they run. A large portion of Alphabet's revenue, Google's revenue, comes from the digital platform that they run. Also, the cloud computing space has been picking up a lot lately. So if you see the IT demand and enterprise demand from cloud computing has been steadily growing over the past decade plus. And that tailwind also has been helping the top players like Amazon, Microsoft Azure, and Google's cloud business that is running. The other part is even the consumer software or the enterprise software part of Microsoft has been doing well as the number of seats have been growing over a period of time across various products that they sell. The SaaS ecosystem has been growing for these companies as well. Even Google has a business in that regard. And if you look at the overall e-commerce penetration in global markets, especially in developed markets, that penetration also has been increasing over a period of time, benefiting an online retailer like Amazon, which also has a third-party seller business. So these are all great tailwinds to have to participate in over a long period of time. And what interestingly happens is these businesses generate so much cash flow that these cash flows can be deployed into R&D for new research, for any other optionality that we can get, which is not something we are paying for, but we are essentially participating in a successful business which is generating operating cash which can be redeployed into interesting opportunities. So that's what's happening in some of the areas. And you mentioned about China and the ecosystem over there. So my visit was in October last year, and the whole idea was to see how the technology ecosystem for electric vehicles has been growing over there, and got a good small cross-section of companies to understand what is happening. And it's very different from what is happening even in the West, developed markets, and even our country for that matter. So I think a lot of businesses in the short run might underappreciate the importance of R&D, but in long run the R&D really helps to scale up efforts and have a optionality of different businesses that they can run.
Have you invested in China, Ronak?
We haven't been. I think from international investors' point of view, China is a very difficult market to invest in. Not because there's a lack of opportunity and valuations are interesting, but the way outside investors invest in China is through something called as a variable interest entity. And these are holding companies listed out of places like Cayman or any offshore countries. And these are the ways outside investors or non-Chinese investors can invest in technology sector in China. So that is a big challenge because you don't get the direct underlying holding for these companies to invest in. So far it has worked. Over the past 30 years this concept has worked. But it's a very one-off kind of a situation where you're not directly owning something, when you have to buy a piece of paper which says that, hey, this is a way you can invest in a country where the regulations and restrictions on the stock market or some of sectors are very difficult to come by.
Raj, US economy, there is considerable fear of it slowing down. There is talk of fear of a recession or stagflation. You look at the macros very closely. Is that a big risk globally?
We track macros, but we don't track it in such detail. So the top-down matters, but what we look at is evaluate companies on a bottoms-up basis, evaluate whether the investing in businesses makes sense or not. So coming to US, so Fed held rates yesterday and said that a couple of rate cuts will happen this year. But broadly, if you look at post-global financial crisis from 2009 till about 2023, the interest rates were kept very low. They kept printing money. So now that era is over and we are moving into higher interest rate scenarios. We are moving into a world where tariff makes headlines almost every day. So volatility will be there. Global macros may be volatile over a period of time. And having said that, our focus is always on evaluating businesses on a bottoms-up basis, though we keep a view on the macros.
You know, since we are on the subject of the US, and just to sort of finish that point off, Rajiv, 2nd of April, they've said the US is going to hand over a tariff number. And of course, Mr. Trump has complained about high tariffs here in India quite a bit, maybe more than any other country apart from China. I mean, I know you do with, it's all stock specific, bottom up, but any sense on what, if the number is a high enough number, what parts of your portfolio are impacted? How do you think about this question?
So I have not been worrying too much about this, Prashant, because firstly, the exact policy is unknown. So one day tariff is on, another day tariff is off, then there are some exemptions and carve-outs, and then again the temper tantrums happen, and then the tariff is back up again. A lot of our companies are either participating in the domestic economy, or wherever they are even exporters. In many cases, they are exporters of services, or we have some exposure, let's say, to generic pharma companies, where these are essential things. So I don't think tariff one way or the other will impact the volumes and pricing to that extent. I think net there is realization everywhere that sudden knee-jerk reactions of very high tariffs is not going to create capacity overnight in the US, and ultimately the consumer will suffer. A lot of this, I think, is posturing, trying to get other people to balance their economies. So you spoke about China. The measures in China are to increase domestic consumption and domestic economy rather than just depending on exports. So Mr. Trump is right in that sense that US cannot be a trade deficit company forever for very large amounts, and ultimately some rebalancing has to happen, and that will happen. But let's say even if tariffs are brought down on something like a Tesla, will it change the auto market domestically very dramatically? Unlikely, because they operate in a very high price segment. So adjustments will happen. Will it be a very different morning on 2nd of April? I have my doubts. I think more or less it will be business as usual.
All right, we'll take a quick commercial break here. So much more to talk about. So that's interesting. Will the 2nd of April or the 3rd maybe will it be a very different morning here and around the world? Rajiv essentially saying that maybe not, but interesting perspective nevertheless. We'll continue this interesting conversation with the team at PPFAS Mutual Fund. Take that break. See you on the other side.
Welcome back. You're watching our special show, Market Masters, and we're in conversation with the top team at PPFAS Mutual Fund, Rajiv Thakkar, Ronak Umkar, and Riyaj Mehta. Rajiv, you told us earlier that the market doesn't bottom out at the same time, the entire market. Some stocks may have already bottomed out and opportunities have started to come in. So incremental cash, where are you deploying? What is the team buying right now?
So far the buying has been in spaces where we already own positions. So for a long time we have been liking the banking and financial services names. So we have been owning 4 private sector banks, and those have been things that we have been buying. We have been, as would be seen from our February portfolio disclosures, we have added positions in some of the auto names that we have, or the public sector companies that we own, or in the pharma companies that we own. Largely it's been the same names. In December and Jan we added a couple of new names to the portfolio, but those are the places where we have been deploying.
Financials. What about IT, Rajiv? Is that an area you like? It's a bit of a non-consensus view.
So in IT, there are multiple reasons to be concerned about, but at the same time, longer term, these companies have been well governed and have been generating a lot of cash flow, etc. So one of the big concerns in IT has been around this role of AI in coding, and how much of an impact there will be on the number of people required and the IT budgets of various companies. That has been one area of concern. The other area of concern has been this accelerating trend of large foreign companies setting up their global capacity centers in India and directly employing people rather than going through the listed IT companies. And the third, of course, has been this new regime change in the US, and what will that do to visas and offshoring and things like that. So various concerns have been there. However, the companies in India have had a track record of managing various challenging environments. So we are neither too optimistic on this space, nor are we completely down and out. It's somewhat of a neutral stance here.
Ronak, what has made you all incrementally more bullish on autos, PSUs and pharma? These are the 3 sectors apart from financials, which is pretty much a consensus on account of valuations. But what has made you incrementally more bullish in the month of February?
So in the auto space, if you look at the domestic auto market, it's in fact a very small market compared to some of the global markets. In a country of size of India, we have a very low auto penetration. That has been the longer term trend which has been captured by some of the domestic players who have built the manufacturing capability in India. They understand the domestic market very well and what kind of products are being bought by Indians. These kind of products are launched by these companies. Whereas if you have seen many of the foreign companies in India, they have not been able to scale except for one player at a meaningful rate in our country, because it's a very cost conscious and a feature conscious market. And that's a unique thing about India, where if you have built an expertise to make in India, to service in India, and also to provide a new innovative product lineup over a period of time with all the safety and price considerations, I think that is a skill set good with the Indian automakers. That's what made us conscious about the opportunity here. At the same time, the company we added, Mahindra & Mahindra, is not just into passenger vehicles. They're also into farm equipment like tractors. They're also into IT services. As a conglomerate, they have been doing a lot of cleanup over the past from capital allocation point of view, and the growth from some of the segments that they operate is also quite positive. So we own a couple of them. We own Maruti Suzuki and we own Mahindra & Mahindra in the auto space. In the pharma space, Rima, essentially it's a basket of pharma stocks. It's not a sector where we are bullish on a particular company, but the way we have been buying these companies is on the back of the tailwind of generic drugs exporting over a long period of time. And India has a capacity and capability of marketing and selling these drugs across the world. And they also cater to the domestic market, which is also growing at a faster rate. So these trends, if you combine across multiple companies, We don't need to pick a single company where the risk of FDA warnings or import alerts can hamper their profitability. But if you build a basket of such companies who have similar characteristics, a good balance sheet strength, capability of marketing across the world and even domestically, I think these companies provide a good diversified way of investing in pharma space.
Got that. Rajiv, you used to own Indraprastha Gas, right? But I think you sold that name when the APM gas allocation rules were changed. But cities still do need gas distribution, right? It's still how are you thinking about that space? Stocks, of course, have corrected quite a bit.
Sure, Prashant. So there have been 2 or 3 points which create a lot of uncertainty. One, of course, is the APM gas allocation. The other was around how much profits these companies should be allowed to make. So there were statements from the regulator and from the minister. So that again creates this uncertainty and overhang. The third important thing, since you mentioned specifically Indraprastha Gas, not that we own it or we have any strong view about it, but again, in the media, there have been statements from various authorities saying they want to convert the transportation market in the National Capital Region to electric vehicles soon, so that the pollution levels come under control. Now, that directly hits at the large CNG market in which this company operates. So I have no idea as to when these things will happen, or is the stock attractive enough to buy or not. I don't have a specific view on that. But there are these few factors which are an overhang on the overall environment.
So much change and so much disruption, right? I mean, I think you do own Mahindra & Mahindra in your portfolio. And they are partnered with BYD for their batteries, I think. And BYD yesterday came out with this 5-minute battery charging system. Time taken equal to sort of filling up your car with petrol or diesel. I mean, so it kind of could be an inflection point. But again, I mean, what does that do? When is the question? What does that do to industries like, refining? And so lots of implications which will play out in the coming years, Rajiv. Do you think the rate of change in terms of disruption has picked up quite a bit?
Yeah, I think the only constant will be change and at an accelerating pace. So we have seen this in the way people transact. So the whole UPI and the fintech ecosystem that has come about, the e-commerce, quick commerce, the gig economy, ride hailing, transportation of transportation shifting from internal combustion to EVs, the energy use itself, the pickup in solar and wind over the fossil fuel led power generation. So plenty of change. As you rightly said, one will have to arrive at judgments in terms of which are the companies which will be able to make the transition and which are the companies which will fall by the wayside, and at what pace the transition will happen. Being too early also can be damaging, and being too late also can be damaging. So one has to time the transition well.
Raj, the optimism on banks also stems from the regime change at RBI, the recent liquidity bazooka, expectations of rate cuts. So valuations aside, what are you all expecting from the RBI and the macro indicators?
So very difficult to predict what the RBI will do, but broadly, if you see the measures that they have taken to improve liquidity, be it open market operations or be it dollar-rupee swaps, from an inverted yield curve, we have moved to a flatter yield curve now. So the shorter-term rates have moved down a little bit. But going forward, we expect the short-term rates to move down a little more, whether it will happen in the next monetary policy or after that. But in the calendar year 25, we expect the short-term rates to be softer than where they are right now. And it will move to a more of a normal yield curve that it used to be 2 years back. So that's where we see the interest rates moving.
Okay, well, more questions, but as always, we are paucity of time. Raj, Ronak and Rajiv, thank you very much, all three of you, for sitting down with us here at CNBC-TV18. An interesting conversation. I hope the one of many that we will have over the sort of coming months and years as we track the changes in many of these industries that we discussed. Thank you very much for being here on this program. We'll take a quick commercial break here. We continue with the regular programming on the other side. Stay tuned.
Hello and welcome to News Centre. I'm Parikshit Luthra. The government-appointed Cabinet Committee of Security has approved a 7,000 crore rupee order to procure advanced howitzers from Indian defence equipment manufacturers. Let's give you a quick snapshot of the deal. The acquisition has been cleared for 307 artillery gun systems and 327 heavy gun towing vehicles to support the artillery systems. The first batch of deliveries will commence by middle of this year and will be completed within 5 years. The deal is expected to be signed later this month. Bharat Forge will account for 60% of the order book and Tata Advanced Systems will account for the rest. The Defence Acquisition Council has also cleared proposals worth over 54,000 crore rupees to enhance defence capabilities. Joining us right now to take this forward is Rajinder Bhatia, Chairman of Kalyani Strategic Systems, a subsidiary of Bharat Forge, and also the President of Society of Indian Defence Manufacturers. Thank you very much for joining us on the phone, Mr. Bhatia. Let me begin by asking you, this indeed is a big order for the Indian defence industry, especially for Bharat Forge, because 60% of the orders are going to Bharat Forge. Could you give us a sense of whether this will require Kalyani Strategic Systems, which is a subsidiary of Bharat Forge, to expand its manufacturing capabilities, invest in new capabilities?
Parikshit, thank you so much. So, of course, it is a CCS has cleared the proposal. The order is yet to be signed, and we have been eagerly waiting for this order because I believe this is a game changer. This was a weapon system which was developed along with DRDO by private industry and is now seeing the signs for its early induction. So this, of course, is a landmark moment. Order, I'm sure, will follow shortly. As of now, the order is not yet received, but CCS clearance has come. Answering the second part of your question, which is that whether do we need to, we have repeatedly said that Kalyani Group has already established a very large capacity. We are already manufacturing more than 6 to 8 guns per month, and we are in the process of upgrading this to 12 guns per month. We really do not need any expansion of capacity because these capacities has already been established in anticipation of order like this. In fact, we are prepared to not even wait for 5 years. We are getting up to deliver this much faster than the time frame which has been indicated to us. So we are fully geared up for this.
Okay, I would also like to ask you, sir, when do you begin deliveries? I think the order says middle of this year. Could you give us a sense of how soon could deliveries begin once the formal contract is signed?
See, after the formal contract is signed, we are required to produce one prototype, which is supposed to go through 1 or 2 mandatory firing tests or non-firing tests in our case. And thereafter, we should get the bulk production order, which means you get a clearance, bulk production clearance certificate, which will come. Thereafter, we can supply the guns. So I presume that by maybe the third quarter or the fourth quarter of next year, we should be seeing the guns flowing out from our plant to the Indian Army.
Right. Could you also give us a sense as to what has been the contribution in developing this gun from the DRDO side and also from the side of the private sector?
See, it is very difficult to kind of, quantify that. It has been a team effort. DRDO laid down the specifications, helped the industry to develop the weapon platform, and also to kind of, take it up to that level that it met all the desired QRs and actually became first in the world to achieve a very, very long range. In fact, this weapon platform offers almost 47 kilometers of range. So this development is landmark in that. But to quantify how much DRDO did and how much we did would be very difficult. It was a team effort, and I think it has borne very good fruits.
Right. What about exports, sir? What is the export demand for these guns right now?
So we have already exported some of these guns, and I would not be able to disclose the country, but most of the people are aware. We have already exported close to about 12 guns. We are also seeing quite a bit of interest from many countries all across the globe, both from West and from our other side, East. So we are hopeful that once Indian Army also starts buying, which is almost on the now verge of that order being placed, we should be getting some more traction for orders for 8X going into the future.
Right. Now, we also believe that 65% of the components going into this weapon system are indigenously procured. Could you give us a sense how this gun, which has a 40 kilometer range, a 52 caliber, is largely domestically produced, gives us a self-reliance capacity, and how does this howitzer compare to some of the others around the world made by other OEMs?
So firstly, I think, let me correct that. In our weapon platform, which Kalyani Group will make, we are indigenous content will be more than 80%. since we are making almost everything in-house, it's almost in excess of 80%. So it will be a purely indigenous, developed and Indian manufactured platform. So that is point number one. Secondly, this gun has got the capacity to give a range of 45 kilometers and above. And to us, it is perhaps the best gun in the world right now.
Right. That indeed is important. I would also like to ask you one quick question, sir. This is about the Defence Acquisition Council. A government statement has just come saying that DAC has cleared capital acquisition proposals worth over 54,000 crore rupees to enhance defence capabilities. This includes procurement of 1,350 HP engines for T-90 tanks, Varunastra torpedoes, airborne early warning and control aircraft systems, and guidelines have been approved to reduce timelines in capital acquisition process. Could you give us a sense of how the Indian defence industry is going to benefit from these orders? I'm asking you in the capacity of SIDM President, and will Kalyani Group also be benefiting?
So, firstly, if Indian industry benefits, Kalyani Group would benefit. That is the one sure thing. Now, coming as SIDM President and commenting on this, we welcome any effort done by the government to reform the acquisition process, to cut down the timelines. It is always a welcome process. We have been advocating for cutting down these acquisition cycles for a long time, and if government has now started to do that, it will be a welcome step. Regarding what will be the impact of these, any orders which are placed on Indian industry does have an impact. Our, value of production for domestic industry will certainly go up. And we are looking forward to, our Raksha Mantri gave us a target of 3 lakh crores for domestic production in next 3 to 4 years. So any increase and clearance of more proposal will only help us in achieving the aim which has been set out for the Indian industry.
All right. Thank you very much, Mr. Bhatia, for joining us with your perspective, joining us at a short notice and giving us your view on these mega defence orders announced by the government today. So indeed, a big move for the defence industry, and defence stocks will be in focus tomorrow. Let's move on, shifting focus to the insurance sector now, which saw a flurry of activity this week. A total of 5 major deals were either announced or finalised, making it one of the most eventful weeks for the industry. Yash is here with all the details. Yash.
Just going by the numbers of transactions which have been announced in India's insurance sector, it clearly has been the most eventful week in the life of Indian insurance sector. In the last 7 days itself, a total of 5 large deals have been either announced or they've been consummated. Let's go by the date. On March 13th, Baba Ramdev's Patanjali Ayurved, along with the Dharampal Satyapal or the DS Group, announced acquisition of about 98% stake in Magma General Insurance, valuing the company at 4,500 crore rupees. Adar Poonawalla will be selling nearly 75% stake in Magma General Insurance to Patanjali Ayurved. Also, Patanjali Ayurved will have about 74% stake in the company. They will pay about 3,330 crore rupees, and the DS Group will own about 24.5% stake for about 1,100 crore rupees. The next announcement came on March 17th. Bajaj Finserv and its promoter companies announcing acquisition of 26% stake held by Allianz in both life and general insurance joint ventures. Bajaj Finserv and its promoter companies will be paying about 13,780 crore rupees for a 26% stake in Bajaj Allianz General, valuing the company at 53,000 crore rupees. The deal being done at about 4.9 times FY24 price to book value and 2.6 times FY24 price to GDPI. Also, Bajaj Finserv and its promoter companies will pay about 10,400 crore for a 26% stake in the life insurance entity, valuing that company at about 40,000 crore rupees. This deal being done at about 1.84 times price to embedded value on a FY24 or a trailing basis. Now, who will acquire how much of Allianz's 26% stake? The first listed company, that will be Bajaj Investment, that will be acquiring about 19.95% stake, Bajaj Finserv about 1.01% stake, and Jamnalal Sons about 5.04% stake. On the very next day after this, which was March 18, came the next announcement. Hinduja-backed IIHL announced completion of acquisition of Reliance Capital. Through this, Hinduja Group will own 100% in Reliance General Insurance and 51% in Reliance Nippon Life Insurance. Hinduja Group will also consider listing of the two insurance entities in a period of about 2 to 3 years. On the same day, that was March 18th, LIC CEO told CNBC-TV18 that LIC will announce an acquisition of a health insurance company. As per LIC, the talks are at an advanced stage and LIC will look to acquire not a majority but a significant stake in the company. Reports suggest that LIC could be looking at Manipal Cigna Health Insurance for the stake acquisition. As far as the final deal is concerned, that of course came today, March 20th, where about Prudential PLC, which is present in the asset management as well as the life insurance industry in India, has said that they will be forming a joint venture along with HCL Group, Shiv Nadar's HCL Group, to enter the health insurance industry in India. Prudential PLC will be holding about 70% stake in this health insurance venture, and Vama Sundari, which is essentially the parent company or the promoter company of HCL Group, will be holding about 30% stake. So 5 large deals in just about 7 days. Still Friday remaining. God knows what's in store for that one.
All right. Thanks, Yash, for joining us with that comprehensive update. Time for a short break here on News Center. But coming up, the government seeks details from Ola Electric over discrepancies in reported sales and vehicle registrations. A special discussion when we return.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. from chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show.
Welcome back. You're watching News Center. The top corporate story we're tracking this evening: Ola Electric faces regulatory heat. Sources have told CNBC-TV18 that the government has sought details from the company on the mismatch in sales and registration data. Ola has claimed that it sold 25,000 scooters in February, while Vahan data shows only around 8,600 scooters sold. The company has said that all vehicles would be delivered only after their registrations are completed. Maharashtra's Regional Transport Office, meanwhile, has also conducted inspections at Ola showrooms across the state, and not just in Maharashtra, but they have been inspections in Madhya Pradesh, Punjab and Karnataka as well. In Maharashtra, the RTO inspected vehicles to check whether they are being sold without valid trade certificates. Sources say that at least 36 scooters were seized from showrooms in Mumbai and Pune. It doesn't stop there. RTO authorities in Jabalpur also issued notices to the company after discovering that scooters were being sold without proper documentation. Meanwhile, Ola Electric showrooms in Punjab have likely been shut down. What does this mean for the company going forward? We have also seen copies of the orders issued by the Maharashtra RTO, the Jabalpur RTO as well. Joining us right now is Jain Gupta, founder of Stakeholders Empowerment Services. Thank you very much, sir, for being with us. What kind of questions does this raise for Ola Electric? Yes, they can say that we are renegotiating our contracts with our vehicle registration agencies, but there is a big gap. On one hand, you say 25,000 scooters have been purchased. The Vahan data, the vehicle registration data, shows around 8,700. Should this difference not be explained by the company?
See, first of all, thank you very much for having me on the show. Issue is very clear that why a consumer would be paying money upfront and waiting for months to get your scooter. It is only possible that if your scooter is something which is not available in the market. Now, I do not know because I don't use the scooter. I don't know what EV scooter is, but then the issue could be that, yes, I am ready to wait for 2 months, 3 months because the product that you are giving me is best. But unfortunately, in present market scenario where there is so much competition, where there are dozens of EV scooter manufacturers, it is unlikely, but I cannot be saying for the sure. But the issue very clearly is that when I give a sales figure, my sales figure has to be 100% correct. Give here, there, 1% here, there, if something is wrong to put it. Now, when the mismatch is of the magnitude of around 60-70%, then the question comes that what have you done till now, or did you inform the consumers that this is the problem? Say, for example, I have bought a scooter and you have informed me, sir, this is the problem with the agency, with the registration agency. You will take 2 months, 3 months. Then I would have had time to buy or not buy. I would have taken a decision. But if you have done that and not told the consumer, then it is a case under Consumer Protection Act. That is one part. But if you have given sales figures which are not correct, then it is a case on many issues. First would be under SEBI prevention of unfair and fraudulent trade practice, because you have given data in the market which is not the correct, because of which the share price was not reflecting the reality. I do not know for sure. But one thing is there that they have been trading without trade certificate. It is not a thing that trade certificate was withdrawn of all the places or some places suddenly overnight that one day the inspector came and said that no, there is no trade certificate. There would be validity. Either the trade certificate would have been temporary valid or long-term valid. The validity would have expired. So you would have known when my trade certificate is expiring. So if you today come and say, oh, my trade certificate, I will get it renewed, that means something is wrong. Or then you come and say that it is not a isolated case with me only. There are 6 other or 7 other or 2 other agencies or scooter manufacturers who also have this problem. Probably understanding that everybody's license is pending or certificate is pending. But if it is only an isolated case, then there are only 2 possibilities. Either I am wrong or somebody is forcibly making me wrong.
Right. Now, when it comes to, sir, trade certificates, we've been seeing RTOs carry out inspections. The Maharashtra RTO has carried out inspections in Pune and in Mumbai. There have been similar reports from Jabalpur, Indore, Punjab, Karnataka. So when on such a wide scale you are having inspections, authorities are questioning you about the lack of trade certificate. Some scooters are being confiscated as well. The company has not come out with a formal explanation. Considering there are so many reports for a listed entity, do you feel it's important to come out and say what is the right thing?
I would say, why go for 10 instances? If there was one instance, it is the duty of the company to come and calm the customers that this is an isolated case or this is the case because of this reason. There is nothing wrong with our company. There is nothing wrong with our scooter. There is nothing wrong with our establishment. But when you are keeping mum, in that case, you are not telling the consumers or to the regulators or to public at large that what is the real situation. You got to tell the real situation. It is not a thing that people do not suffer problem. Their people suffer regulatory problem, everything else. But if you are right in your work, if you have done something right, you will come and out say boldly, yes, this is happening. There is a notice, something is like this. We feel that we are right. We will settle this. We are doing this. But when you are keeping mum, then the questions multiply every day into enormous proportion.
Right. And what is the one corporate governance question that arises at this juncture?
I would say the independent directors are expected to ensure that everything is as according to the law of the land. They have to take a compliance certificate. Now, I would say that it is impossible for independent director to go and verify each and every certificate. They rely on the certificate given by the compliance officer of the company. So independent directors should ask the compliance officer, last meeting you gave me this certificate, tell me what was the basis on which you gave the certificate. If they had fed wrong information to the independent director should come out and say that the company's governance practices are such that independent directors cannot trust on the information that is being provided. However, if this was provided, that there is lapses, then what action they took as an independent director is there. So the governance issue is there because governance covers almost everything from labor law to commercial law to regulatory law, everything is covered. So that is the question that need to ask.
All right. Thank you very much, Mr. Gupta, for joining us and sharing your views on the questions around Ola Electric right now. Let's move on and get you a story on India and New Zealand trade ties at a time when New Zealand's Prime Minister Christopher Luxon is in India. He's one of New Zealand's greatest cricketing legends. In his 17-year-long international career, Ross Taylor left an indelible mark on the game with 40 centuries across formats. He was recently in India as a part of New Zealand's trade delegation. My colleague Abhimanyu Sharma caught up with him with a conversation on his love for India and his innings as a businessman.
To be here back in India, obviously India is like a second home to me, and to come along with fellow cricketer Ajaz Patel. Obviously New Zealand and India have strong ties, but hopefully we can, with us being here, that we can make the ties even better.
Also, there was a cricketing parlance, a cricketing example which was given by both the ministers, both by India's trade minister as well as the New Zealand Prime Minister, about a collaboration between both the countries. What are the kind of interests we can possibly look at? Because we understand you're also a part of the business sector now. Yeah, I mean, I just got into wine. I'm importing wine into India, into the northern states and a couple of states down south. But no, just because you're a cricketer, you don't stop learning, and it's nice to be back here. But I mean, we're so close in so many aspects. I'm sure, over time, hopefully we can get a lot more travel and, tourism between both countries. And I think, by all accounts, there could be direct flights into New Zealand. So I look forward to hearing about that in time.
All right, so that was Ross Taylor looking for closer business ties and cricketing ties between India and New Zealand. With that, it's a wrap on this edition of News Centre. More news and updates continue right here.
Business Hour drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Hello and welcome to Indianomics. I'm Lata Venkatesh. The Indian rupee has just done a U-turn. After falling by nearly 4% from November 24 to February, the Indian currency is up 1% in the past week and up 2% from its February 10th lows of 87.95 per dollar. One big reason for the rupee's recovery appears to be the February trade data, which showed a monthly trade surplus if you took goods and services together. Now, foreign portfolio outflows, especially on the equity front, have begun to thin down, but they still remain outflows. Has the rupee bottomed? Will India's current account deficit remain contained next year as well when tariffs loom? Will the net capital outflows turn into capital inflows in this calendar year? Now, that will also depend on India's growth trajectory. For a 360-degree perspective of growth, rupee and rates, I have with me an elite panel of economists, Samiran Chakrabarti of Citibank, Santanu Sengupta of Goldman Sachs, and Upasana Chachra of Morgan Stanley. Gentlemen and Upasana, thank you very much for your time. Samiran, let me start with you. You are quite convinced that this quarter, Jan, Feb, March, we will post a current account surplus?
Yes, Lata, that has been the trend for a while now in the last few years, when we are seeing this seasonal improvement in the current account for this fourth quarter of the fiscal year. So we think that that same trend will continue this year as well, and we should report a current account surplus for this quarter.
Okay. Santanu, what is your sense about this quarter, and more importantly, whether the deficit will remain contained in the coming quarter as well? Your thoughts?
Yeah, I would think that, as Samiran said, that, in the last couple of years, you've had this trend of this particular quarter driving into a current account surplus. So likely you'll have this in this quarter, but going forward, you'll have some expansion of the deficit. We still think that the external balances from the current account side is going to be relatively comfortable. You're still going to have a strong amount of services exports coming through. Your remittance inflows are good. So we would think that the current account deficit will be contained within 1% of GDP, probably a shade lower than 1% of GDP.
Okay. Upasana, the more difficult question has been capital flows. Y'all came out with a strong report on Indian equities and Indian growth. Is there any internal estimate on whether the capital outflows will thin out and we may turn to inflows? If yes, when?
That's really a tough question to answer in terms of how capital flows can change. But I think at the margin, what we are sensing is that, and as you also pointed out from the data, that probably some amount of the bearishness from an equity investment perspective is finding a floor. There's more recognition that data is not deteriorating and at the margin improving for India macros, and policy is also moving in direction to support growth. So again, as you highlighted, the growth delta matters for India from a capital flows perspective, and I think there is reason to believe that the second half probably could be somewhere where we would see that growth delta looking better for India versus maybe other economies as well, and that could turn the capital flows picture as well for India.
Okay, no, I agree that the toughest question was for you. I mean, it's a difficult one to guess. But Samiran, would you, I think in your recent report you have upped your forecast of rupee. Can you take us through your argument? You believe the rupee is now in a stronger patch than what you perceived a couple of months back?
So a few things have happened, Lata. One is that overall the DXY itself has come down quite substantially from around 108, 109 levels to more like 103, 104 levels now. The second is that because we had allowed a bit of currency depreciation, nominal depreciation, and the fact that our inflation has corrected very sharply has led to the overall 40-country INR RER now back to around the 102 mark, which is slightly lower than even the longer-term average has been on RER. So from a valuation perspective, rupee has moved into a much more fair valuation level than what it was even a few months back. And on top of it, this improvement in current account, the seasonal improvement in current account, and we are also hopeful that at some point of time, the capital flow picture will also improve, not just because of the portfolio flows turning, but also because the FDI repatriation outflow that we have seen being massive over the last couple of years, at some point of time, that will stop. So we are hopeful that for FY26, the net FDI number will look better than what it has been in the last couple of years. we're not yet expecting it to go back to historical trends, but at least some improvement on that front, along with a pickup in the portfolio equity flow, should make the current account look somewhat better, which could also be supportive of rupee. And last but not the least, Citi has a view that oil prices will come off quite materially in 2025, maybe even going towards $60 per barrel by end of the year. That will also be quite supportive for the currency.
Okay, so what's your currency range now, Samiran, as of March end, of course, which is just a few days away, and for year end?
So, I mean, the way to think about it is not just from a rupee dollar level, but from a more relative perspective. So the argument that I was giving was more of a relative argument. But we think that as the tariff picture becomes clearer after the reciprocal tariffs are introduced next month, we could see some retracement in dollar also going towards DXY, going towards 106 and all. So with that, maybe rupee also can move towards 87, 88 range. But compared to the relative nominal depreciation that we had seen in the last few months, I think that's behind us. The key challenge for RBI would remain that this very large forward book that it has got, how it brings it down to a more normal level. So as and when the BOP situation improves, that will be, in my view, the primary objective of the RBI. The spot reserves are okay for now. That's enough for them to be able to control the currency in a narrow range.
Okay. Well, according to what dealers tell us, even at the moment, RBI is allowing the sell swaps, and they're selling, but they're buying more than they're selling. So it's a net buy figure, which we have even for last week. And of course, there is this buy-sell swaps, which they have pushed 3 years down the line. Maybe we will get more of that. Santanu, what is your sense in terms of where the dollar rupee can go by the end of the year? I know it's a little unfair given the tariff, overhang, but nevertheless, how much of a depreciation this year?
Yeah, and end of the year, Lata, is a long time out.
Yes.
with so much of uncertainty around. But we would think that in the near term of around the 3-month horizon, you hover around this 86.5 to 87.5 kind of a mark, and get towards an 88 over a 3 to 6 month kind of horizon. In the long term, we have right now baked in a depreciation of around 2.5% odd, which takes you towards that 88, 89 kind of mark. A lot of uncertainties, obviously, regarding flows, not so much the current account side, but more on the capital account. I would just emphasize the point that the short forward book position that the RBI has is quite sizable, and therefore, whatever inflows you're getting through the course of the year, and the role that you use in the forward book will be important in terms of the currency management. And again, from a spot reserves perspective, while you're looking comfortable, right now the respite that you're seeing in the rupee is also largely because the dollar has turned, and therefore your short positions that were the positioning that we're building up offshore has also probably lightened up. And it is therefore going to be the dollar trajectory which is going to matter for the dollar rupee pair in particular. But over the medium term, again, going back to the fundamentals, the current account looks very comfortable. If some of the flows are back, the RBI should be able to manage it. And you're not going to have the requirement for a large depreciation that you had in the previous 3 months, because your vol is right now much higher than what you had in the second half of last year. So the vol adjustment will also be lower through the course of this year.
No, I take your point that the Reserve Bank's NDF sell position, the forward sell position is overhang, as both you and Samiran point out. But there are these other positives, and perhaps the Reserve Bank will have some elbow room to kick that forward, as they have done with $20 billion of swaps. Upasana, your rupee view?
So in the near term, I would say it remains more range bound, of course, begging more clarity from the trade policy that we see on 2nd April. Beyond that, I think, as both Samiran and Shantanu have pointed out, it will depend on the DXY positioning as well. We do have a slight depreciation bias if I have to take the 9 to 12 month view, also in line with what we think probably the CNY could see in terms of some depreciation further in calendar year 25, and that could play a role as well. But the dynamics of the BOP probably are going to be more supportive, as are the inflation differentials. And again, from the worst in terms of the rupee is probably behind us, is how I view it as well.
Okay. So would you all go beyond the 88? The maximum I heard here is Shantanu saying at the most 89. At the height of the rupee depreciation, people were talking about 90 very freely. Now, even at the end of the year, you guys are only looking at 89. Upasana, what is the in-house view in Morgan Stanley, even if that's not your terrain? What are people talking about, 88 or 89 in the current year?
So for us, the peak for USD INR does go to 89. Yes, we don't go past that. And that's more like, 6 months out.
Okay. No, I agree that these days calling so far out, as Shantanu said, is difficult. But yes, considering where we came from on the rupee, even at 89, this will be, less than a 2% depreciation. And from the height of 87.95, it is only a 1% depreciation, which is low by our historical standards of an average of 3% per month. But let me also get a quick growth view. Ultimately, the rupee was weakening also because, or the capital outflows happened also because India's growth picture dulled last year. Samiran, let me start with you. What's your sense? Will this year, will Q4 show a substantially better growth? The Mospi's arithmetic is 7.6, but where may we end up?
So, Lata, it's not probably fair to extrapolate the Mospi numbers for the fourth quarter, because we will see revisions to the first quarter and second quarter numbers as well. So you could still end up with the full year being close to 6.5%, but the fourth quarter not being at that extrapolated 7.5%. We think that we are, whatever high frequency data we have got for the fourth quarter, it appears to be tracking closer to 6.5 as yet. And then that is an improvement from the quarter before, from the 5.4, which was the September quarter bottom. So we are on that path of improvement for sure. In terms of the drivers, I would say that the rural is still holding up quite okay. Urban is gradually improving. Investment side, public investment, some improvement. Private investment yet to show any significant pickup. Now, on top of all of this, there will be two factors to really watch out for. One is if the equity market improves, then all the consumer side measures taken by tax cuts and rate cuts, they will kick in and give you the big thrust for next year. And the second, on the opposite side, is to what extent this global uncertainty persists, which will keep on private investment depressed and become a headwind for growth. I think these are the two opposing factors that we have to track for FY26 to get a better idea of whether where we are going to land up.
Okay, so you're 6.5 for the current quarter, and what is the working number for FY26?
We're at 6.6, a very similar kind of number.
Okay, but that's still a little better than many other forecasts. Shantanu, where do you stand on Q4 itself? If I remember right, you have a report upping your growth forecast.
Yeah, that was about a couple of months back, where it was a shade higher, almost marking to market in terms of data.
Okay.
Look, over the medium term, we firstly on Q4, we are at 6.7, and I think it's exactly because of the reasons that Samiran mentioned. This is not probably fair to compare what the extrapolated CSO number would be. But I think more broadly on the growth cycle, we remain still below consensus at 6.3% year over year for fiscal 26. And the main reason is because that we think that the worst in terms of the growth numbers, showing up is over. So 5.4 clearly was the bottom that you got to see in Q2 of this fiscal year. But the amount of easing that you're seeing in terms of policy, in our view, is probably not going to be enough to offset some of the uncertainty-related slowdown or slowness you're going to continue to see on the private investment front. It's not just for India, but also globally. It's difficult to imagine private capacity being set up in an environment where uncertainty is so high. And therefore, the upside that you're going to get from the policy easing is going to be somewhat negated from the uncertainty in our view. The second point of the fiscal is that at the end of the day, even with the tax cuts, you are consolidating the deficit. It's 80 basis points this year. It's going to be 40 basis points in the year after. And when you think of it in terms of the fiscal impulse to growth, which means the change of fiscal policy impacting growth, while you're going to have a small upside from the tax breaks, you're going to take somewhat away from government spending being slower overall, which is the other current expenditure being weaker. And therefore, unless the domestic economy really picks up, we would be in the camp where growth is in the sub 6.5% range.
Fair point. Well, actually, we have to take a quick break, but we will dig a little more into the growth argument and into the more difficult terrain of tariffs in a minute after this break. that, we've been discussing with three economists where the rupee is headed, current account balance of the country and growth. The range so far that we have is that the rupee this year maximum goes to 89, so the worst of the depreciation is behind us. And that growth is not picking up so much, probably 6.3 to 6.5. I've been speaking with Samiran Chakrabarti, Upasana Chachra and Shantanu Sengupta. Well, Samiran and Shantanu had their word on growth. Upasana, where do you stand on GDP growth for Q4 and FY26?
So we are tracking growth for Q4 at around 6.7%. I think we would focus more on the GVA to get a better sense of the underlying growth momentum. And as laid out earlier, the drivers are agri, rural, to an extent pick up in public capex spending, and also some improvement on the services export side that we are seeing. And that should, let growth settle around 6.5%. So for fiscal 26, we see growth around the 6.5% mark, driven by these drivers.
Okay, so we have 6.5, 6.3 and 6.6 as guesses for FY26. But, I mean, the sympathies are there for you economists to forecast because there is this big tariff overhang. Give me your best estimate, Shantanu, if you all have done any homework. If you look at the tariff numbers, the Indian exports to the US is, about 2% of GDP. So what may be the impact on India's GDP, assuming tariffs go higher?
Yeah, obviously it's a difficult question. You can think of it in multiple ways. One is country level reciprocity, if President Trump goes for reciprocal tariffs, or you can look at product level reciprocity. The range in terms of the weighted average differential that we have calculated has been, between 6.5 to about 11.5%. And then you've got to make the assumptions around what kind of elasticity you assume for your exports. So with these assumptions, we think purely from India's point of view, which you rightly pointed out is 2% in terms of the exports, we think it's going to be between 10 to 30 basis points. So it's not a very significant number. However, if you have multiple countries coming under the reciprocal tariff umbrella, and we're going to figure out what happens on April 2nd, then the impact would be larger because you could have some of your intermediate goods being exported to one country and from there the final good going to the US. And if that country also comes under the tariff umbrella, then your export effectively is going to get, your export demand is effectively going to get impacted. Our sense is that it's not just going to be hard tariffs only. You're going to have other bargains along the way, and you can have more of non-tariff, measures. You can have a trade deal, which India has been talking about. Indian officials have been talking about with the US. There could be further more happening on the energy front, and therefore the whole gamut of possibilities are there to finally get to that number, which might look very different by the end of the year compared to what you see in terms of the announcement on April 2nd.
Okay. No, I agree. These numbers help, although I know that there are shifting sands over here. I mean, you may reduce tariffs for the US and you may end up getting flooded with perhaps milk powder from New Zealand or Netherlands. So we really don't know how these things will work. A very quick, if you all can, one sentence answer from all of you. And this is the toughest question. Samiran, your best guess on when capital flows may turn into inflows?
We have taken a view that from a quarter sense, the capital account surplus quarter is likely to be Q2 FY26 is when we get into a capital account surplus and debut.
Okay. So July, August, September probably. Shantanu, you want to take a jab?
Same. July, August, September is when we would think. It's too much uncertainty in the April to June quarter.
My sympathies with you. Upasana, what is Morgan Stanley's best guess?
So as I mentioned, probably second half, and I would side with them. Probably the September quarter could give us some indications.
Okay. Even this would be music to the ears of the market and to investors. Samiran, Upasana and Shantanu, thank you very much for giving us a 360-degree perspective of macros and markets and for sticking your neck out in very, very difficult times. We wrap up on Indianomics on that note. Thanks much for watching.
When we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks I think corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large. I think for me, if you ask me, I still consider that March quarter will be, again, looking like downgrades of earnings from where we were. And this is coming from, the commentaries we are listening from the management. It's a bit cautious. And I think you guys are also talking to the management. There's no real, recovery, which is broadly seen across different segments. In some form or fashion, the macros eventually should sort of turn as we see that monetary fiscal, some bit of that space is easing out with the stance taken by RBI. So and the hope is that consumption should start seeing revival maybe towards the end of this year.
The thing I think back of this whole time frame is how really resilient Butch and Sunny were the whole time. I mean, they launched on what was going to be a short test flight with the crew flight test vehicle with Boeing. And then they moved very quickly into station increment operations, and they became seamlessly part of the International Space Station. And they did that because they're experienced astronauts, and we had prepared, right? We had flown gloves for them to do spacewalks, and we had flown a lot of components for them. So I think that shows the adaptability of crew members.
I thought, I should leave. I should go back to India. We will figure out what is it that we will do. There was no idea for free will. So I came. Rahul also left at the same time. Then we spent almost a month or two to figure out, okay, now what next? So it always started from the family. What you see in front of the label is very different than what is in the back of the label.
And then very different from what's actually inside the bottle.
Exactly. I guess so far we are in some 2,000 stores. In next 2 years, we can easily target anywhere between 15 to 20,000, right? It's a misconception, to be honest. I think the percentage of spend required for R&D eventually is much lesser that you need for your marketing. Investing in R&D is much better ROI than always doing it in marketing. When the conversation with HU started, I think 2 or 3 months before that, we started our Series B process. We run the ship. Yeah. So
there's no change in that.
No change in that.
Even though ownership has changed completely.
Yeah. So we operate from Jaipur. We'll continue to operate from Jaipur. I think it's more about, there's a difference in the cap table before versus now. Whatever we can do, say next 5 years, with them we can do it in 2 years. We needed money. And by then, of course, we never had a lot of savings, right? So we asked our parents, and you'll not believe that, they said that, we can mortgage the house, raise a debt. And actually that is how our journey started. You can buy a 5-star rating on any e-com by paying 30-40 rupees. That's true. Most
and it's
companies
happening.
participate. It's happening.
It's prevalent.
It's prevalent. Everyone does that. We never did it.
Hello and welcome to this edition of the Young Turks podcast. I'm Shireen Bhan. If you've been watching the show for the last 23 years, then we brought you stories that often inspire, also make you look at the world of entrepreneurship with a different lens, but very often make you wonder how and why entrepreneurs succeeded in what they decided to do. My guest today is part of a duo that decided to start a company in the middle of COVID, in fact, right before the second wave of COVID, and decided to get into the beauty and personal care space, a highly competitive space. And in a short span of 4 years, what they've managed to achieve has been quite remarkable, hitting a run rate of almost 500 crore rupees. And what is even more remarkable is that they've managed now to sell the company while still retaining operational independence within the Unilever conglomerate. Joining me now to talk about the minimalist journey is Mohit. Mohit, many thanks for joining us here on the Young Turks podcast. It's wonderful to have you with us. So that's where I want to really start with the how. In 4 years to start a company, and this is, by the way, for those of you who don't know, this is their third venture. The first was apparel, the second was personalized hair care, which eventually positioned or pivoted itself into the minimalist. And minimalist, of course, has been the big success story that it has. How do you go from starting a business in the middle of COVID to being able to take it to become a 500 crore brand, perhaps one of the fastest growing D2C brands in the country?
So firstly, thanks for inviting. Very happy to be here. When you start, you have no idea where it will be. I guess, for most founders and, entrepreneur, it's a very risky bet. The percentage of, startup that succeed and get to a very good scale, the percentage is very small, right? So, if I go back again in October 2020 and can see that, we will be in 24, right? It's impossible. You actually start with your belief in the category. That is this the right category? Is this something that you think will gonna evolve? Is there a market for it? And in that market, how can we differentiate and have a unique positioning? So actually started with that.
But I want to pause here. How does a chartered accountant and a chemical engineer decide to bet on the beauty and personal care category? I mean, how does this happen?
No, so like you said, our journey started with free will. And in that, the entire game was purely tech. 2 years later, when we're thinking of expanding this entire proposition into skincare by creating personalized skincare, that is what we were doing. But then we were all impacted by COVID. Nothing was working. We also got 3 months to sit at home, figure out what next. Because while personalization is very interesting and add a lot of value, the challenge is distribution.
Right.
You're not able to leverage, your e-com, retail, or anything. So I guess in that period, we thought, why don't we try something else rather than putting multiple active into a bottle for your personalization? Why can't we do very problem-specific solution for an individual and let them create their own personalized by maybe buying more than one product?
Yeah, so let the consumer decide.
Let the consumer decide. And that is how you can even, figure out your distribution also. And yet you are very close to how we started. Parallelly, again, when you go deeper into any category, you also understand the good, bad, ugly side of it. So from outside, it all look, very
Good.
interesting, all good, hundreds of people in R&Ds and larger companies and all that happening. But most of the companies take customers for granted. What you see in front of the label is very different than what is on the back of the label.
And then very different from what's actually inside the bottle.
Exactly. Regulations is not very stringent. Even today, if you go to any large beauty platform, look at maybe top 10 sunscreens, send them to an independent lab, 70% of those products will not get the claims that they are reporting. Their SPF value will not be more than 15 when they're saying 50, right? So that is where we are. So we thought that, while all this is happening, we invest in the tech, but actually we can create something which is very transparent and honest. Because, as a customer, we all need that.
Yeah.
And just focus on product, not on brand. There will be many customers like us who are more functional, who might be able to relate with our story. So actually that's how it all started. On one side, solid distribution. On other, working on those values that we did not like being in this industry. So it started as a pilot, and it grew faster than we expected. And after that, we had to shut down Freewill and focus completely on minimalist.
So the pivot from Freewill to the minimalist, first of all, how did the name come up?
So we were thinking, what to put in a bottle, and the conversation was going on in a team meet, and we think that everything which is relevant for a consumer, we should only use those ingredients. We should remove all the fluff, no marketing stuff, no fragrances, nothing. We would want to keep it very minimalist. And this word came 2 or 3 times in the conversation. And we thought, hey, it's a nice word. Let me see if the trademark is available. And it was. And we thought that, if you're talking more about, using minimalist as a philosophy in the product, the name goes well with it.
Just call it minimalist.
Just call it minimalist. So actually, it just came in a conversation. And that's when we thought that it goes well with the brand philosophy. So that is what we should name it.
Cut to 4 years later after you started the minimalist. And I'm sure that along the way, there probably was interest coming in from potential suitors. Unilever Ventures, of course, is an investor. So I would imagine that journey from Unilever to HUL was an easier journey to make. But the decision to exit at a time where things are going very well for you, where you've got growth, you've got profitability, you've got a clear runway ahead of you. The decision to take the call to exit then, how did you make that choice?
It wasn't an easy one. And again, before this conversation, many a time, some other large company wanted to meet us to explore synergies.
Did you meet them?
No. Most of the time, the answer is no, because we were not honestly looking for any M&A or any such partnership, right? Because, again, one, we knew the businesses at a very nascent stages, and we know it better than anyone else, right? So any such collaboration or partnership will actually kill what we have built.
Yeah.
When the conversation with HUL started, I think 2 or 3 months before that, we started our Series B process. So we even hired a banker. We started meeting investor because, again, till then there was no discussion on M&A. It was not even our roadmap. But around that time, we started talking to our investors just to understand what is it that they are also looking at, what we also need. So the sweet spot, what we felt in India is somewhere between this $300 to $500 million when it comes to M&A. Anything beyond that might be more challenging. So if we raise money 3 years later, given where we're expecting the business to be, the option would be IPO.
IPO, yeah.
Right?
Yeah.
And then you are signing up for that for next maybe 10, 15 years as a founder. If you don't raise, M&A is a opportunity, right? Or we might raise maybe about 2 to 3 years if there is no M&A, and can run on our own because we're not looking for a lot of capital. But when conversation with HUL started,
when did the conversation with HUL start?
It happened in October, towards end of October, and we felt that there's lot of synergies we can draw from them. So after a while, see, numbers beyond a point doesn't excite anyone, right?
Yeah.
While we understand the digital part of it, they know the retail offline businesses far better than us, right? And if we truly believe this is helpful for consumers, it's important for us to be present, right? We can reduce our chances of taking wrong steps and all, and whatever we can do, say next 5 years, with them we can do it in 2 years. Second, maybe after a year or so, when we started doing some bit of international, we started getting a lot of feedback that the made in India will not work. Not a lot of distributors are very comfortable selling our product. Some even suggested that why don't you set up a small facility, say in Singapore or the market, and only for international you kind of create made in Singapore, you import from some other.
That's interesting. So you were told that made in India will not work.
Yeah.
Why not?
See, we don't have very good reputation in beauty and personal care when it comes to made in India. Not too many brands have been able to position themselves globally, right? We have done well in pharma, but not much has happened in it. And we always felt that someone has to do it anyways, right? So we never sold anything by routing from any international. Every product, even till now, that we ship is like made in India. And we started seeing a lot of traction. So like our market share started increasing. We are in Southeast Asia. Our ratings on Shopee, Lazada in Malaysia, like 99% of the customers rated us 5 on 5. And we felt that the perception is maybe in some distributor, some individual.
Right.
And actually, if we deliver on the promise, we are able to build this
trust.
Build the trust, right? So that beauty for the world is something we can achieve. And again, we felt that with HUL, we can do it faster, we can do it better. There's always a shelf life for an idea. If we miss out on some of those opportunities today, will that opportunity exist 5 years later? May or may not, right? And I guess as a founder, at some point in time, you always feel that, say, 10 years from now, if I can see that, this is a household name globally, we are well present, we are much larger organization, doesn't matter who has larger shareholding, I think I'll be more happier versus again, what if this would have happened and living with that feeling that, I think we optimize purely on our returns and then thinking what is right. And I guess the last part of it is at some point in time you start to disassociate also. So, with time you feel that I and Minimalist are same, right? That is my identity.
Yeah.
But then you feel I like creating product. I'm operator by heart. At some point in time, if I'll find something else to do interesting in life, I'll do that. We don't know we'll succeed or not, but that is a life that I enjoy. So I guess, all those things, if you put together, you start to feel it kind of makes sense for everyone.
Well, it's also interesting because what you worked out as part of the arrangement with HUL is that you pretty much will continue to operate as an independent island within the large HUL framework. Now, how did that come about? And was there agreement on both ends on that working forward as well? Because, integration has been a challenge for many deals previously. So how did that come about?
It was an easy decision. We needed this to happen. They were also aligned that this is how it should work, right? We should continue to operate where we are doing. We should continue to do what we have been so far. And they can give all the support that they need. So there's an entire ecosystem. We can go and say, hey, we need help in this area. They'll make it happen. They don't want to interfere. So I guess.
So you run the ship.
We run the ship. Yeah. So
there's no change in that.
No change in that.
Even though ownership has changed completely.
Yeah. So we operate from Jaipur. We'll continue to operate from Jaipur. No changes in team. Nothing. So I think it's more about, there's a difference in the cap table before versus now. And then beyond just a financial investor, lot of support around us that we can go and use. But it's completely on us. What is right for the business, do that, use that support, continue to grow. And I think they have been very nice in terms of giving us that flexibility to manage it the way we have been doing it.
But, flexibility is one thing, but to give you complete control on how you run the business, what choices you make, what you do as far as the product portfolio is concerned, all of that remains the same. All of that continues to be your decision, your call.
You have to trust again, you can't document every small thing that,
sure.
Okay, which product you are creating in next 24 months, what we should do, what we should not, right? I guess a lot of discussion happen in terms of how we see the brand evolve and then how they also see the brand evolve, right? I mean, usually thing only happen when you both think in the same manner. If I have a different way of growing the business and they have a completely different way, then it won't work, right? And I think the reason even this deal happened is because I guess as a group we are thinking in a very same manner. There were hardly any area where we had disconnect, that either in terms of retail, how many stores we should have, either in terms of international, what is it we should do next, either in terms of the product, what we should and what we should not. I guess knowing what you don't want to do is more important than knowing what you have to. And then getting the same comfort that, these are the areas we also don't want to from their side was again, very comforting for us. So rest is again then trust.
And it's going to be an interesting experiment even as far as HUL is concerned, I would imagine. But so what does this now do in terms of turbocharging your plans? Because as you pointed out, there are things that you can probably do now in 2 years that it would have probably taken you 5 to 7 years to do as just the minimalist. So give me a sense of how you turbocharge the growth ambition and the growth plans for the company from here.
I think the three very easiest growth lever, one, as I said, is our offline expansion. So with them, we know which store, what data, what is relevant, not relevant, then exploring this entire piece, understanding, for the next 2 years, how many stores are relevant for us, how to plan. They already have an on-ground team. We can leverage a lot of those things, right? So I guess so far we are in some 2,000 stores, and we took almost 12 to 18 months to be here. In next 2 years, we can easily target anywhere between 15 to 20,000, right? 10 times more than what we have achieved. And all that, again, can be done very seamlessly. Second is international. While, of course, we started working in these markets, we have some bit of retail partnership. But every new market you enter, you have to, again, figure out who are the right channel partners. You have to have those relationships and all.
And that's where the Unilever system will kick in.
And that cycle take anywhere between 4 to 6 months, right? Again, with HUL, given they are present in most of these markets. And now, because of their prestige portfolio, even we know, say, which channels have performed better, say, for Paula's Choice, K18, other brands, then what should be our distribution strategy. All that is now easily accessible. And then there's an on-ground team with whom we can go, take support, talk to those partners, and again, launch faster. So that, again, is the second. And third is the global R&D centers. Whatever we have been doing in terms of, our own clinical studies, test, evaluating ingredient, they have been working on multiple things. So we have a easy resource we can tap in. So it again makes so much sense for us in terms of consistently deliver what we have been. So I guess those are the honestly 3 areas where we see a lot of synergies. Beyond that, operationally, from again, given their scale, they have the lowest rates in terms of logistic, warehousing, procurements, whatnot. So all those will come again with time, but growth largely from the first 3.
And manufacturing continues to happen out of your plants?
It continues to, So we are evaluating a few more options because, again, at some point in time, our plant will reach a capacity. We are already at some 70% utilization. Setting up a new plant, or HUL also have a lot of facilities. So can we use some of their facility? Shall we invest in the new one? That we are still trying to figure out. The one we are running, that will continue to be functional. There won't be any changes there.
No change there. So, is this now a 2-5 year arrangement? Is there a time limit that's been put in place, or is this something that you will again decide as things unfold?
No, so there are 2 things into it. One, of course, the remaining 10%.
Correct.
So that will change hand after 2 years. But our role, again, we love what we do. We are here for at least 2 years. And beyond that, I don't want to say things that I don't know, to be honest. We will see how it evolves. If we still find it challenging, if we think we are able to contribute the way we have been, we'll continue to be here.
gave you the belief that you had a right to win in this market? You're up against not just other D2C players, but you're up against, global companies. You're up against Indian large incumbents who have the capital, who have the distribution muscle, the distribution power, and existing brands in the market. What gave you the belief that you had the right to win in this space?
When we started Minimalist, we felt that, while distribution is all taken care of, most of these things in terms of agility, in terms of marketing, will also be commoditized.
Right.
Most companies work with the same 3P. Their product portfolio remains very similar.
Yeah.
You have the same set of content creators, influencers with whom you can also work.
Yeah.
Your differentiation probably will be how deep you are in your investment capital and ready to burn to grow this space, right? So money will only be the moat. And we don't think we were made for that.
Was that the chartered accountant that that drove that philosophy?
I always felt that a business should be run like a business. It has to make sense. And if your differentiation is just your marketing, someone can come and disrupt you, right? And off late, I started to feel that, from now on, you will start to see companies which will win this market because they have better product. So while other two things like, the ecosystem, marketing and all are again commoditized, distribution is a commodity, the product is a differentiator. So we always knew that we would want to differentiate on product. We invested a lot in our R&D.
It's interesting that you talk about the focus there as far as R&D is concerned, because this is the lament that everybody has with the Indian industry in general, that there is not enough spend on R&D, that there is not enough innovation that's going on.
Yeah.
So as a startup, to have bet on that, to have actually spent most of your capital on building a R&D team that delivers the goods, that's a pretty bold, courageous bet to have made at the start of your journey.
Actually, it's a misconception, to be honest. I think the percentage of spend required for R&D eventually is much lesser that you need for your marketing. So it's a very good trade-off. I read a quote that, you can create an average product and spend rest of your life selling it, or you can create a better product and let people do your marketing, right? So where we want to put our money, we want to put in R&D or product, or we want to continue to spend disproportionate amount in marketing. If you actually see it in a 5-7 year horizon, you'll always feel investing in R&D is much better ROI than always doing it in marketing.
That clearly is reflected in the way that you've been able to grow the business. But, going to 500 crores in the last 4 years. And this is not something that we've seen even the large companies who have their own D2C brands be able to do successfully without burning cash because you're profitable, without spending the big bucks on marketing, without going down the influencer route, which is what we see other D2C brands do quite successfully. How did you start to get customer traction? How did you start to build customer love? What was that X factor that worked for you, you think?
So I think a couple of things honestly help. When we were starting, we thought that this is a right space to be in. But we felt it will take a lot of time in terms of educating customers about the actives and all. But one thing we realized is even the small segment of customers who knew these actives and this space, that percentage was big enough for a startup like us, right? Then I think the overall ecosystem. So we did a lot of work in creating educational content through our social media, where we told people about these actors, that acids are okay and all those things. A lot of customers became the evangelist. So see, everyone today is a content creator, directly, indirectly, right? And if you like something which you think is worth sharing, you will do that. And if you can give that as a hook in your product, people will be more than happy to do it on their own, right? You don't have to pay them to say about it. And then even on content creator, so many dermat create content, many skincare content, influencers create content, right? Even if we never had a paid collaboration, but if say their followers are asking about, hey, what is niacinamide? Most of them were educating it, right? So while a lot of educational content was being created, people were aware about it. Brands like ours also got an advantage from it, right? So I guess everything came together and supported.
So are you now an expert on niacinamide, alpha-arbutin, kojic acid, whatever else is on the hot active ingredient list? How clued in are you?
I'm probably more like an informed consumer. Rahul, he's my co-founder. He knows these things better than me. And then, of course, the R&D team, they're the expert. So again, I'm just like anyone else in this room.
But again, the choice that you made to decide to go down this route, which is the active ingredient route, which is a relatively nascent new space, not just in India, but globally as well, as opposed to the natural space that people seem to be veering towards at this point in time. Was that something that you thought about in terms of the route to take before you decided to go the minimalist way? Was that an active consideration? Should we do the natural way or should we take this route?
See, it was confusing, and I think most research around that time said that the market is clearly naturals.
Yeah,
that
exactly.
is where the trend is, right?
Exactly.
But again, if you'll ask someone who does not know this space, I take natural as a word purely for safety. So say if I go and talk to my mom that, hey mom, do we want to use salicylic acid, say, or something made from neem?
Yeah.
The word acid will be scary for her.
Yeah.
And she will say, I would prefer something more natural.
Yeah.
I think that does not mean she prefer natural over these active. I think in her mind, she's saying more about, I would want something which is more safer for me.
Correct.
And I think that is where probably it was little blurry, right? Second, we always want to do something which is more clinically proven. In these actives, while in beauty, these are new, but in pharma, dermats have been prescribing these for so many years anyways, right? So like benzoyl peroxide is not new.
Yeah.
Doctors are writing these products for last 20, 30 years.
Yeah.
We have been consuming it directly, indirectly anyways.
Yeah.
So there was a lot of research done on these.
How inspired were you by what was happening around you? And I know that a lot of people do the comparison between the ordinary as well as minimalist, and certainly the packaging does have a lot of relatability in that sense, and they don't do the marketing fluff either. Were you inspired by the
Very
ordinary
much.
story?
Yeah, again, had they been in India, I always say that there was no need for a brand like Minimalist, right? And I always was surprised when we're doing Freewheel that, look at this brand, they're doing some really good work. They are very transparent, they're honest, there's a lot of, effectiveness in terms of studies and all that they share, right? Why no one is doing it in India? Of course, we are doing something in skin, hair care, not in skin, but it always used to, excite me.
But then how did you ensure that while you take the values that are core to the ordinary, but you also ensure that you create something that's differentiated, you ensure that you create something that is not just imitation, but really stands out on its own?
So I think with time you realize the needs of customers in different markets are very different. We also live in a very different climatic condition, right? So a same product won't work in each of those markets. And I'm not saying that, Indian skin is different. Again, that's a marketing story most people say. But say the concerns.
So it's not?
It's not. It's...
But we're more prone to things like hyperpigmentation and so on and so forth.
I think your concerns would be
Yeah.
different. See, if I talk about, say, aging, right? Someone in India age in the same manner, they need the same product. And say product like retinol will work in the same manner.
What is the difference, by the way?
It's a different, so I think retinol take two steps to convert into, I guess, retinoic acid or something.
Okay.
Retinol just take one. But again, coming to the point, I think, say pigmentation, rightly mentioned, is a bigger concern in India, right? Versus say someone in US. And being in this market, we know we have to be far more deeper into such categories. So today we have like 3 products for pigmentation, while most of the US companies will have maybe 1. On other hand, say rosacea is much larger problem. You don't see those problems that often in India. So we don't have any product for that. Later, we also realized that, we don't want to be just a serum brand.
Right.
And we started expanding our portfolio into the maintenance and the other category in skin, right? From cleansers to toners to SPF and other. Now we are into even scalp and hair care, and recently launched even a baby care. So while the initial similarities were more about, the values and few product, then you have to figure out your own story, your own journey.
What's also interesting, and I don't know how many people know this about you and how both you and Rahul got started, but you're both brothers from Jaipur who had no background in business. Of course, you experimented with a bunch of startups from apparel to hair care, personalized hair care, which eventually led you to the Minimalist. And the decision to actually start up had more to do with the fact that the two of you wanted to work together and continue to work together. So the building out and all of that was an afterthought, but it was more, how do the two of you spend more time together, right?
Exactly. So actually we started our first venture, which was an apparel, purely to stay together. So we grew up in a small house, and I started, focusing on studies around 11th or so.
Before that, you were not interested.
I wasn't, to be honest. I wasn't taking things very seriously. If I'm not wrong, I might have failed in 1 or 2 subjects when I was in 9th standard.
Might have. You did or you didn't?
Borderline, probably, yeah. And I felt that, I don't understand much of it, right? I was always more in sports, just like any other kid, right? I mean, your passion is cricket. And we used to spend a lot of time on everything than studies. And I think around 10th or 11th, I realized that, how much effort our parents are putting in giving us good education. And some of that we are taking for granted. So that's when we become more serious. And around that time, of course, we had to cut ties with everything outside of our life, so that we have more time on what really is important. So in a house, if you get an hour or so as a playtime, right? My entire time was with Rahul then. So maybe in our, within the house, you play cricket, you play some other sport, you figure out things together. So we actually grew up more as friends than brothers. And when I was with Credit Suisse, I know my options were either to move to UK, or within Southeast Asia, it was largely Singapore or Hong Kong. Rahul around that time got a pre-placement offer from one large FMCG company in India. And we can imagine that, how our life will be. We will meet maybe once a year on the festivals and all. And we felt that, this is not something that you wanted to do it, right? So starting a business would be the right thing. It wasn't startup, because I'm talking about, 2007 or 8. Terms like startup, entrepreneurship were not even commonly used. So we felt, let's do a business. We will figure out what it is. And at the right time, we will go back to Jaipur so that we can spend more time with family. And that is how the journey started.
So you're inseparable. This approach to saying, look, we'll figure it out. And this doesn't come very naturally, because, we've grown up in an environment where there has always been this very conscious attempt at having a plan of, whether you get into a job or, that there needs to be a plan A that you're working towards. And when I hear you speak, saying that, okay, I'll leave Jakarta, come back to Jaipur, or give up Kar Dekho, and, we'll figure it out. Where did that courage come from? Because, often failure, or the fear of failure, or the fear of uncertainty holds us back. I mean, were there concerns that the family expressed, for instance, saying, "Kya kar rahe ho yaar?" I mean, stick to the jobs that you have.
Yeah, I mean, you are right. See, you have your own doubts whether this will work or not. And then you're worried about your family also. And unless until you have full support from there, it doesn't work. And our family have been very supportive. We knew that, say if we'll take 1 or 2 years to figure something out, that much time we can give to ourselves. If it won't work, I guess we can always go back to our corporate life, do something. But not doing it now. Never wanted to, grow up with that regret that what if, exactly. What if, we could have done something, and we never took our chances. So when I came to India, I told Rahul about it. Rahul has always been very supportive. He said, one person can't do all. So I'll also leave. So he left, and we needed money. And by then, of course, we never had a lot of savings, right? So we asked our parents, and you'll not believe that, they said that, we can mortgage the house, raise a debt. And actually that is how our journey started. So we raised around some 80-90 lakh by mortgaging the house.
That's again a very unusual thing for Indian parents to do, mortgaging a house to fund a startup, or a business. It's a pretty brave thing to do as well.
Yeah.
What has been your learning process, especially the feedback that you get from customers, how you've utilized that to actually build the business, build the brand, refine the product portfolio as you move along? What has been the learning curve and the learning process for you?
So in our case, it was simply that, create clinically proven solutions and then be transparent with our consumers. Now, most of the time in our office, whenever you have questions that you need to answer, just look back at these two values, you will find 90% of the answers. So like when K-beauty became popular, a lot of people started asking, even an investor, that, do you want to do Slaying Mucin? It's popular, yes. Will it give a lot of advantage in terms of business? It does. Is it clinically proven? It's not. Then the answer is simple. It should not be part of Minimalist. Shall we work with influencers? If I'm paying someone to say good thing about us, how is that transparent? And if you want to really live those values, don't work with them. Then work with the community. We actually need someone to say that, hey, it's working, right? Can you work more closely with the consumers? So actually, the biggest learning is this, that,
so that kind of sets the boundaries. In a way, the values set the boundaries for what the business should or should not do.
Correct. And I think more closely you define those boundaries and more sharper they are, and you actually have to live those every day. It, with time, even help in terms of, decentralization of decision making. You can't take all the decisions. But if your people also know that, okay, these are the parameters I have to look at every now and then. Like, my R&D team never come and ask me to create something which is popular or trending just because we should jump into it.
Isn't there a fear of missing out? Because that drives a lot of decision making. And especially when we talk about investors, I would imagine that there has been that pressure. You talked about, for instance, the K-beauty trend. How do you retain the confidence to say, no, we're not going to go down that path? The fear of missing out is a real thing.
Again, one learning is you should be ready to say no to most of the things around you. It's never about the right decision you have taken. It's more about how many wrong decisions you have taken in the process. Out of those 10 opportunities, 9 are not relevant. Be very, very sharp for your consumers. You should be something for someone, right? I mean, you can't be like, everything for everyone.
Everyone, yeah.
And no one needs that. I think markets are deep enough, at least now in India. We're not talking about like 2010 or so, when say actives or this part of the business is very small. You have to unnecessarily expand your TAM. And more so now. So while of course the Indian market is growing, we are even expanding internationally. Entire GCC, South Asia, US, Europe, I think those are much more deeper. I don't think we are there yet in terms of TAM. So I guess, again,
the headroom for growth is significant.
It has been, and that's true for most of the businesses, trust me today.
the other learnings about the Indian consumer? As what would your advice be to somebody who's looking at getting into the D2C space at this point in time, and on how they should go about addressing needs, how they should go about building at scale?
See, one thing that we have seen a lot, people are way more smarter than we think, right? And that is not just a phenomena only in your metros or tier one. The same level of awareness even exists in smaller towns. Someone living in a tier 3 is also following, say, a dermat in New York.
Yeah.
And this person knows exactly
So the internet
what
has
you're
changed
selling.
that, has been the big
Exactly.
leveler.
So the flow of information that used to take a lot of years earlier is now very seamless. I know exactly what these are. And many times we think that people don't know about it, but people are smart enough to understand. So don't take them for granted, ever. Second is, I think there's a lot of noise around it. In any space, you will see multiple things are happening. Start with a niche. Focus on solving some specific problems. Once you have enough comfort or trust in that, then expand into other. Like in our case, we started with problem solution. Then your maintenance product moisturizer. So go with the painkiller, because that is where defining or differentiating with someone else is easier than the so-called vitamins, right? So good to have is more challenging space, but the problems are easy to target. Those are difficult also to solve. But if you do, you immediately have the trust. And always focus on customers. I can't emphasize more on it, right? I mean, I see this as a statement everywhere.
That's the most abused thing, right? I mean, which company doesn't say that it's customer focused, customer obsessed, customer centric?
Yeah, so, most of them say, very few follow. And for a new startup or a founder, many times things look very overwhelming, that there's so much of a competition, so much is going around. It is what we have seen is a very few are doing actually the right work. Rest is just noise. Ignore that. Do what is right for customers. Focus on right categories. Don't worry about the time. And most of the things will fall in place.
So, break this down a little bit further for me. When you say that you've been customer centric, and that's different from the claim of being customer centric, what have you done differently? What have you done that you believe speaks to the truth of living that value?
See, you have to do hundreds of things. Let me start with, say, e-com. There's a industry in India. You can buy a 5-star rating on any e-com by paying 30-40 rupees. That's true. Most
and it's
companies
happening.
It's happening.
It's prevalent.
It's prevalent. Everyone does that. You can see a product which is recently launched, like 2 weeks back, and within 2 weeks you can see that it has 100 5-stars ratings and all, right? Many times you can simply see the date of the listing and the rating. It won't make sense, right? 100 users who are buying can't come back and give the rating. Usually 1% does that, right? So till the time you don't have maybe 10,000 or so, only a fraction of that will reflect. We never did it, because again, for your team, you have to be that role model of doing the right. Again, is it transparent? It's not. Is it right to the customer? It's not. Don't do it. We recently launched a product for our hair care portfolio. It's a anti-dandruff, and because there was some manual filling involved, few caps were not tightened properly. So when the product got delivered, in some product we felt the cases of leakages and all. If you go to Amazon today, you can see maybe our rating is like 2.5. Now it's very easy to buy some, fix it and move on, but not a single team member have asked us to do it, because they know this is not the right thing. And again, I'm just giving you small examples, right? We know with time, when people will buy the product, the larger customer will see the right thing. Eventually the ratings will change. If it won't, we'll have to figure out something to make it work, right? Influencer marketing, we spoke about it. There's an entire industry where you can have ads, not ads, by even giving collabs. People are saying good thing about you, that hey, this changed my life and all. Everyone does. It's a smart thing to do. Is it a right thing to do? At times it feels very questionable to me.
Could be a tactical thing to do.
Yeah. See, I
an
think if it
opportunistic
is,
thing to do.
It's an opportunistic thing to do. Is it the right thing? In my mind, I always feel it's not. See, till the time someone is giving an honest view and asking you to pay for my followers because I'm taking that space and then giving all the pros and cons of a product, that's the right thing to do, right? Because I'm using a media. For me, it's just a media, right? But if even this entire narrative is also being sponsored, I'm saying exactly word by word what is being someone asking me to do it, right? Again, for me, honestly, I may be more old school, but doesn't feel right to us.
Before I end, I mean, now that the baby has, in a sense, changed hands, what is the vision that you have for the Minimalist 5 or 10 years on?
Can it be one of the most loved or trusted brand? I'll not put a number to it because again, as I said, we never chase numbers. If you can become a brand, which I say that, globally, when people say, if I'm thinking of active, I'm thinking of a company which I can trust, and this names come on top of a mind, right? Rest will follow. So doing all those things for each of those markets, again, wherever it's needed, continue to double down on the very, very basic thing. At times we glamorize by saying this is very complicated. It is not. It's very simple.
You have to keep it simple.
You have to keep it simple. Right people, right product, do what is right for customers. There's no fourth thing. Just these three. I think everything beyond these are very easy to manage, which is your capital and whatnot. So just do these three things. This is what we are planning to do.
Do these three things and keep it simple. So, you said that you don't have a plan B at this point in time on what happens perhaps 2-5 years down the line. But is there even remotely a seed of an idea that is kind of somewhere there that you're thinking about at this point in time in terms of what next?
No.
All about the Minimalist at this point in time.
Yeah, it should be. Again, I think we are at a very interesting stage right now. Next 2 years would be very exciting. And I think I'm very, very focused on understanding a lot of, again, as I said, we never did retail. So it's a new learning experience for us also. We never did a lot of international at scale. So good learning experience. And I'm more excited about it.
Well, it's been such an absolute pleasure speaking with you. Thank you very much for keeping it real, for saying it like it is, and for sharing the story and the journey of the Minimalist. We wish you the very best of luck with your future endeavors and with your plans to take Minimalist global and make it one of the most loved and trusted companies in the world. Appreciate your time and thanks for sharing your story with us.
Thank you so much for listening.
Well, with that, it is time for us to wrap up this edition of the Young Turks Reloaded podcast from all of us here on the team for now. Many thanks for watching. Do stay tuned to CNBC-TV18. There's a lot more coming up right after this. We'll be right back.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with
You're watching CNBC-TV18. It is now time for the big newsmaker, the big CNBC-TV18 exclusive. The news coming in from the insurance space. Allianz is set to exit the Bajaj Insurance joint ventures 24 years after they got into an alliance. Bajaj Finserv and Bajaj Group promoter entities will acquire 26% from Allianz in Bajaj Allianz Life and Bajaj Allianz General Insurance for 24,180 crore rupees. The transaction will give the Bajaj Group 100% ownership in both Bajaj Allianz and Bajaj Allianz General Insurance, as well as the life insurance business. Joining me now to talk to us about the road ahead post the exit of Allianz is Sanjeev Bajaj, the Chairman and Managing Director of Bajaj Finserv. Sanjeev, many thanks for joining us here on CNBC-TV18. It hasn't come as a surprise. This was anticipated. It's also been a fair amount of an overhang as far as the businesses were concerned. But finally, this 24-year alliance, this 24-year joint venture partnership has come to an end. I want to understand from you, to start with, Sanjeev, how prepared are both businesses for this exit at this point in time?
Shireen, good morning. And let me start by saying that this has actually been a great win-win deal for both partners. Both partners have reinforced their strategic intent for India, but with different paths. And from Bajaj's point of view, the Bajaj Group reinforces its focus in India on the insurance business at 24,180 crore that we are going to be investing to buy the 26% stake in both our insurance companies. I believe this should be the single largest investment in the insurance space ever in India, and one of the largest investments in the financial services space. Once again, reinforcing Bajaj Group's commitment and belief in the India opportunity. As far as both our companies are concerned, these are managed by very well qualified boards and by senior teams that have been with us for very long periods of time. And hence we see no change at all at any operational level. Our partnerships will continue to be the same. Our distribution continues to be the same. Products are the same, so no change on the ground.
So no change at all on the ground as far as operation is concerned, Sanjeev. But let me ask you whether you are going to scout for another partner, whether that is at all something that you would like to even consider at this point in time, or do you believe that going solo now after this 24-year arrangement is the preferred route for you?
We are very clear that given the capabilities that have been built in both our companies now, almost 24 years old, both the companies are perfectly capable on going solo. Effectively, as I said, the board has been running both the companies, a board that is controlled by Bajaj, and with the right support from Allianz as and when required, but fully empowered board and management. And as a result, no, we don't need another partner. If you also see the Indian insurance space in the last decade or so, this is not new. There have been multiple companies, including most of the leading companies, where the Indian promoter has gone solo, and most of those businesses have actually even done better.
Okay, so going solo, that is the route forward. That's the road ahead. Let me also ask you about the possibility of listing, Sanjeev, because this has been the regulator's nudge to industry as well, that large insurance companies need to consider a public listing as well. With this eventuality out of the way now, is that an imminent possibility for you?
Well, as you mentioned, Shireen, correctly, the regulator has been engaging, especially with the larger, older insurance companies, to talk to them about the possibility of listing, to put a glide path and timelines towards that. This is something that has been taken up by both our boards as well, given the significance of this current action with Allianz exiting the insurance companies. It will take us some time for the rebranding once we get all the regulatory approvals, etc., etc. And as a result of that, the board at a suitable time will consider the nudge, as you said, from the regulator and put out a path forward.
But, you know, indicative timeline, Sanjeev, and I understand that you are going to go through this process of Allianz exiting, which will, of course, require the rebranding as well as other regulatory approvals. Number one, by when do you anticipate all of that getting done? And two, you know, what could a realistic, practical timeline for an eventual listing be? Are you working towards an FY27 kind of scenario?
I think FY27 is early. The board and the management has been fully involved. Well, the board and Allianz as FinServ as a shareholder has been fully involved in the current transaction, and the management will now roll out the necessary changes. So for us, the next year or two is going to be busy with this. I believe at a suitable time, the board will seriously evaluate IPO as a possible option for both the companies. As you know, both the companies are very well capitalized. Our solvency positions are the highest in the industry. The businesses have not really needed external capital now for over 10 years. So we have truly built two businesses that are balancing top line and bottom line, focused on customers as best as I think is possible in this country without being immodest about it. And hence we are in no hurry. Yet we understand the nudge from the regulator. So in a suitable time, the board will consider this, and once it comes out with clear direction, we will actually share it.
Okay, we'll wait to hear from you on that. But Sanjeev, a little bit about what happens now as far as Allianz is concerned. And I know that you don't really have a say in that any longer. But what we did see from Allianz in its press release last night was that it's going to use the proceeds to make strategic bets in India and look at opportunities in India. I just want to understand from you, is there any kind of a cooling off period that's been factored into this arrangement, into the agreement between you and Allianz as they exit?
And the answer to that, Shireen, is that once the first tranche of the shares are bought by Bajaj, post all the naturally regulatory approvals, the cancellation of the JV and stuff, we release Allianz from the non-compete, so then they are free to go ahead and get into binding agreements in India. This was their desire and one of their asks, and we completely understand that as a large player. And that's why I think the discussion, the negotiations have been such that it's created a win-win on both sides.
And just to understand that, so you're saying that once that 6.1% is done with, Allianz is free to tie up if it wishes to with any other Indian insurance company, any other Indian promoter, if it so desires?
Very much so. Along with that, technically the JV agreement falls away, the name change happens and stuff, but yes, in effect.
So how do you see the competitive landscape? It seems pretty clear that Allianz is going to be in India, who we don't know quite yet. But how do you see the competitive landscape emerging post this transaction ending and the possibility of another transaction starting?
You know, there are two ways you can look at this. There are 50 insurance companies, so there will be a 51 in what is a crowded and competitive space. We have seen that for the insurance companies started in the last decade or so, it's not been very easy to build scale profitably just because the large companies are doing a great job. On the other hand, our own long relationship with Allianz tells us that they're a high quality company, and we would welcome a sane competitor, a high quality, measured, conservative competitor into the market to just help balance the market. But I think it takes some time for them to get in, assuming that's what they will finally do. I've also read the press release like you, and it takes time to build a good quality business.
Well, speaking of building a good quality business, Sanjeev, I want to understand what the growth appetite and the growth aspiration is for both businesses from here on. IPO is a separate matter altogether, but let's talk about growth. It's been a relatively slower year in comparison to what you've historically seen. What's the expectation and the anticipation from here on in terms of growth?
You know, the general insurance business is very much an asset-led business, and since we've seen a slowdown in asset purchases, you've seen that industry slow down to 10-12% growth. We've been growing a little faster than that, but also with a key eye on being fair to customers and on profitability. On the life insurance side, the last 7 or 8 years has seen Bajaj Allianz Life significantly outgrow the market with a set of new relationships on distribution, new products, and building top line and bottom line quite well. Given the significant change that happened last year with surrender values, it has been an opportunity for us to rejig again our focus and look at growth with a much higher level of profitability, and that's what the team is currently working on. So I see both the businesses growing at healthy levels at or a little higher than industry levels in the coming years. Keeping in mind also that, we're going through a significant period of global uncertainty. India is one of the few markets which is still managing to grow 6+%. And I think that's something for us to celebrate. But of course, plan how can we get to 7, 8, 9%. And I'm very confident that you will see this in the coming decade. And for low penetration industries like insurance, it's going to be a great decade ahead for us.
Well, you believe that it's going to be a growth decade ahead for the insurance sector, which continues to be underpenetrated. But it's also happening at a time where the FDI regime for the insurance sector has changed. And ostensibly, that's the reason, I would imagine, that Allianz has decided to exit this 24-year partnership, Sanjeev. So did it eventually boil down to the fact that they wanted majority?
Very clearly, I think that's something that you have to ask Allianz and have them answer. But as they have said, India continues to be on the strategic radar for them, and we'll hear more as they move ahead.
But, do you believe that we are likely to see more foreign players looking at the India opportunity, specifically the India insurance opportunity, now with this FDI regime change and 100% FDI now on the table?
I think they should, because when you look at, again, as I said, the companies in the last 10 years, most of them have stayed small. They are not able to bring in the right amount of capital. They end up then cutting corners to build growth. We need good quality players, because keep in mind, insurance is a long-term business. It's a business with a very high level of risk. You get your risk assessment right, you can have one large incident in the general insurance space that can wipe out your capital, get you bankrupt. On the life space as well, guarantees, long-term guarantees have been known to wipe out businesses. Hence, you need good quality promoters, companies that understand these businesses. Plus, we have such low penetration levels in India that it doesn't worry me at all that as Bajaj continues to grow, there will be the opportunity for many more players, because we need so many more Indians to get that security cover.
You said that there's unlikely to be any operational change at this point in time, Sanjeev. But, it has been a partnership that's gone on for over 2 decades. So I would imagine that there will have to be a fresh roadmap of some sort that you draw up. And I'll ask you this in the context of another eventuality, which is, on the anvil now. Rajiv Jain, 31st March is just around the corner. What do you believe is likely to be the role that Rajiv is likely to play as far as each of these businesses are concerned?
So firstly, as I said, a board of both the insurance companies controlled by Bajaj has been running the business for over a decade, and there is going to be no change, I can tell you, on the ground. Day-to-day competitive activity continues, but there is going to be no significant change. As far as Rajiv Jain is concerned, we have a board meeting coming up later this week, and Rajiv is fully committed to the group and the business, and the board will evaluate. As we know, his term comes to an end of March. The board is evaluating next steps, and you will hear about it soon.
If I may, because this is something that the market and the street is watching very closely, and different scenarios are being painted at this point in time. I wonder if you've had a look at that. But, if you could give us some color and clarity on what some of the options are that you are exploring, that the board may consider as far as Rajiv's engagement post the 31st of March is concerned with the group.
Well, I think the board meeting is in 2 days. This is the NRC and the board that will decide that. I don't have any absolute right on that, so let's wait 2 days.
But he's very much going to continue to be with the group in some form or fashion, perhaps in an elevated form or fashion.
2 days, he's fully committed to the group.
Okay, I'll leave it there. I did try, Sanjeev, but I also want to understand from you the contours of this transaction. By when do you think the 6.1% will be done, and the funding for the transaction, as well as far as the promoter group companies are concerned?
So again, Shireen, this requires IRDA and CCI approval, which we hope will come in the coming months. But naturally, we have to leave it to those regulators to decide. We will be in the process of applying our post yesterday's signing of the agreement. The funding is where of the 26%, a little over 1% will be bought by Bajaj Finserv, so that Bajaj Finserv then is in absolute control of both the insurance companies. And keeping in mind the speed with which we needed to and moved ahead, and the funding opportunities available, because Bajaj Finserv is a unregistered CIC, a core investment company. It cannot borrow. So keeping in mind that the Bajaj Group has lent support and reinforced its commitment to Bajaj Finserv and to the two insurance companies by Bajaj Holdings and one of our group companies, Jimlal & Sons, chipping in for buying the rest of the stake. So that is the current plan right now.
Sanjeev, if I can understand from you in terms of prioritization now, as you wait for the process of regulatory approvals to come in, what will the next steps be? I believe that you've also held an employee town hall this morning, I would imagine, to give clarity to internal stakeholders on what the future looks like. If you could share some of that with us as well.
It's a big event for us, and that's why it's our responsibility to reinforce our commitment, support as a group, as a board, as senior management, whether it's to our customers, to our employees, to our partners. And we've started that process from today, and that's why we had the town hall this morning. Our senior leaders will reach out now to all our large relationships, will reach out to the agents who've been supportive of us for over 2 decades. To give them the comfort that nothing changes. With our 74% ownership, I think that's reasonably obvious. But these are the times where we need to over-communicate, we need to reach out, we need to handhold if somebody has a worry or an apprehension. And we will do that in the coming weeks as we line up our funds as well, so that as and when approval comes, we can move ahead. Both Alliance and we are clear that we want to get this over with as soon as we can, so that we both go our own way into doing what we need to do. We are very excited, as I mentioned earlier, about the prospects about insurance in India. And with this additional flexibility that we have of 100% control of both companies in the group, it allows us to build these businesses with our own ambition, our own focus, our own entrepreneurship, our own assessment of risk.
And I'll pick up from that last point that you made about your own growth aspirations, your own ambition, as well as your own risk-taking ability now that it's 100% controlled by you. You said that you will, of course, try and deliver on industry-leading growth as you have been doing. But does the growth ambition, does the risk-taking appetite change now, Sanjeev, with you in full control? And if you can quantify that for us, what it could mean potentially as far as business outcomes are concerned.
When you look at both the companies, you will see a great balance in top line and bottom line. And this has been core to both partners. But naturally, each partner has their own priorities. You have one partner that works in a European environment where 2% growth is great. You have another partner that works in an Indian environment where 15% growth seems to be low. Now that there is one promoter running the show, we will review some of these opportunities going forward. I don't have an answer beyond that. The agreement has just got signed last week. As our board goes with the management into our long-range strategy plan later in the year, some of these things will evolve.
Yes, I would imagine that some of these things will fall into place. But if I may ask you two quick regulatory questions, Sanjeev, which of course the industry is grappling with at this point in time. One, of course, is the government and the regulators nudge as far as the bancassurance side is concerned, and the reliance or the over-reliance in the view of the government as well as the regulator on bancassurance. How do you see that impacting the sector, and what do you believe it could potentially mean as far as you're concerned? Do you imagine being a net beneficiary if the wheels were to be slowed down on that front?
Very clearly, we will be a net beneficiary because we don't have a exclusive tie-up with any bank. But having said that, our general insurance company has over 250 bank tie-ups, the largest in the country. Even though we are not promoted by a bank, our life company has, again, more than 50 partnerships with banks, and that's growing. But yes, as we open up distribution, it will naturally end up being beneficial to companies like us, which is not part of a banking conglomerate. I believe the interest and direction towards this should be based on what is right for the customer. Because on the other hand, you have also banks, they have their own ownerships, they have their own focus areas. So while in my own selfish interest, naturally as it opens up, it's great for us. If it's good for the customer, and I believe it is, it makes sense to open up. And most banks have opened up. There are just a few that are still closed. In addition, what's important is for us as an insurance company, we have de-risk distribution. So if you look at the business we get from banks, what we get from agency, what we get from direct channels, our own proprietary team is very well balanced. And this is something we have done in the last 7 or 8 years so that we are not reliant on any one large partner. Doing that makes you unnecessarily dependent.
Right. My other question, again, to do with the regulator, is on the possible capping as far as commissions are concerned. Again, nudging industry that, look, take self-corrective actions or we will have to step in. What do you make of that, and how do you believe industry is likely to respond?
So this is something that the regulator did a great job a couple of years ago by defining an overall cap on expenses, including commissions. And that is the right way to go. You don't want to be micromanaging below that. There are certain younger channels where we end up paying a higher commission, but we are still within the overall limit. When we go direct, we have no commission, but our expense costs are higher, especially the fixed cost of running a digital direct business. So if you micromanage, you end up losing on innovation. I think the overall cap has been a great direction that the regulator has put in place. There are still some smaller companies that are busting that cap. They have to fall in line and the regulator has to work with them. But overall, as long as you're within the cap, the policyholder is protected.
Okay, so before I let you go, Sanjeev, and we do appreciate you joining us here on what has been a busy morning for you. But before I let you go, I just want to reiterate that no leadership changes at either business at this point in time. Is that what you're confirming to us? And two, you spoke about a decadal opportunity for growth. Again, leave us with some color of what the decade ahead could potentially hold.
So clearly no leadership changes in the insurance companies. The same senior leadership continues and is committed to building the business going forward. The next decade is going to see India moving from $2,700 to $2,800 per capita to 2.5 times that. We have seen in many parts of the world when per capita income crosses around $3,000, by and large, the savings required for somebody for security of the house, children's education, health, basic purchases are taken care of. And the remaining money ends up going into financial services. It goes into financial assets because those then end up being productive and give a higher return. And that is something that we're going to see in the coming decade. This is what gives us that confidence that this, driven by high quality businesses that are focused on the long term with solid teams, a significant focus on technology, leveraging the cloud, leveraging AI. And you've heard about some of the early stuff that we're already doing in AI is going to enable us to create competitive businesses going ahead.
Well, Sanjeev, it's been a pleasure. Many, many thanks for joining us and giving us some clarity on what the road ahead looks like. Important to note, Sanjeev Bajaj saying that they will go alone as far as the insurance businesses are concerned. They're not looking at bringing on a new partner post the exit of Allianz. No leadership changes at this point in time being envisaged, and the appetite for growth and for risk perhaps will be higher at the end of this. Sanjeev, many, many thanks. We look forward to having a deeper conversation with you as you crystallize some of your plans for the future. Appreciate you joining us here this morning. That's the Chairman and Managing Director of Bajaj Finserv, Sanjeev Bajaj, also clarifying that in 2 days a board meeting will take a call on Rajiv Jain's future with the group. Seems very clear that Rajiv Jain will be committed to the group, but what exactly the role will be is going to be decided by the board. That's the big CNBC-TV18 exclusive. We will take a break here.
Hello and welcome to a very special edition of Newsmakers. Global news on tariffs, finance, markets are rocking our world every minute. Today I have with me a newsmaker who can make sense of this ever-changing news around us. I have with me perhaps the most powerful woman banker in the world, the CEO of Citigroup, Jane Fraser. Jane Fraser has headed Citigroup from 2021 and has just completed a massive transformation of the bank, and at the end of it boasted a 37% rise in profit in 2024 at about over $12 billion. And the second most outstanding quality about Jane Fraser is, even as the world around her asked their employees to come to work every day, Jane Fraser stood firm and said that employees can come 2 days to work and 3 days work from home. Flexibility for employees is her hallmark. So Jane Fraser, for all these qualities, congratulations and thank you for joining us.
Well, thank you very much indeed for having me. It's wonderful to be back in this vibrant country at a very important time in the world.
Yes, I realize that you know more about India than most people, but what we want to know is about the United States. Our viewers are very confused about the way things are changing practically by the hour in terms of tariffs, in terms of financial markets. First, if you can tell us, how do you see the US economy evolving for the rest of 2025? There is a large group of stagflationists who believe tariffs will bring inflation and a smaller fiscal deficit will bring lower growth. Are you in that camp?
Well, we knew that President Trump was going to be a change agent. None of us anticipated, I don't believe, the extent and the speed of, and the pace of change that is occurring. And we're still at a point where there's a number of policy uncertainties which will get resolved and become clear in the next few weeks. So I think in that respect, we will all have more clarity about exactly how the policies will play out on the economic agenda. What we do see, I think, are two of the major headlines. That deregulation, from our clients' perspective, is certainly going to be pro-growth. I think the clients see an unraveling of some of the regulations that have been holding the economy, the competitiveness back, and that will certainly attract investment. Tariffs is really the big question globally as to exactly what will the nature of those be. We will find out in April.
Yes.
And at that point, I think a lot of clients, a lot of companies, a lot of investors are pausing to wait and see, and then we can determine what the impact on the economy will be.
So you've not quite joined the stagflation bandwagon, would you say?
No, it is too early to fully understand exactly what the second and third order effects will be. Tariffs will certainly change trade. They won't stop trade, but they'll change trade, and that's probably going to be the area that most people are looking at. What will the impact on growth? What will the impact on inflation be? The devil's always in the details.
Yes, in this case more so. Time permitting, I'll come back to the global questions, but let me have your first views on Citigroup itself. You completed a major reorganization last year. Are you satisfied with the outcome? And is there more of transformation to come?
So 2024 was a very important proof point year on our strategy, and I was pleased to see that we had almost a 40% increase in net income. We exceeded the revenue targets we had set for the year, and we had record years in 3 of our 5 businesses. So I think that was important for demonstrating that our strategy is working. We are driving an improvement in our business performance. But we still have more work to do. We have more to do. And I'm excited by the potential for our firm. I'm excited by our potential here in India as well, because I see a lot of the changes that are happening in the world, be it in IT and AI transformation, be it in geopolitics, be it deregulation, be it in the market environments, mean that our clients need us more than ever, and we are in a strong position to support them.
Well, you know, your reorganization made headlines earlier this week in India probably for different reasons. There was news that you're going to do more of the IT work in-house and that the outsourcing will be cut down from 50% to 20%. Is that true?
What is certainly true is AI is changing the potential for how we think about all of the work that's going on. I think you've seen that we have rolled out AI tools to over 140,000 employees around the company and around the world. And that is starting to change how we do work. It's starting to change workflows. It's unleashing a lot of creativity. And therefore, we're looking at insourcing more of the work that we do, and our technology colleagues are proving that they are more than up to many challenges, so we're bringing more of the activity within Citi.
Okay. Well, I'm going to ask you something specific. If those decisions are made, one company whose stock went down was LTIMindtree. They are big IT contractors for Citi. I would assume that even big companies like TCS and Wipro have done projects, at least in the past, for Citi. Are any of these names likely to lose work or lose the quantum of work?
Oh, I love our partners here in India. We have some fantastic partners who are strategic relationships for us. I don't see those strategic relationships diminishing in their importance in any way. The nature of work for everybody is changing, and I'm looking forward to seeing many of our key partners while I'm here on the ground.
So maybe the nature of work will change, but the partnerships will continue.
Yes.
Okay, let me get back to the global scene, simply because my viewers will be upset if I did. You know, you're in 140 countries. How are you looking at Europe? For the first time in 35 years, they're going to increase their deficit. The German parliament, at least one house has passed it. So is there more work? Is there growth in Europe after many quiet years?
I think Europe is at a very important juncture because there are a lot of investors, I think, are losing some confidence in Europe's ability and willingness to really tackle the structural issues that were laid out, I think, extremely well in the Draghi report. And is there the will to drive the efforts to get more scale, more labour market mobility, to tackle reform agendas, and to really put competitiveness on the front foot? I think a lot of the European economies are really struggling with this. Companies in Europe, on the other hand, there are many bright spots in the individual corporates, but they are finding growth outside of Europe, not within Europe. And I think it's at a critical juncture that if Europe doesn't seize this moment, it will be very hard to make change that's necessary.
Where, smart money has been going to Europe now, lately, and to China. But from your point of view, from your vantage point, what are your growth areas?
I see more money moving to the States and to Asia because of concerns on competitiveness and also because of the wealth creation opportunities in both parts of the world. The capital market in the US is
We are all here because in a world of tariffs, tonight is all about tariffs. So please join me for an evening of no-holds-barred tariffs. And a big thank you to Deloitte, our sponsor for the evening. And now, ladies and gentlemen, comes the time to invite our chief guest for the evening. We are delighted to be able to hear tonight from India's finance minister, whose reformist zeal, support to infrastructure and unwavering commitment to fiscal consolidation will hold the economy in good stead for years to come. Ms. Sitaraman will be in conversation with Shupijit KK, Executive Editor of the Economic Times.
What a spectacular audience and what an amazing setting to be marking the 25th edition of ET Awards. Thank you all for being with us here today. And most of all, thank you, ma'am, for joining us this evening. Your budget this year, ma'am, created a lot of positivity with the continued support for CapEx and staying the course with the fiscal consolidation. But as we meet now, we are focused on a lot of geoeconomic uncertainty. There is a raging tariff war, which no one is able to predict what course it's going to take. What is going to be India's game plan? How should we negotiate this, and how are we going to negotiate with the US?
In a broad sense, I think both sides should have ambition for a good treaty. Particularly for India, when you're looking at Viksit Bharat, you need to have a good traction. Everybody is concerned about the growth numbers. You want it to be not in single digit. You want the growth to be in double digit and all that. You still need to do a lot more to strengthen our exports. And in order to strengthen our exports, not in this sector, not in that sector, across the board, wherever export potential lies, we need to strengthen that. So I'm sure the Commerce Minister is quite seized of this, and he would take this agreement to meet the ambitions that we have in terms of promoting growth, in terms of ensuring that our supply chains are intact and smooth and flowing well, and therefore that would guide his negotiations, I would think.
So geoeconomic fragmentation is now a reality. In some ways, it's a reversal of the forces of globalization that have created a lot of prosperity in this century. Do you think this will impede India's growth momentum?
I would think whether it is geo-fragmentation or supply chain disruption or tariff wars or strategic disruption to free flow of trade or multilateralism now taking a different kind of a multipolar angularities. In each one of them, there is such opportunity for us, and it is for us to very smartly move to make sure that this is the opportunity that India was waiting for, and we should use it so that, after all, it is another 22 years before we should reach the goal of a Viksit Bharat. So I'm sure every Indian is expecting all of us to move in that kind of a speed.
Now, while this sort of, while other countries also face offensive tariff action from the US, there is a very real chance that some of them could try and dump their goods in India. Is that an eventuality we are seriously watching against?
Well, yes, you're already seeing signs of that. Dumping of excess inventory which is sitting with any country, you know largely who we are talking about. When such chances exist, we will have to guard ourselves against it. So how carefully we can find a way to avoid the dumping, however much there is a layer of Indian manufacturers, small, medium-sized, would prefer cheaper inputs. But even then, the larger consideration should be to be able to give them the access to cheaper inputs, but not become a victim of dumping. So government's task it is to make sure that we plan for it and balance everybody's interests.
You've spearheaded major reforms in taxation, now in personal tax, but previously also in corporate tax. Is it time now to look at a more comprehensive or rationalization of GST slabs? The IMF has also advocated it.
Well, I think we've started this exercise. In fact, at the time when we started it, I would say it was late 22 when we started this exercise of rationalizing the GST, for the rates, for the number of slabs, and on the other side for compliance and the process itself. So the twin-pronged approach to simplify GST was started late 22, early 23, but that work is almost reached a finale. Now, at this stage, there is one more look that I've taken it upon myself. The groups have done excellent work, but I still have taken it upon myself to once more completely review each of the group's works and then probably take it to the council to see if we can come to a final conclusion on, yes, we agree on these, yes, we have changed these, but some more work is required in some other, so we'll take it to the next council and so on. So we are very close to coming to a final call on some of the very critical issues, reduction, rationalization of rates, looking at the number of slabs and so on.
Ma'am, on the matter of public sector banks, many of them do now need capital to sort of support, the growing demand for credit. Is the government open to reducing its stake in PSBs below 51%? Will we see some moves now?
Not specific to today's context. That we'll have to reduce and allow retail shareholders participate in public sector banks is a principle agreed to by this government. We will be increasing the public float. We want to have more and more common public, retail investors in banks to be actively buying and selling shares and get into the secondary market, and be also, if anything, representing themselves to the boards.
India is negotiating FTAs with a number of countries, including the EU bloc. What ought to be our guiding principles? What are the compromises we can make, and what are the ones that we can't?
Well, the first principle in that is put India's interest first. Today, our understanding is a goodness negotiation. Putting India's interest should be absolutely your top priorities. And unless you do negotiate for India's own good, even your negotiation will not be taken seriously by the opposite side, because they are very clear on what they want. But can you not be as clear? And therefore, I would think the approach now is to be a lot more hands-on on your negotiation. Take the stakeholders absolutely at every process with their inputs, not just consult them once and leave them, but as you progress, get guided by their inputs. And above all, on the larger principle, it is going to be a lot of bilaterals. It is not just India. Globally now, because of the tariff uncertainties, because of the ineffectual way in which WTO operates, you are going to depend on bilateral agreements rather than look at multilateral, or even look at bilateral, but when things go wrong, you still have a WTO to fall back on. No, you probably don't have an effective WTO. I'm not saying it's not there. It is there. But with your complaints going there, you're not going to get any redressal in a near future. So what is the good of it? And therefore, bilateral, your interests first, and ensure the language of the agreement is such that you don't get into legal tussles too often.
And we are projected to grow at about between 6.5 and 6.7% next year. I think everyone likes a faster GDP growth. What would you say are maybe the 2 or 3 things that need to fall in place for for us to achieve maybe 1 or 2 percentage points more in the growth rate?
There's one thing on which definitely I'd like to take this opportunity, tell the media, make all of us think about is, like the markets, there is a sentiment which prevails in a country to grow. You need to have that positivity. You need to have that self-belief. And if this is said, the unsaid is, you need to be the last person to run down your own country. You need to believe in India's capacities. It is that sentiment which is missing, if anything, today, so that all of us can trust each other and say, yes, we can do it and move forward. My expectation, other than everything else, banks will have to be robust, credit will have to be available, fuel cost will have to be low, more funds will have to be available for small and medium industries. The rigor with which you want to have ease of doing business should also trickle down to states. Your municipalities and local bodies will have to do well. All that said, sentiment, please. If sentiments can govern our markets and therefore all of us feel buoyed at one point and completely watered down at the other, so is the economy. In spite of the achievements, if we go on naysaying, our youth are not going to hold us easily accountable. They will put us through the grind, saying, what are you all doing? Startups have proven to us in the last 5 years, against all odds, how they can progress and how they've made India the 3rd largest ecosystem. If they are able to do that, shouldn't all of us try and do this and make India do faster, grow faster? I would strongly pitch for an optimistic tenor and not when we are not really growing at all. Fastest growing last 3-4 years continuously. At this time too, we don't want to be optimistic.
The message is loud and clear, and with that we come to the end of this session. A big round of applause to our always wise, always candid Finance Minister, Nirmala Sitharaman. Thank you so much, ma'am, for being with us.
We have now come to the all-important awards ceremony that we have all gathered here for today. This edition of the award witnessed immense contributions from a stellar jury of peers who took time and effort to deliberate and carefully choose tonight's winners. So before we begin the celebrations, a note of thanks for our incredible jury members, most of whom are with us here tonight. And with that, ladies and gentlemen, now we proceed to the climax of today's Theatre of Celebration, the awards. Now, ladies and gentlemen, the first award goes to a legend in journalism. Ladies and gentlemen, the winner of the ET Global Indian of the Year is...
Fareed Zakaria is a pioneering Indian-American journalist, political commentator and author, globally renowned for his sharp and insightful take on international affairs. ET honors Fareed Zakaria with the Global Indian of the Year Award for his unparalleled insights into geopolitics and global affairs, making him one of journalism's most influential voices.
So Fareed couldn't be with us here tonight. I would like to request his niece, Malika Noor Mehta, to receive the ET Global Indian Award on behalf of Fareed Zakaria from the Honorable Finance Minister.
I feel very lucky to have been able to be the occasional fly on the wall in Fareed Mamu's life, because I think, perhaps just through the process of osmosis, I learned so much about politics, policy, humanitarian issues, business, and much more, just by being in his presence. I learned so much about how to analyze, how to think, how to dissect, how to question, just by watching him do so. While my entire family on both sides is made up of people who think deeply about our world, about the issues that plague it, and about how to find solutions to seemingly intractable problems, I do believe Fareed Mamu is one individual in our family who has mastered the ability of presenting a very complex idea in the simplest of ways, and as such, opening up the conversations to people who may have previously felt excluded. Fareed Mamu, thank you for all that you have done for our world. I love you.
Thank you so much, Malika, for such wonderful words. Now, ladies and gentlemen, ET's Business Reformer Award has celebrated important policymakers over the years who have left a deep imprint on the nation's journey. And this year's winner and his contributions are all too well known for all of us. Let's take a look at who the winner is.
A visionary, innovator, and reformer, few leaders have transformed India's infrastructure and technology landscape, like Ashwini Vaishnav. For his fearless reforms and his commitment to building a modern India, the Economic Times proudly honors Ashwini Vaishnav with the prestigious Business Reformer of the Year Award.
Congratulations, sir. As the Business Reformer of the Year, I will request Mr. Vaishnav to receive his award from the Honorable Finance Minister.
First of all, I would like to thank Honorable Prime Minister Shri Narendra Modi ji, who gave me this platform. Without his confidence, without his trust, without the opportunity that he has given, it wouldn't have been possible to be here on this stage and to be able to contribute to the country's growth. I would also like to thank my parents for giving me the values, for very, very strong belief in certain principles that my parents gave me. I also would like to thank very, very strongly from the bottom of my heart, my family members, my wife, and 2 children who have been very strong source of strength for me, and the kind of sacrifice they have done. When Prime Minister gave me this responsibility, the first thing that my family members told me was that we are not going to shift to the official accommodation in Delhi because this is a rare opportunity Prime Minister has given you. So give your 100% to the country. Don't even think of us. Give your 100% to the family. Thank you all. Thank you all the friends who have contributed to this journey. Thank you very much, ET. Thank you all.
Ladies and gentlemen, as we progress forward, this is the era of tycoons who are making bold bets and driving consolidation in entire industries. which is why fittingly this year, the award has gone to the leader of a global business empire that deeply is Indian at its core and its fabric. The winner of ET's Business Leader of the Year award is...
Few business leaders have shaped industries and redefined leadership like Kumar Mangalam Birla. Under his leadership, the Aditya Birla Group has evolved into a global powerhouse, spanning 40 countries and leading industries that shape economies. Since 1995, he has led the group's extraordinary rise, from a $2 billion entity to a $66 billion global conglomerate. Tonight, the Economic Times celebrates Kumar Mangalam Birla, an architect of growth, a trailblazer in industry, and a recipient of the Business Leader of the Year award.
Ladies and gentlemen, let's have a huge round of applause for the winner. I would request Mr. Kumar Mangalam Birla to please come up on stage and receive the ET Business Leader of the Year award from our Finance Minister. Sir, congratulations. But before we ask you to say a few words, we have a little bit of a surprise for you. So I'm going to invite on stage Swatantra Microfin Chairperson and Kumarji's daughter, the lovely and supremely talented Ananya Birla, to grace the stage and say a few words.
I still remember when you told me that you had won ET Business Leader of the Year for the third time, a feat never achieved before. Your eyes were shining and you were so overjoyed. So just to give you guys a little bit of context, my dad absolutely loves the Economic Times. Papa, you truly inspire me. I cannot imagine how hard it must have been to lose your father, Dadaji, at 27, such a young age, take over an entire empire when everyone had written you off. You have not only proved everyone wrong, and this is a testament that ET obviously agrees to, 3 times now, you have made the entire nation proud. No matter what, you have shown up to work every single day for the last 30 years. Through it all, and that is no joke. On behalf of Mom, Aryaman, Advaitesha and myself, we love you all so much. Congratulations, Papa.
Thank you so much, Ananya. That was beautiful. And now, the man himself, Kumarji, requests you to please say a few words.
My mother has been my conscience keeper. She has been my rock of Gibraltar. I've done some crazy things, and she has supported me through it all. I want to dedicate this award today to my mother. I want to thank my wife, Mirza, for always being there and for bringing up our 3 children so beautifully. Our 3 children, Ananya, Aryaman, Vikram and Advaitesha, I'm just amazed at how fierily ambitious they are at their independence, not wanting to take help from their father. Some of you might know that I am the 6th generation in the family of the Birla's family of business builders. And there's something I want to share with you. This is something that I chanced upon a letter only 2 years ago. This is a letter from my great-grandfather, Mr. G.D. Birla, to the shareholders of Grasim way back in 1973. And allow me to read a short excerpt of that for you today. It says, and I quote, "How does one judge a company? Do the criteria depend solely on its profitability, its production figures, market share and product ratings, or is there some other aspect one must consider as well? Some deeper, warmer, more human aspect?" We have always believed that there is. We have always believed that what really matters is how much the company cares, how socially involved it is, to what extent it is concerned about improving the quality of life of the people around it, not just its own employees, but also the members of the community it lives in. I read this a couple of years ago by chance, and it struck me that this legacy, this letter written almost 50 years ago, actually captures the essence of the purpose of our group today. Thank you once again. I think this is as much for the work that needs to be done. There's much more to do, to imagine, to build, to transform, and a lot more fun to be had. Thank you.
Hello and welcome to India Business Hour. I'm Parikshit Luthra. Here are the headlines we are tracking this evening. Indian equities continue their rebound for the fourth day as the US Central Bank's decision to keep rates unchanged sparks a rally across Asia. All sectoral indices end in the green, led by the IT sector. The rupee marks its strongest gaining streak in 14 months. US Federal Reserve maintains a status quo on benchmark interest rates for the second consecutive time as it anticipates Trump's tariffs to push inflation higher. China's central bank and Bank of England stick to the script, hold interest rates as well. The Cabinet Committee on Security approves the 7,000 crore rupee deal to procure advanced howitzers from the Indian defence equipment manufacturers. The Defence Acquisition Council also clears proposals worth 54,000 crores to bolster India's arsenal. Also approves guidelines that will reduce acquisition timelines. Adani Group forays into wires and cables business. Subsidiary Kutch Copper ties up with Pranita Ventures to form a new entity called Pranita Eco Cables. Leading cable stocks crash up to 14% in trade. The government seeks details from Ola Electric over discrepancies in reported sales and vehicle registrations. Maharashtra Transport Commissioner exclusively tells CNBC-TV18 that they have impounded 36 Ola Electric scooters as they were available at outlets without valid trade certificates. Social media platform X moves the Karnataka High Court against the Indian government's power to take down content under the Information Technology Act, argues that such orders are in violation of Supreme Court judgment. The apex court in March 2015 had declared that content could only be blocked through a competent court order or under Section 69A, which deals with the clause of national security. Donald Trump says that he expects India to lower tariffs on US imports substantially, but adds that his administration would be imposing reciprocal tariffs nonetheless. On the 2nd of April, India and the US had reached an agreement to finalize the first phase of a multi-sector bilateral trade agreement by fall of this year. Zelensky said he has accepted the ceasefire on Ukrainian energy targets that Putin agreed to earlier this week, calls his telephonic conversation with US President Trump as positive, very substantive and frank. This was the first conversation between the two leaders since their showdown at the White House last month. Israeli airstrikes into the Gaza Strip continue. Close to 85 people reportedly killed in the last 24 hours. Hamas says that mediators have stepped up efforts to halt the Israeli offensive. Those were the headlines, and we'll start with a closer look at what has been the fourth consecutive day of gains on Dalal Street. Indian equities joined the Asian markets that rallied after the US Federal Reserve kept rates unchanged. This makes it the longest winning streak for Indian equities in nearly 2 months. Nifty and Sensex gained over 1% each, with Nifty crossing the 23,200 mark to rise to its highest level since the 13th of February. All sectoral indices ended in the green, led by the IT index. Meanwhile, in the currency markets, the Indian rupee rallied to near 2-month highs as IT strengthened against the greenback for the 6th day in a row. It is now 2% stronger than the all-time lows it hit on the 10th of February. This marks the rupee's longest gaining streak in 14 months. The US Federal Reserve did not throw a curveball as widely expected. It kept benchmark interest rates steady for the second consecutive time, while indicating that at least 2 rate cuts are likely later this year. US Fed Chairman Powell added that the Trump administration's policies appear to have tilted the US economy towards slower growth, while a good part of the higher inflation expectations was due to the president's tariffs. US President Trump disagreed with the central bank's decision. In a post on social media platform Truth Social, the president said the central bank would be much better off cutting rates. CNBC's Steve Leisman is here with more details on the Fed decision.
The Federal Reserve leaving interest rates unchanged at its March meeting in the range of 4.25% to 4.5%, but emphasized the uncertainty in the outlook linked to policy changes coming from the Trump administration. Throughout his press conference, Fed Chair Jay Powell made clear that the Fed is not especially confident in its outlook, but is in its current policy.
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy.
Fed officials in their projections raised their core inflation outlook for this year by 0.3 to 2.8%, most of which was linked to higher tariffs. They lowered the growth outlook by 0.4 for this year to 1.7%, and yet it kept its forecast unchanged for 2 rate cuts in 2025.
We understand that sentiment is quite negative at this time. And that probably has to do with, turmoil at the beginning of an administration that's making, big changes in areas of policy. And that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more at the price level.
Powell repeated that the Fed was focused on 2 options: cutting if there's clear economic weakness, and holding rates steady if inflation ends up being a problem. He continued to not mention rate hikes as an option. Steve Leisman, CNBC.